Teresa Taylor.
Here.
David Miller.
Here.
Controller Malia Cohen. Deborah Gallegos for Malia Cohen. Thank you. Frank Ruffino for Fiona Ma.
Present.
Lisa Middleton.
Present.
Arena Ortega. Jose Luis Pacheco. Kevin Palkey.
Good morning.
Ramon Rubacava.
Present.
Yvonne Walker.
Here.
Melissa Willett.
Here.
Dr. Gail Willis.
Thank you very much. So we are going to start with the Pledge of Allegiance, and I have asked Mr. Palkey to start us.
Please stand if you can. So I believe our flag is over there in the corner. Ready? I pledge allegiance
To the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you.
Here, you have a hot mic.
All right, so for those who are watching us online, we're gathered in Monterey this week for our annual offsite meeting. And our CalPERS offsite meetings are designed to be educational, highlighting information that will be the foundation for the work ahead of us in the coming year. We encourage open dialogue and welcome your questions to make the most of this opportunity to deepen your knowledge. We are joined in the room today by several stakeholders that have traveled to the coast to join us. We will welcome public comment throughout our 3-day event for those in the room as well as joining us online. For those who want to participate in public comment here in the room, please see one of our stakeholder relations team members. For those wanting to comment remotely, you could call in after each presentation by phone at 1-800-259-4105, and our team will be standing by to assist. And with that, I'd like to introduce our CEO, Marcy Frost, for her opening comments.
Great. Can everyone hear me okay? So thank you, President Taylor and members of the board and stakeholders, as well as the speakers who have joined us today. As we know, our annual July offsite meetings take place during the early days of the new fiscal year. The timing is intentional because these meetings allow us to take a step back, look at the last 12 months, but I think even more importantly, look at the 12 months ahead of us. Last year at this time, we heard some of the early ideas from our then new Managing Investment Director for Sustainable Investments, Peter Cashin. Today, Peter has an update on the important work his team has been doing in crafting and executing the Sustainable Investing Plan for 2030. That includes deploying capital to invest in the global climate transition, working with partners and regulators to enhance human capital practices, and finding innovative ways to realize the returns that we need to pay our members' benefits. We'll also talk about the evolution of our healthcare program over the last year and how we're planning to further enhance clinical quality measures and advance our work on healthcare equity. And later, we'll get a report on our CEM benchmarking scores for 2023 and hear how we rate with stakeholders through our annual survey. It's a packed agenda that includes guest presenters whom we're honored to host. Looking forward to these discussions that we'll have over the next few days. So let me pivot to today's agenda. We'll start by welcoming our new Chief Investment Officer, Stephen Gilmore. This is not his first day on the job. He actually had his first day on the job on Friday. A little jet lag, flew in from New Zealand just the day before. So Stephen really impressed us during the CIO search, and I know he is eager to hit the ground running, although he certainly has already done that. He's a seasoned investor, familiar with the public requirements of a job like CalPERS, and above all, he is committed to the mission and to our members. And I know that you've been having a number of early discussions with the senior leadership team in the investment office as well as our executive team. As we welcome Stephen, let us also thank Deputy Chief Investment Officer Dan Bienvenu, excuse me, for his leadership of the team and our strategies over the last 9 months in an interim role. Dan has done an outstanding job keeping the team on track and stepping into the hot seat on occasion, representing CalPERS with professionalism and dignity. Please join me in thanking Dan. As I indicated earlier, our first two presentations today center on the $100 billion climate action plan, as well as the steps we're taking to help lead the global transition to a lower carbon economy. We're taking some really interesting steps, embracing innovation, new approaches to climate investing that are likely to draw a bit of attention. And that's okay. We have a high conviction that this is the right direction for the portfolio, one that will deliver strong investment returns for our members. We'll also be discussing the role that emerging and diverse managers play in helping to realize some unique opportunities that help diversify the fund and enhance our returns. That will be led by our private equity team, who will be joined by our partners from TBG and Grosvenor. They have brought along some of the investment entrepreneurs we're funding through our co-investment program launched last year, and they'll be able to talk with you about their experiences so far in working with TBG and Grosvenor. And then after lunch, thank you to President Taylor for suggesting this as an agenda item. We'll pivot to geopolitics with a fireside chat featuring Stephanie Ivy Sanford of Goldman Sachs and Norman Eisen, the former U.S. ambassador to the Czech Republic and now a senior fellow with the Brookings Institute. We're honored to have them both here and learn from their experiences. With so many forces impacting the economies around the world and the political climate here in the U.S., the timing for this discussion, I don't think, could be better. We'll finish the day with an update on our proxy voting record from the year. And in addition to our ExxonMobil and Tesla votes that made news this season, the CalPERS stewardship team voted our proxies with hundreds of companies in our portfolio, consistently advocating for the kind of strong corporate governance that helps protect our investments. So let me jump to a topic that I know many in the audience, as well as our board, are interested in, and that is the fiscal year returns. As of June 30th of 2024, we are reporting a preliminary one-year annualized return of 9.3% with an estimated funded status of 75%. As you know, that's above our expected long-term investment return of 6.8%. The investment team saw particularly strong returns during the second quarter, and our global public equity portfolio led all of the asset classes. While those returns are to be celebrated and have boosted our funded status, we are reporting a decrease in our multi-year returns, partly a reminder of the chaotic investment conditions experienced at the outset of the COVID pandemic. The 5-year return now stands at 6.6%, the 10-year return stands at 6.2%, and the 20-year return is estimated at 6.7%. I also want to point out the strong returns in private debt, since that was a new asset class as a part of our last ALM cycle. It's relatively new, as you know, and that saw a return of 17%. Again, a 9.3% return is indeed a good number to report, and our team deserves a thank you, a big thank you for their hard work. One thing to keep in mind is that these investment returns, based on the policy changes that the board made this spring, it will bring an action item to the board in the September meeting on the risk mitigation policy that used to go in effect at 200 bips above the assumed rate of return, and it was an automatic triggering of this policy. It is now coming back to the board for consideration whether you want to take action and how you want to have that action move forward. All in all, though, we are encouraged by what we've seen, and we look forward to the next steps with our new Chief Investment Officer, who you'll hear from next. But before that, I'll turn it back over to President Taylor.
Thank you, Ms. Frost. With that, I'll turn it over to our new Chief Investment Officer, Stephen Gilmore, for his comments. And it's a pleasure to have you here in person with all of us for the first time. Mr. Gilmore, on behalf of the entire board, welcome. We're very excited to see where your leadership will take us.
Well, thank you very much indeed. I'm very happy to be here. It's a privilege and a pleasure. I have to say I've had a very warm welcome, and that's not just because of the 112-degree heat in Sacramento, which is quite different from New Zealand in winter. But the members of the board, team members, and even locals in Sacramento have made me feel very welcome, even the first few days. I thought it might be helpful to talk a little bit about what attracted me to CalPERS. For me, it's a natural evolution. I spent 14 years working for sovereign wealth funds, Australia and New Zealand, worked in financial markets for a long time. CalPERS is a storied institution, and for me, attractive things are aspects like size, the number of members, more than 2 million members, a very large pool of assets under management, more than $500 million. half a trillion, I should say, and I had to get used to all those zeros. But also it is about the mission. It's about making those investments in a sustainable way. And when I went through the process, there were things like Sustainable Investment 2030, which we'll hear more about when Peter speaks. But I was quite struck by the ambition. And it's not just the size of the investments, 100 billion, over a period of time, but it's also the desire to engage, to be active, and given the size and influence that CalPERS has, that can make a real difference. So it's not about excluding, it's about engaging and making a difference. I was also struck by the focus on diversity. As investors, we have to solve very complex problems. And to solve those complex problems, it's essential that we have good information and different views. And from my perspective, those views come from lived experience, cognitive diversity. That could come through gender, it could come through ethnicity, it could be culture, it could be religion, it could be educational background, it could be socioeconomic, it could be neurodiversity, it could be age. I'm not going to label any one of those as being the key determinant, but it's about having that variety of experiences when it comes to solve those problems. And of course, that's an important feature of building teams within CalPERS and also an important feature of our investment. I think in the period ahead, the most important thing for me will probably be to have lots of meetings and to listen. And as Marcy knows, I asked if I could ride down here with Scott. So we spent 3 hours talking about, I guess the challenge ahead and the asset liability work that we'll do over the next year or so. So I'm really quite excited by lining up the portfolio, the assets with the liabilities. Naturally, the key imperative for us is to improve the funded ratio. And as Marcy mentioned, the returns over the last year have helped us do that. The reality, of course, is that the biggest determinants of that funded ratio will be what the market gives us, along with inflation outcomes and so on. From an investment team perspective, the focus will be on improving the odds of beating that required return. And that means using the advantages that we have. Those advantages include things like size, reputation, the quality of the team. So that's really going to be a big focus for me. I don't really want to speak too long because there are more important sessions to come. I wanted to hand over to Dan, and I personally would like to thank Dan for the work that he's done in being a great leader in the interim, and I'm looking forward to working closely with you through time. But you've got an important announcement or acknowledgement to make.
Yeah, thanks, Stephen. And I, too, very much am looking forward to working together and want to say welcome, and I'm very happy that you're here. I also just want to take a second to recognize someone in the audience here who's retiring, and that's Jean Sue. Jean is a very talented team member, talented credit investor, talented investor in general, and we will miss her greatly. Jean and I have worked together. Jean's been here for 25 years. We've worked together for 20 years in the time that I've been at CalPERS. The first time we worked closely together was when Jean had the idea, right in the aftermath of the financial crisis, to put I think it's a term asset loan facility, a TALF asset, into our portfolio, and then overlay it with equity risk. So it was the first time that the equity and the fixed income teams really worked closely together. It was a great idea, and with Jean's strong underwriting skill, we were able to add hundreds of millions of dollars to the portfolio just with that asset alone. From there, Jean went on to build the CLO portfolio, again, overlaying that with either an equity beta or a fixed income beta. That happened for years and years, and again, that period added hundreds of millions of dollars to the portfolio. And then most recently, Jean was responsible first in the opportunistic strategies program and then through the private debt program to actually build our allocation to private debt. That too has been very accretive. She built the team, she built the portfolio, and as Marcy said, and Jean has warned me very strongly that we can't count on 17% from private debt year after year, so noted, but it did add 17% in this past year, and again, that represents hundreds of millions of dollars. So Jean If you could just stand really quickly and let us thank you. We wish you the best. So Gene, congratulations on your retirement. Much deserved, hard earned, and we wish you the best. And with that, I'll hand it over to Frank Ruffino, who now wants to say a couple words also.
Good morning, and good morning, everyone. Good morning, Gene. I am particularly honored to, on behalf of the Treasurer of the State of California, the Honorable Fiona Ma. She joins the California Public Employee Retirement System in recognition of your retirement service from CalPERS. And I quote, "On behalf of the State of California, I hereby award this certificate of recognition in honor of your exceptional leadership and commitment to transparent, ethical, and effective operations over your 25 years of service to the California Public Employee Retirement System, the largest pension fund in the nation. Thank you for your wholehearted dedication to serve the Golden State, the people of California, and your colleagues. Congratulations and best wishes on your retirement. Fiona Ma, California State Treasurer."
I want to thank Dan and Frank, and especially want to let Jean know we're going to miss her. And I hope you have a wonderful retirement, and that's why we do this work, right? Is to have retirement. Thank you. Go ahead, Ms.
Thank
Cohen.
you. Good morning, ladies and gentlemen. My name is Malia Cohen, California State Controller. And before Frank stole the mic, I too wanted to share just a couple thoughts. Jean, I am sad but excited for you for this really exciting transition. I know it's been slowly in the making. To the public, I just want to acknowledge that when I came on board last year, she was one of the first staffers to reach out and take me under her wing and educate me and bring me up to speed on where this body was, some of the issues, the hot topics, and pitfalls. And I think you've demonstrated poise and grace in leadership, and sometimes often in the shadows. And I think that that is a strength to your character. And I just wanted to speak to that and just uplift it. I wish you and your family a great time as you move on forward. I'm glad you made it to the offsite this year. And I just wanted to add my voice to the choir that's singing your praises. Thank you.
All right, with that, I'm going to turn it over now to Peter Cashin, the Managing Investment Director for Sustainable Investments, for an update on our SI 2030 plan and the climate investments we announced last week.
Thank you, President Taylor. Good morning, everyone. It's my pleasure today to provide an update on the Investment Office implementation of the Sustainable Investments 2030 strategy. As you recall, it was 1 year ago today that we presented the draft strategy, and I believe we've made some important progress to date. To start, I'd like to give a refresh of the 5 key elements of the strategy. The first 3, as you can see, are primarily related to climate. So invest $100 billion to generate outperformance. Second, increase portfolio resilience by fully integrating ESG, including climate risk analysis, and also put ourselves on a pathway to net zero with some important 2030 milestone targets. The fourth, which is critically important, is to promote greater inclusion in the financial industry. And lastly, to promote equitable financial markets, our work led by Travis Antoniono. So let's zero in for a moment on the Climate Action Plan. As you know, we'll invest towards our 2030 Climate Solutions $100 billion target. And this will put us on a pathway to reduce our emissions by half by 2030. CalPERS will very actively engage with our portfolio companies on their net zero plans, as we've especially seen very recently in the past with Marcy and Exxon. So kudos to Marcy. Over time, we will also consider reducing exposure to companies if they don't take action, and if such inaction increases their investment risk for long-term investors like CalPERS. Lastly, we'll build out our ability to track emissions and climate portfolio performance, and this will be led by Nelson. So now I'd like to zoom out and address a few bigger picture questions, namely, why is this an important time in sustainable investing? And why do we think we can generate outperformance? So to the first question, why is this an important time? Well, if we look historically, we really are in the midst of a climate revolution. And if we look back over time, we're arguably in the fourth such revolution historically. The first was the adoption of coal in the 1760s. The second was harnessing the power of gas starting in the 1870s. The most recent, as we know, has been the technology revolution, beginning in the 1970s. When the video game Atari came out, you remember Pong and Asteroids, I mean, really that fundamentally changed the world, and I think that's the right milestone for the start of the technology revolution. But each of these revolutions has had a profound impact on growth, efficiency, and frankly made incredible contributions to economic and social progress. So that brings us to today. Climate change, as we know, is real. And ironically, in part, it's been caused by those first two revolutions, coal and gas. So we're undergoing a climate change revolution since decarbonization and transition to lower carbon will impact really everything. From the way we generate power, travel, consume, to even what we eat. So given the size, scale, and speed of this transition, it's essential that we're aware of the risks and the opportunities as prudent investors. Now, if we look closer at the here and now, climate is really one of the three megatrends that will further shape the future. There's AI, deglobalization, and climate will be three fundamental drivers that will impact the economy today and beyond. So again, we must understand it, we must be proactive and capitalize on it. Climate in particular will play out over the rest of the century. The next question is, why do we think we can generate outperformance by investing in climate solutions and transition? Well, we believe there's really three reasons. The first is the unprecedented level of investment pouring into this thematic. $1.7 trillion in 2023, up from $900 billion just a few years prior. This will create an unprecedented amount of new investment opportunities. We need to keep in mind that some of these will be good and some of these will be bad, so selectivity is key. The second reason relates to resource efficiency. Firms that better contain costs by improving their efficiency, for example, reducing water consumption, reducing electricity, reducing the reliance on commodities, will be rewarded with lower cost structures and higher valuations. As we look forward, the economy will face unprecedented demand for these items and resources in general, causing increased price pressure. So firms that are efficient and frugal will benefit. Similarly, entirely new industries of resource efficiency providers are developing, and we want to be aware of these, and some of these we've already invested in. The third reason is climate risk. Physical risk is self-evident. We have wildfires in California, real estate vulnerability on the coast, this inability to get insurance. The second risk, transition risk, is the risk faced by firms, particularly high emitters, related to reduced demand for their product as consumer demand lowers, and increased costs related to government policy, for example, imposing a price on carbon emissions. So from a top-down portfolio level and from a bottom-up company assessment, we need to be very aware of these risks across all investments, not just climate solutions. So we believe that by incorporating these three factors into our investment decision process, it will result in improved selection of companies and funds, and by so doing, our strategy will outperform a strategy that fails to recognize these three critical long-term drivers. Lastly, let me touch on the role of the Sustainable Investment Unit. So we want to equip the investment office with the tools and knowledge to profitably and prudently navigate the transition to a low-carbon economy, now and over the decades to come. We'll do this by adding value across INVO, by setting sustainability strategy, contributing technical expertise to deal teams, and sourcing investments and funds. We want to be seen by the market and position ourselves as an informed and intelligent climate investor who can operate at scale and be their first point of call. A very quick update on the Sustainable Investment rollout plan. As you know, we've developed and launched the 2030 SI strategy. We have a major recruitment effort underway where we're adding 10 staff to the Sustainable Investments team to double in size from 10 to 20. We've had some critically important advances on the human capital side with the labor principles implementation and the responsible contractor work, which is very well advanced. We are updating ESG guidelines and procedures with an external firm, and we'll be rolling that out as soon as we bring on additional new staff. Emerging manager program success and expansion. We've recently in the press, as you saw last week, had a media and promotion around the INVO's sustainable investment rollout, and of course investing towards the 100 billion. So in the first 6 months of the strategy rollout, there's already some significant progress. In private markets, we have an advanced pipeline of 19 deals for 3.6 billion, and we've committed 9 deals for over 1.1 billion. So regarding the pipeline, let me also underscore that not all these investments will happen. Some will fall off, but that's a natural part of the process. Within this pipeline, private equity has the most in number, while infra has the most in amount with more than 2 billion. So a big shout out to each of those asset classes. In terms of commitments, we have 9 commitments across a range of sectors, which is indicative of the broad reach of climate across the economy. Notably, 7 of the 9 are co-investments. One interesting co-investment that I'd like to highlight is a large recent co-investment in a sustainable energy company that provides both renewable energy and software solutions that optimize energy use for producers and consumers. This energy optimization is vitally important because it reduces the need for extra or new renewable energy construction, simply by allowing customers and providers to do more with less. This facilitates the broader transition to a low-carbon economy, and we believe that their product will have an amazing growth opportunity. I'm also very happy to report that 8 of these 9 have been done by private equity. And that is the largest deal, the energy distribution one, has been done by infrastructure. I'd now like to make a few concluding remarks from my side. First, we've made excellent progress in this first year, but there are few straight lines in investing. This rollout will face some risks and issues, like any thematic investment strategy. There can be political changes, the speed of decarbonization, technological challenges, and this all introduces uncertainty. So as we implement, we'll be cautious, deliberate, and also highly selective. As such, we need to ask for some patience from the board as we roll out this investment program. It won't be a straight line, it will take time, but we already have some excellent progress to date. Each climate dollar will also need to compete against other investment alternatives, non-climate traditional investments. We think that this is the correct approach. We don't want climate to be a portfolio construction constraint, but rather we want our climate investment strategy to identify new opportunities that may otherwise have been missed and make us more climate aware. We believe that this approach will allow us to deliver on our KPIs, namely generate outperformance, increase portfolio resilience, and have us on this pathway to net zero. It's now my pleasure to pass to Samiso, Nelson, and the FTSE team for a presentation on the Climate Transition Index. Thank you very much.
Thanks, Peter. Next slide. Okay, thank you. Nelson Decontessa, Sustainable Investments. As noted by Peter, private markets are and will be playing a key role in the transition to net zero. But the question is here today is the climate change revolution also investable in public markets, and specifically in public equity markets also? Can those investments be a source of portfolio resilience and a driver of incremental performance? How, when, where? These are some of the fundamental questions that the SI and GPE teams, under the leadership of Peter and Simiso, have generally been exploring, and that are framing CalPERS' approach to climate-aware investing. The short version of our answer to those questions, complex questions, is that yes, the climate change economic revolution is investable in public equities, and that yes, value add can be generated through a combination of active portfolio management and scalable systematic indexing. So why active portfolio management? We believe that the combination of materiality and non-obviousness or complexity of the transition to a net zero economy produces prime conditions for alpha generation. The emergence of new business models, the complexity and specificity of national decarbonization plans across the globe, inconsistencies in reporting standards are all factors that support those conditions for alpha. As with any other source of alpha, it won't be easy, but the opportunity is there, will be there for skilled managers to seize. While we can't speak about specific funds or managers here, we have listed on the slide, at the top of the slide, several types of strategies or frameworks that we believe will be building blocks in building a diversified portfolio of climate-themed alpha. Switching to indexing, how can climate-aware indexing add value relative to a traditional hard-to-beat cap-weight index over time? Here, we believe that lessons learned from past revolutions or megatrends are useful. The digitization of the economy that started 25 years ago and still in play is, in our opinion, a very relevant analog to consider and learn from. Most of us remember the high-flying dot-coms of the 90s or the near bankruptcy of capital-starved Amazon.com. One lesson learned here is that, yes, few of those early disruptors have in fact grown old to disrupt. But really the most important lesson for us is not to be fearful, but it's really that a large and long horizon investor like us is that a disciplined, diversified tilt on technology proved very successful, in spite of its non-linear path that you mentioned, Peter. We believe that a disciplined tilt on climate solutions will also be accretive over time. In the space of climate-aware indexing, investors have many options, many frameworks to choose from, and the table below on this slide highlights several of those, and I'd like to thank Wilshire for their help on this. Most of those frameworks have one thing in common. They primarily seek portfolio emissions reduction. CalPERS' approach to climate-aware indexing is different. It falls under the climate transition category. It focuses on climate solutions, the picks and shovels of the transition, the growth upside of that transition, while also seeking to mitigate the potential downside associated with the transition to a low-carbon economy. The FTSE Russell team here today will tell you more about the building blocks that we used in our jointly developed Climate Transition Index that was announced last week. Simiso will then highlight key differentiating features in our custom index. So with that, it's my pleasure to pass the microphone to Tony and Caroline from FTSE Russell.
Thanks, Nelson. First, let me start by saying thank you on behalf of FTSE Russell to the board for the opportunity to present to all of you today. My name is Tony Campos, joined here by Carolyn Eagle, my colleague at FTSE Russell. As Nelson said, we're going to talk about some of the work that we've been doing in climate indexing, particularly incorporating low carbon transition into public equity benchmarks and passive portfolios. If we could go to the next slide. We'll cover 3 areas broadly. I'll cover the first 2, and then Carolyn will finish up. And we want to start with kind of first taking a bit of a temperature check on sort of what global asset owners are sort of looking at in trends, adoption, priorities in sustainable investment, how that relates to some of the work that we've been doing in climate and benchmarking. Then I'll dive into a little bit more detail around this sort of, the concept of the transition to the low carbon economy. What is it? What is the global green economy? How big is it? What are its characteristics? Can we look at the performance? And then we'll get into, some of the index design concepts, building blocks and principles based on our experience for, building indexes for asset owners globally that, help incorporate the transition to a low carbon economy. So with all that as sort of background, just let me say, FTSE Russell, as one of the largest global index providers, we've been focused on sustainable investment since 2001, launched one of the first ever sustainable investment index families back then. I myself joined the team in 2004, so about 20 years working in sustainable investment at FTSE Russell. There's been a huge evolution and change over those 2 decades in this space, and the work that we've been doing with the team at CalPERS has been among the most exciting, rewarding, and challenging that we've ever undertaken, and it's been a real privilege. So thank you to the team, and we're excited to talk about it a little bit more today. So with that, let's carry on. On to the next slide, please. So since 2018, we've conducted an annual survey of asset owners on the topic of sustainable investment. We wanted to just start with sharing a few sort of early look at some of this year's key findings. So we talked to around 300 or so asset owners globally. This was done earlier this year, kind of in the spring, March into April. Pretty even geographical distribution. And there's a whole lot of detail and analysis. We're just going to hit, again, some key findings to emphasize some of the themes of our work in climate indexing, but also just to say, all right, kind of, we all see a lot of certainly media coverage, headlines, and discussion around sustainable investment. Where are things as of now? So broadest kind of conclusion to draw and thing to point to is, kind of when we ask the big question of, are you evaluating or adopting sustainable investment as part of your investment strategy, we still see, nearly 3/4, 74% still say yes, global asset owners. And regionally, when we break that down, the Americas score is on trend with the global score. So it's about 72% of the asset owners here in the Americas region, so that's US and Canada, say that they are evaluating or implementing sustainable investment. So broadly speaking, there's still a significant majority of the global asset owners that we survey that are focused on sustainable investment. Now, that is up for the Americas year on year. So we did see a bit of a dip last year in the Americas in terms of, sort of, let's call it sentiment in terms of response to that question, but it's sort of jumped back up to 72% for the Americas region. And as we start to look a little bit more specifically at questions related to topics and areas where, priorities are taking shape, we certainly see that the impact of climate risk on investment performance remains, top of the agenda. So about 75% of respondents in the Americas say that the investment impact of climate risk on investment performance is of primary concern. So again, that is consistent with what we're seeing globally as well, where climate and incorporating the transition to a low carbon economy into, again, particularly index design, is what's driving most of our engagement with asset owners globally today. And that touches on the third point, the question around implementation and active versus passive. So for the first time this year, when we ask around, are you applying sustainable investment into your portfolio via active or passive, we're seeing now that a larger percentage of respondents are talking about passive implementation than active. Very nearly equal. It's about sort of about 5 percentage point difference. So there's obviously a approach that incorporates both active and passive. But if we looked at that about 2 years ago in the survey, the percentage point difference was about 30% difference towards active. So clearly a trend which is consistent with our engagement with asset owners globally as well on index design and development, that we're seeing a clear adoption and implementation into index portfolios. So with that as some context, let me transition from kind of the, that market level perspective into, kind of what are some of the motivations and drivers behind adoption. So if we could go on to the next slide in the next section, which is really going to draw from a research paper that was just published last week around the state of the global green economy. So we talk often about the transition to a low carbon economy or the global green economy. We want to sort of provide here, based on some data and research that FTSE Russell maintains, to give you a sense of how we characterize it and what are some of the characteristics of it. So first of all, what is the green economy? We want to start with sort of kind of a basic assertion, which is that the way we typically classify and talk about investments is based on a taxonomy of industry sectors, subsectors, et cetera, that was developed in the 20th century when we were reliant on a sort of fossil fuel dependent economic model and language for talking about industrial classification. And we thought the most important thing is to start with the alternative taxonomy. So this was developed in 2008 to begin with. This is the latest iteration today, our FTSE Russell Green Revenues Classification System. So it's an alternative industrial classification system for identifying the green sectors, subsectors, and microsectors in our language that make up the global green economy. And what you'll see here is that it's a pretty broad range of activities and products and services. Of course, things like renewable energy, both generation and equipment, are the most visible and often talked about. But actually, there's a much wider range of activities that we want to capture here. In total, there's 10 different sectors, all the way down to 133 microsectors. So many of you may be familiar with some of the work in the EU to define the EU taxonomy, which this work kind of predated, and we helped inform some of that work. But there is kind of now a recognition that you kind of need some ability to identify, classify, and measure exposure to green products and services. We do that through bottom-up fundamental research and analysis on a global universe of listed equities of about 19,000 companies. So all the data that I'll go through after this is drawn from that data set. And again, this work started in 2008. And this helps identify, exposure to those climate solutions. These are the companies that are helping enable that low carbon transition through the products and services that they're providing. And with this data, we can then, as we'll find out, when we talk about index design, incorporate that into equity and fixed income portfolio construction to enhance exposure to some of these climate solutions. Okay, next slide. So the global green economy is big, it's diverse, and it's growing. And the thing to sort of bear in mind is that any large universal owner, an institutional investor, will already have exposure to the global green economy through their public equity portfolio. But using that alternative taxonomy, that alternative classification structure, we're able to highlight just the green components. And there's a few things I want to draw your attention to try and characterize it with a little bit more precision. First of all, its size. So if we just look at the market capitalization of the green component of a public equity universe, so this is all global, large, mid, small cap listed companies, it's about 7.2 trillion in market capitalization. which is about, that should say 9% of all listed equities. Sorry, it says 10%. It's about 9% of all listed equities. We've highlighted on the bar chart, if you were to take that segment, that 7.2 trillion in market cap, as its own standalone sector, it would be the 4th largest sector, bigger than banks, bigger than energy. So you already have substantial exposure to this, but it's about identifying it and then, you know, rerouting your allocation to make sure that it's accentuated. It's also a diverse group of companies. So there's around 3,500 listed companies that make up that global green economy that I just sort of talked about, that 7.2 trillion in market cap. So that's across all size segments, large, mid, and small, and all geographies, developed and emerging. So that means when I talked about, we research around 19,000 companies globally to try and build up this database. What we find is that most of them don't have any what we would call green revenue, any revenue from green products or services as described in that taxonomy we just looked at. There's really only about 3,500 listed companies that have any non-zero revenue, and I do mean any non-zero revenue, so there's no minimum sort of qualification for the data set here. But those 3,500 listed companies, you know, come from a wide range of sectors. And about 1/3 of the traditional sectors have about 10% or more of their revenue coming from green products and services. So, you know, this is a diverse group of companies. And when we talk about growth, so I'll pick up on a theme that Peter touched on around sort of investment and growth, and sort of, you know, when we look ahead, the green economy is growing faster than the market at large. So if we take a 10-year compound annual growth rate of just the green market cap, it's growing 5% faster than the global equity market. When we look at just the revenue, the green revenue segment of this global equity universe, again, 10-year CAGR, it's over 2% faster growth than the global equity market. So it's growing faster. And if we go to the next slide, the need for continued investment, which Peter touched on, looking at some of the investment in 2023, if we sort of forecast that out, and if you take this chart is sort of based on analysis from a number of different sources, including the IEA and International Renewable Energy Association and others, to sort of forecast out temperature scenarios. What we see is that the global green economy needs to double in size even further by the end of this decade to help keep us on track for 1.5 degrees Celsius global average temperature increase. So that increased investment that we've seen in the recent past needs to continue, and in fact even grow, which, you know, sort of helps emphasize the case around investment opportunities here. On to the next slide, and then I'll be concluding. So when we think about performance, we can use this data to benchmark how the global green economy has been performing. And the first chart on the top is a benchmark of an index, FTSE Russell, first launched in 2008. It's called the Environmental Opportunities All Share. Let's take this as a proxy for the global green economy. These are essentially any listed company with 20% or more revenue from green. So again, back to that taxonomy that we started with. This index launched in 2008. Since its inception date, it's outperformed global equity markets by 82%. Most interestingly and recently, so since 2020, there was exceptionally strong performance in 2020, 2021. 2022 was a down year, but it sort of rebounded pretty strongly last year with 10% outperformance relative to the benchmark in 2023. Again, if we were to take that benchmark, that Environmental Opportunities All Share Index, it's about 900 companies. So again, about 900 companies that have 20% or more revenue from green products and services. Over the last decade, it would have been the second best performing sector globally, just behind tech. And that performance that we've seen, sort of at the aggregate level, we try to sort of break down a little bit into sectors and themes in the bottom chart. And here we're looking at some of the subcomponents. So what stands out is that energy efficiency in particular is driving the outperformance. and the need for increasingly efficient energy management. So again, even though renewable energy is the most visible and often talked about component of the global green economy, the performance there has not been as strong. And what has been driving the outperformance has been the energy efficiency sector. Geographically, as is highlighted in the bottom, the U.S. is the largest component of the global green economy by size and market cap, and it's also been the strongest performing in 2023, so helping drive that outperformance. And when we do a little bit of attribution analysis, which isn't highlighted here, and we look at something called, kind of what's driving, behind some of this outperformance, it is the selection effect, as we would characterize it, i.e. the companies that are being, that pass the criteria for the index, that 20% revenue threshold or more, is more impactful and more influential on the outperformance than just the industrial composition that makes up the benchmark. So a lot of interesting trends there that are helping inform kind of the motivation for the investment case, particularly around climate solutions. But as we sort of pivot into the last section, I'm going to hand over to Carolyn here. We want to set that in the context of a broader conversation around climate transition indexes and the building blocks of which green revenues is a crucial component, but only one component to climate transition index design. So thank you for that. I'm going to hand over to Carolyn.
Thanks, Tony, and thanks again for having us this morning. So if we flip to the next slide in the next section, I'll give a bit of history and context, and then walk you through FTSE Russell's Climate Transition Index framework and building blocks. So here we're illustrating a bit of the evolution of climate indexes. So as you can see, as climate investing more broadly has evolved, climate indexes have increasingly incorporated more sophisticated data inputs and methodologies. So on the far left, you see sort of the first generation of climate indexes. And these FTSE Russell developed over 10 years ago, and these really sought to manage climate risks associated with the highest carbon companies by reducing exposure to these companies. The next generation, if you will, of climate indexes sought to manage these the climate risks as well as capture the opportunity piece. So what Tony talked about, so capture that exposure to the green economy, and we did this through exposure to our green revenues data set. And most recently, and sort of most salient to this discussion today, is this sort of climate transition approach, where we're looking at both historical climate data and incorporating some forward-looking data on top of that. And this forward-looking data seeks to assess where companies are going, particularly as companies announce their net zero targets and climate transition plans. This data seeks to capture that. These data sets are supported by TPI, or the Transition Pathway Initiative. I'll get into more detail on that data, and applied in a flexible index framework that FTSE Russell has developed, which I'll also get into more detail on. But just wanted to set the context here, where we were 10, 15 years ago and where we are today. So if we go to the next slide, I'll spend a few minutes just giving you a bit of context and background on the Transition Pathway Initiative, or the TPI. It was founded in 2017 by two UK asset owners. Today, over 150 asset owners and asset managers representing over 60 trillion in assets support the initiative. It's a global initiative, so it's not sort of European-centric, it is truly global. And it sets out to solve a particular challenge in climate investing. So it sets out to answer the question that investors have: how do we objectively assess a company's preparedness to transition to a lower carbon economy. All companies are setting different targets. They're within, different sectors. They have different regulatory regimes and requirements. Basically, it's asking the question, how do we know if a company is in line where it's supposed to be? And a few sort of key aspects to highlight of the TPI data and what it seeks to do. So essentially, it's an assessment of how the largest companies in the highest emitting sectors are transitioning to the lower carbon economy. How are they meeting their decarbonization requirements? It's really a top-down assessment. So where's a company in relation to those decarbonization requirements, the Paris Agreement, different temperature scenarios, et cetera, coupled with a bottoms-up assessment of a company's management and governance of its emissions and its emissions risk associated with that transition to a lower carbon economy. The TPI is housed in the Grantham Research Institute as part of the London Stock Exchange. London School of Economics. I say London Stock Exchange so often, that's our parent company, but thank you. London School of Economics. So they're managing the sort of data model and research. TPI supports global climate investing initiatives related to areas like disclosure and engagement. So in particular, it supports the TCFD recommendations on climate disclosure. TPI is also the data partner for the Climate Action 100+, which focuses on engagement with the 100+ highest emitting companies globally. FTSE Russell has been a partner and supporter of TPI since its inception, and our partnership allows us this unique ability to use their data in our index design and construction, which I'll go through right now. So if we go to the next slide, I'll touch on this framework. So when developing our climate transition index framework, we had a few key objectives. We understood that investors were looking for how indexes could support the low carbon transition. And we wanted to design an index that delivered clear, measurable climate outcomes. So not just sort of inputs, but actual measurable outcomes. And importantly, we wanted to develop an index methodology that was clear and transparent and could support engagement activities outside the index around sort of that TPI assessment. So that engagement piece was critical. To achieve this, we landed on 5 key climate data points: green revenues, fossil fuel reserves, emissions, and 2 TPI data points: management quality and carbon performance. I'll get into these a bit more on the following slide. But importantly, we developed a flexible framework which allowed us to target very specific climate outcomes alongside investment outcomes. So within this framework, we're able to incorporate these climate metrics alongside risk management metrics and other sort of non-climate portfolio construction parameters, again, which I'll get into a bit more detail. So if we go to the next slide, I want to talk about the index framework and index design, but maybe before I do that, I want to set the context for how these indexes are being used, sort of where they fit into asset allocation models, sort of how we're working with the largest asset owners on these. So I've used the word transition to talk a lot about the climate transition and the transition to a lower carbon economy, but I'll use it in a different context now, which is a lot of the work we're doing with asset owners is to help them transition assets from a core passive market cap weighted equity portfolio into a passive climate index strategy. And the way we're doing this is by designing this index framework to achieve very specific climate outcomes. So the client's sort of desired climate outcomes alongside their investment outcomes. And we're able to do this through a flexible framework where we can sort of put different sort of risk management measures, portfolio construction parameters on top of these objectives. So I'll go through briefly sort of how we do this. And again, this is a very sort of customizable, flexible framework. Essentially, we start with the market cap weight of a company across a global or sort of specified equity benchmark. And from that market cap weight starting point, we can over or underweight companies based on their climate characteristics and their scores in these 5 metrics. So notably, Tony talked quite a bit about the green revenues data set. That's a primary sort of critical climate input into companies. We can overweight companies based on their exposure to the green economy. Fossil fuel reserves data evaluates a company's exposure to potentially, fossil fuel assets, stranded assets. Carbon emissions data looks at scopes 1 and 2 operational carbon emissions. We take that market cap weight starting point and over and underweight companies based on carbon emissions. And then lastly, we incorporate that forward-looking TPI data. So the management quality data, which specifically looks at how a company is sort of managing and governing its risk associated with carbon emissions. So if you think, it asks questions like, does a company regularly report emissions? Does a company set targets? Is climate a strategic priority in the C-suite? That's sort of what the management quality seeks to measure. It's a bottoms-up assessment, whereas then the last data point, the carbon performance data, is more top-down assessment. Is a company in line? It's sort of where it should be in terms of its decarbonization trajectory. So those are the 5 key sort of climate inputs. We can apply these, we can apply targets alongside non-climate related parameters, including, importantly, things like fundamental factor exposures, as well as other constraints. So, stock active weights, industry and country constraints, turnover constraints, et cetera, to achieve those climate outcomes alongside the investment outcomes. So what we achieve at the end of the day, or sort of the outcome, is this non-market cap weighted passive solution where, again, clients can achieve the outcomes and exposures that they want. If we go to the next slide, I do want to talk about adoption and sort of the use case amongst your peers primarily. So we launched our first sort of TPI index specifically in 2020 with the Church of England, which itself was one of the co-founders of the TPI. Though our work in climate transition indexes goes back to 2015. Today, we have over 70 billion in assets under management tracking a FTSE Russell Climate Transition Index. And the adoption amongst asset owners has been global. So again, back to that sort of idea of asset owners, most of the adoption has come from this idea of them transitioning assets from a core passive market cap weighted equity allocation into this climate transition aligned approach, which is a non-market cap weighted solution which allows them to achieve different sort of climate and non-climate outcomes. So if you go back to that sort of idea of the evolution of climate indexes, Tony mentioned our Environmental Opportunities Index. We launched in 2008. That looked at just sort of green sectors as one slice of the sort of bigger picture. Then we launched indexes that just looked at sort of exposure to carbon emissions. And today we're, like I said, managing over 70 billion in assets tracking these climate transition indexes and incorporating that sort of forward-looking data that TPI allows us to as part of that. So I hope that gives you a sense of the framework and our building blocks. I do want to turn it over to Samiso, who's going to talk in a bit more detail about the specific custom climate index we developed with CalPERS.
Thank you, Caroline. Good morning, members of the Investment Committee, Samiso Nzima, CalPERS staff. Let me start by adding my voice to the choir that is welcoming Stephen Gilmore to the CalPERS family.
Samiso, I think you have a mic over here that might pick you up better.
Is this better now?
Yeah.
Okay. So I was saying, I'll add my voice to the choir welcoming Stephen Gilmore to the CalPERS family, as well as congratulating Jinsu on her retirement. Secondly, let me thank my fellow panelists here, Nelson, Caroline, and Tony, for providing the background on the different approaches of constructing climate-aware indices and explaining the building blocks that underpin the CalPERS with the Climate Transition Index. I'll speak to the investment thesis, which supports the case for climate-aware investing, and will also highlight some of the differentiating features of our custom index. If we can move the slides, please. One more. Yeah, one more. Thank you. So the investment thesis behind our custom CTI. So from now on, I will refer to the CalPERS FTSE Climate Transition Index as CTI, is that companies that are better prepared for the transition to a low carbon economy, or those who enable the transition, will be better placed to outperform laggards in a world in which there is significant increase in the price of global average price of carbon. The investment goal of our climate strategy is to position the CalPERS portfolio to take advantage of the opportunities and mitigate against the risks resulting from the transition in pursuit of better financial performance for the portfolio. It is clear to us and to a lot of other investors that climate change will have significant investment implications for the global economy and hence for investment outcomes. CTI is built to evaluate both risks and opportunities of climate transition, distinguishing between sector leaders and laggards, including in the energy sector. CTI does not seek to exclude entire sectors of the economy, but rather focuses on relative transition preparedness of companies within each sector. Any company exclusions from CTI are for non-alignment with the goals of the Paris Agreement and are not permanent. Rather, they depend on carbon performance. I think the FTSE team spent a lot of time talking about some of the indicators, some of the building blocks around transition index, and carbon performance is one of those that we're looking at. The goal of CTI is really to systematically overweight companies that are well positioned to succeed in a low carbon economy and underweight companies that are poorly positioned, all within the context of market pricing and valuation. Because price and valuation matter, CTI integrates climate and traditional financial metrics to differentiate among stocks, which ensures that climate resilience is achieved without compromising on fundamental portfolio performance. By integrating traditional financial metrics with a proven track record of value creation, CTI's portfolio construction ensures that climate-related characteristics are achieved without compromising future performance. The integration of climate metrics and investment valuation factors is a crucial consideration for us as fiduciaries. staff believes that the CTI's climate integration approach is a better way to invest than the first generation low carbon indices, which focus solely on reducing portfolio emissions. I think both Tony and Carolyn, spoke about the evolution of climate-aware investing and where we are now with the integration approach. We think that is a better way of really positioning the portfolio, not only to achieve the climate characteristics, but also to achieve the investment returns that we're focused on. As shown on the slide, really, CalPERS has made an initial allocation of 5 billion, which is 1% of the total plan, into CTI. And staff will continue to monitor the performance to make sure that it lines up with the investment thesis. And then this will also be considered as part of the next asset liability management in 2025. That concludes my prepared remarks. We'll now open up for questions from the board.
So I want to thank everybody for the presentation. It was amazing. We've got a lot of meat here on the bones, so I'm wondering if my board has questions. Anybody? Okay, well, I'll start. So I wanted to know a couple of things that I saw way back in the beginning, so hold on. Let me get back there. I think this is page 8 of the slideshow, huh? Okay, good. So I have that right there, and in several different places it says clean fossil fuels. Could you please explain what clean fossil fuels are?
Sure. So I'm squinting to see the few different places it pops up. But first of all, to say the taxonomy is both a little bit aspirational of technologies that are in existence, but not really very common. So there aren't really many companies that fit into that category. This might be things like carbon capture, for
Which
example.
we haven't gotten down yet,
Yeah,
right?
yeah,
Okay.
Yeah. So actually, when you sort of look at this, and this speaks a little bit to the evolution. I mentioned when the first iteration of the taxonomy was created in 2008. It had, I think, only 4 sectors, and then sort of a next level down. So it's expanded and it's deepened over that time. We have an external advisory committee that is made up of asset owners and asset managers that help inform both the sort of definitions for what sectors to sort of include, and also, what things to add as new technologies and products and services come online. But that doesn't mean that this is a static thing, or that it's evenly populated by companies that we see in the market and research. So that's an example of one where there, isn't a lot of activity there. It's not a big component of the analysis or figures that I shared.
Okay. So, and then what we're looking for Samisa's part, when you were talking to me, so you talked about the climate transaction index, which I had not heard before. I guess I want to know, how does that fit in with adaptation and transition finance, and if for our particular fund that we are investing in? Or maybe that's a Peter question. I don't know.
Yeah, I think, thank you for the question, and if I understood it well, so the climate transition index really were supporting or investing in companies that, leaning towards climate solutions. And those climate solutions will include adaptation and mitigation and so forth. It's not really a direct investment like in private equity, for example. In private markets, we're actually, giving the money directly to the company. We're actually investing in those listed securities that are involved in, mitigation and adaptation and so forth.
So traditional, it says here, integrates both climate and traditional financial metrics. We're using climate science, is that what we're using?
We are using the traditional climate metrics, for example, some of the green revenue classification that Woods is looking at, some of the TPI carbon performance,
Okay,
and things like the carbon exposure, so the carbon intensity of the companies, the fossil fuel reserve, is that's the part of the climate metrics. But then we're also overlaying that with the traditional financial or investment valuation metrics, so that at least we control for some of the unintended exposures and the performance. We don't sort of compromise the performance of the index relative to the traditional cap-weighted index, for example.
okay. And then I had a question. I think this was on Carolyn's presentation. I'm not remembering. So Transition Pathway Initiative, there's a whole bunch of organizations out there. So I had never heard of this one before. But you also mentioned Climate Action 100 Plus. Their series, I mean, are you all working in sort of a concert or using each other to bounce ideas off of?
Yeah, why don't I start, and Tony, feel free to add. You're absolutely right. There are a lot of organizations out there, specifically to the ones you mentioned. So TPI is the data partner for Climate Action 100 Plus. So the purpose of Climate Action 100 Plus is really to support the engagement activities around sort of some of the highest emitting companies globally. So the 100 Plus represents the 100 most carbon intensive companies globally. And it's a group of asset owners and who have gotten together to sort of collectively work on this engagement. When I say TPI is the data partner, it provides that it's sort of reported and modeled data to support those engagement activities around those assessments. So asset owners can use those TPI assessments as part of their engagement strategies. And as I said, FTSE's been a partner with TPI, supplying things like emissions and climate data to them as well. So that's sort of part of that ecosystem, but obviously it's a much broader collection of organizations. I don't know, Tony, if you want to add.
Just very briefly, one thing we're seeing there is, there's a desire for consistency across engagement and portfolio decisions and allocations. So if it's the same data, the same measurement that features into engagement conversations, for example, through Climate Action 100 Plus, and that same data is also driving, in this case, the weighting for the Climate Transition Index. It's a more direct and honestly transparent conversation with the company around, if you improve disclosure XYZ, your weight in the index will consequentially go up, which means our allocation in you will go up.
Okay, so you kind of said this is kind of a universal use of the data, right? So it's not, one of our problems has been everybody has different data, right? So that's what I'm hoping this is more universal then.
So I think the way to think about it is, like, yes, it's a universal, in that sense, sort of scorecard, sort of framework for measurement. Now, how that score gets applied into something like an index construction, in our experience, does vary, and it's highly customizable, right?
Okay.
Sort of, same ingredients, different recipe kind of thing, right? And we're seeing different asset owners in particular want to take that same data, those same inputs and scores, common framework aligned around disclosure standards like TCFD, the sort of, emerging global standard for climate accounting. But how that gets applied into the index and weighting schemes, may vary depending on preferences, within those asset owners.
So that's where it's a little different. Okay. That was most
If I
of my
may just
questions.
add for
Go ahead,
benefit
Sunisa.
again, having sat on the Climate Action 100 Plus steering committee, I can tell you TPI, CalPERS has been involved with TPI going back, I think, to 2017, 2018. So, and they are part of the, the data is part of the benchmark for the Climate Action 100 Plus. So we are quite familiar from a CalPERS perspective, even, without the FTSE relationship.
Thank you. Yeah, she kind of whispered that to me a minute ago. So I appreciate it. Yeah, I did not know that. So thank you very much.
Thank you. Thank you very much. I'm not quite sure who to direct my questions to. First, I'll just start with you, Peter. In your presentation, your initiatives, they straddle all asset classes. And I would like to know which asset classes that you've had more success with. And like to also know which ones you've had challenges with.
So the ones where we've seen the most opportunities to date and the most tangible in terms of climate solutions, there are three. The first is infrastructure, the second is private equity, and the third is public equity. And perhaps it's not surprising when we look at the green revenues that FTSE has presented. A lot of those are related to infrastructure, supporting industries that will promote the transition, and that's where private equity comes in, whether it's software solutions, ancillary industries that are supporting new renewable installations. And in new technologies, private equity can play a critical role because it comes in not just at the growth stage, but at the earlier venture stage. So it can be an enabler of creating these new technologies. So for private markets, those are the two key. As we've just seen in public markets, the opportunity set is actually much broader, covering wide parts of the economy. So that's why our first starting point has been to take an index approach and invest in a similar fashion to really our cap-weighted index, but to lean into climate solutions and lean away from high emitters without a plan. In a second stage for public equities, we're going to look at active strategies where we identify managers who are running targeted strategies that may have 50 or 100 stocks in them that are really geared towards pure climate solutions. The areas that we see asset classes that are still evolving is really on the debt side. So fixed income and private debt. So the good news is, though, I see enormous growth opportunity, particularly in private debt, because there's so much additional investment needed in transition. As we saw, it was 1.7 trillion in 2023, and this is growing very steeply. For investors to generate higher returns, they need leverage, and leverage is debt. So as you have equity coming in, particularly in the private equity or infrastructure space, you need to kind of complete the financial plan and have that extra return leverage. You need the debt component. So even over this past month, we've had 3 or 4 discussions with large asset managers who are actually already on our roster about interesting private debt investment opportunities. So, but we do see it kind of all across. And maybe just lastly, I'll say real estate, given that practically all new buildings today that are constructed are green buildings and achieving typically a high level of energy efficiency. That's a very, I think, ripe area for further growth.
I have another question about Climate Action 100. So many of the firms have begun to abandon Climate Action 100. We at CalPERS have just ascended back to the chair. And I'm just wanting to know, how does this impact CalPERS initiatives, and what does it say as we think about how we proceed with Climate Action 100?
Well, first off, I think it's excellent and great that Michael Cohen has stepped into appointed as chair of the steering committee, and I think that's very fitting given our historical role in establishing Climate Action 100. So, frankly, we were disappointed to lose those members of Climate Action 100. We did engage and reach out to all of them to convey, essentially this disappointment. And we've also been very active in reaching out to other large U.S. asset managers who are members to essentially encourage them to stay.
I have a quick question just to follow up on that. Did you invite them to come back? When you said, when you expressed your sadness that they left?
Well, fundamentally, we need to understand, like, hey, why did you leave?
Right.
And, and this is one of the pieces of work that Michael and the team will do, is to make sure that it's actually fulfilling the needs of the large asset owners, because when they joined 5 or 6 years ago, they had very small engagement stewardship teams. And now they've understood the importance of this, particularly as it relates to climate, and they've actually assembled very large teams themselves. So in this second stage for Climate Action 100, we really need to assess how are we also adding value to the large asset managers, because it's no longer just giving access to an ExxonMobil or a high emitter, because now they have that themselves, and they have very skilled, qualified teams that can do it. So what additional services and benefits can CA100 offer to the large asset managers to really still make it advantageous and beneficial for them? Because like with any group association, there are, costs and requirements for being members.
So the succinct answer to your question, Ms. Cohen, is yes. We have asked that they keep an open mind for coming back in the future, because we do think it's important that Climate Action 100 Plus has both asset managers and asset owners. They're different, but there is a symbiotic relationship there, and it's important that we have those voices around the Climate Action 100 Plus. And I agree with Peter, having Michael chair that is the idea of trying to get Climate Action 100 Plus to a place where it adds value to both the management community and the owner community, so that they will come back.
What was the response when you said? I mean,
I think it was an open-mindedness. It wasn't right now. I mean, the reason that they didn't re-up, those reasons persist.
Right.
But an open-mindedness to us correcting those reasons and making it a value-added opportunity.
I think if I may add to that, I think it's instructive when you look at the managers that they've left, that they're not saying that climate change is not real. I think there's a difference. They may just withdrew from Climate Action 100, which, again, there may be other issues, and to Dan's points and Peter's points, their reasons, they have their reasons for that. But at the end of the day, I think no one is saying that climate change is not, an investment issue. I think that is instructive for everyone really to realize that, the managers that may have, withdrawn, they still view climate change as an investment risk, and that is all we're doing as well.
So you're cautioning me not to read too deeply into it? Okay. So how do we convince those that believe that a complete divestment from fossil fuel is the right answer to achieving our climate goals and also meeting our fiduciary responsibility?
So we definitely believe that divestment, whole-scale divestment is not the right idea, not a proper solution. And our approach, we really believe that our approach is better on several levels. So first, engagement is the starting point. And then over time, if we view that engagement is not working and the companies are continuing down a high emitting path with no assessment of other opportunities, at some point that presents an investment financial risk because of the embedded transition risk that we have in the economy. So we believe that that's on the first a better approach. Second, for better or worse, fossil fuels are going to be with us for a long time. And we discussed that last year here at the offsite, that even out to 2050, there will be some component of fossil fuels. So we want to support companies that are transitioning, energy companies. However, there will still be investment opportunities and good risk-adjusted returns from this industry.
Perhaps I think one word that you might have quoted several times in this presentation when we spoke about the CTI, the Climate Transition Index, is selectivity. And we think that as investors, constraints tend to be detractive, first as a broader concept. But as we actually approach investments, we want to be selective. And so the first phase, a while ago, maybe we were facing climate non-aware investing, where all we're looking at is financials. And perhaps those that actually want divesting are really calling on that, is let's look at the full picture. Let's look at natural capital together. And how is this really transforming assets into earnings long-term for generations? Then there's the other side of just doing emissions reduction and not looking at fundamentals. Well, is this really the right thing for fiduciaries? We think it's not. The integrated approach that we currently are incorporating in our investment practices in publics and privates is really having this whole picture, is financials and natural capital and so on and so on. And so together we are being selective, and by being selective, we'll be differentiating between the good actors and the poor actors. And we think that the portfolio will be optimal for us as return generators, but also for the overall, ecosystem, and real world.
Maybe I'll just add, sorry, one last thing. The equity markets are dynamic, and that's one of the other problems with divestment, is that it doesn't really account for the change in companies. And companies, Sumiso alluded to this, companies change. And that was one of the reasons for this index. And, Sumiso and Peter and Nelson have heard this entirely too much from me. Because my challenge to the team was like, look, I think public equity markets do a pretty good job. They're pretty efficient in the short term in terms of pricing risks. 3 months, 6 months, maybe out to a year. But in the longer dated risks, I think public equity markets do a very poor job of pricing those risks. And therefore, there should be some mispriced optionality. That optionality meaning leaning into opportunities that Peter alluded to, and then also leaning away from, say, overpriced risks. And that's the idea of this benchmark, is even cap weighted.
Can I interrupt? I just got a note. Everybody needs to lean. I know these are way back far from us, our mics, but if you can lean forward a little bit or pull the mic to you. Folks in the back can't hear us. Sumiso, you're probably a very quiet voiced person anyway, so you got to pull that mic. And Dan, you sort of are. I don't know if it's because the mic is so far away. You're not normally a quiet guy.
I would say I've never been told I have a quiet voice, but thank you. So going back to just the part of the index is about, number one, and Nelson alluded to it, alpha is hard. So we're humble about whether we have a better mousetrap here, but we're very optimistic about it just because of the fact that also the cap weighted benchmark is not mean variance efficient, either empirically or theoretically. We think that this is a better way to harvest the equity risk premium, and one that over long horizons will outperform the rest of our equity investing. And again, that has to do with the mispricing of those long dated risks.
So our next speaker is.
Thank you, Madam President, and thank you for everyone's presentation. This has been outstanding. A couple of different questions. I'd like to focus first on pages 10 and 11. And on page 10, you're articulating a growth cycle that is pretty robust over the course of the next 5 years or so, getting us to over 20%. Being in green energy, but then a growth rate over the next 20 years that only adds another approximately 5%. Is that what you are expecting we need to do in terms of addressing climate risk, or what you're expecting the market to do in terms of rate of growth?
Yeah, I'll comment here, as this came from a FTSE report that was published a couple of years ago. We're not projecting this as to what will happen. This is what would be required to happen to stay within those boundaries of, in the top case, 1.5 degrees average temperature rise, and in the bottom case, alignment with the nationally determined contributions pathway. Now that is, those bands are taken from at least three different sets of analysis, and sort of triangulated amongst those from the IEA, the IRENA, and the NGFS, so the central bank network for greening the financial system. So it's not so much a projection of what will happen. It is about what would be required to meet some of the demands around global average temperature rises.
So I really appreciate that, but that's a pretty important distinction as we are as aggressively moving forward with an investment strategy of this nature. Am I correct?
Well, I think it's in some ways pretty optimistic. Yes, if we're saying the growth of the global green economy, as we've sort of talked about and measured, has been significant since the Paris Agreement was signed in 2015. But actually, that growth would need to accelerate by the end of this decade to stay in line with these trajectories. So yes, it's quite ambitious.
As we look to page 11 and some of the numbers that are there, it certainly appears that within the last decade, this has been a very high-performing area to be investing in, which to the extent that that is going to continue would seem to be driving intelligent investors towards this area. But what is your assessment as to what the next decade is going to look like in terms of the pace of the performance of returns in the green economy?
Perhaps I can take it. And there's no crystal ball here, power here, but when I spoke, I made that analogy or that analog with the tech or the digitization on purpose there. And if we learn from that cycle and perhaps other cycles, what we have seen is we can recall events, bankruptcies of those laying down cables to actually set up the digitization, and then a pickup in profitability over time, and trillions of dollars today in some companies that are actually driving the economy. So short answer to your question is that some companies will not survive, others will become leaders, but the profitability of this overall theme should be increasing as the fixed costs will be absorbed and the leverage will be there.
So thank you for that, and I appreciate it. And the reason I'm asking the questions is I'm certainly not one of them, but there are many who believe that what we are doing here is socially and politically driven as opposed to being a set of investment decisions that we have made. And I think it was Peter that said it, but to whoever compared this to tech, the immediate thought I had was, what was this room like in the early 1970s when the question was coming up as to whether or not we should invest in Microsoft or Apple or any of the other organizations that were starting out in this industry. So I applaud what we are doing to address climate change, but we've got to be able, at the same time, be able to demonstrate that this is, in fact, us moving into an industry that is going to be the next great growth cycle in terms of returns. And your ability to report back and predict it ahead as to how we are progressing, I think is really important. Dan, at the end, said we're making what we think is the right investment decisions. But if I heard correctly, we're not sure if that's going to be a reward we're going to see in the short term or in the long term. And I can appreciate some of the difficulty with making those decisions today as to when we're going to see it. But we're going to need to be able to follow how soon it is that we are predicting when are these returns going to come to us.
So
And
thank
excuse
you.
me for that comment.
Thank you, Ms. Middleton. So I want to move us along because we're going to run behind in a second. So I just want to say, whoever it was, I think it was Peter, saying that we were second only to tech right now in terms of growth of investments. So, and I think that's amazing. So, but I also think that it is important that we're getting the reports so that we can see that the return on investment is actually happening, right? And that we're not greenwashing, that we're not, finance greenwashing the whole bit. We're putting the money in a different area that really isn't green technology. We need those kind of report back to us to make sure, just to see that we're doing the things that we should be doing, but also that we strongly believe and that we need to get this done, because I don't believe the market's pricing this in right now, and that's why we need to do this, and it's so important. So I'm going to call on Mr. Pacheco. Go ahead.
Yes, thank you, President Taylor. And thank you very much. Can you all hear me? Oh, excellent. So, Peter, thank you for your presentation, and thank you, everybody, for all your presentations. I want to go back to the SI 2030 strategy board with the investments to date. You mentioned there were 9 that you've done. 7 of them are co-investments, and the other 2 are the other mechanisms. And, you know, of those, I noticed that one of them is lithium-ion producers. And from what I've read in the papers and so forth, lithium seems to have prevalence in child labor and so forth. And I want to make sure that as we, you know, engage in these kinds of lithium-ion producers, wherever they are around the world, that we make sure that they abide by our CalPERS principles. So I wanted to know what mechanisms that we have in place now that we will make sure that our CalPERS, their principles are upheld, and especially the one associated with child labor. So if you can elaborate on that, thank you.
Certainly. So it was in this past year, as you know, we've developed and adopted the labor principles. Managers have now received them. They've attested to those. So our first approach will be to have the manager, 1, fully aware of our labor principles, and 2, be implementing that in their investment diligence and investment cycle process. Secondly, as we co-invest, that will also be a trigger point for us to review as part of our review of that company that is, they also have been following labor principles via the manager. Because as you said, there are definitely high-risk sectors.
Yes.
When we make investments, we also will use the SASB materiality map and have our managers, you know, being aware of that, because that will also help identify these higher risk sectors like lithium and exposure to child labor.
So we're just starting that now, that whole process.
It's definitely it's been implemented. Labor principles are now being implemented, and ESG integration has been taking place for some time, and we have that driven by you know, the current investment teams, and we are in addition hiring staff that will be leading ESG integration. ILPA is the main tool we use today to assess the manager's ESG practices.
And the only follow-up question, you're talking about staff and so forth, and you mentioned that in your presentations you were in the process of hiring about 10 SI staff. Are you utilizing the rapid recruitment process at CalPERS to try to get those individuals?
The short answer is no. That process started prior to our being ready with our duty statements and having all of our approvals. And that's typically used for investment officer level.
Oh, I see.
Fortunately, the investment officer recruitment is well underway and proceeding well. In fact, Nelson is leading that. And I believe we're taking on 4 of the 10 will be investment officer level.
Okay. Thank you so much. Thank you, President Taylor.
All right. So next is David Miller.
Thank you, President Taylor. Yeah, thank you all for this presentation. I'll try to keep this brief, which is sometimes challenging for me. But I'm so encouraged by, again, CalPERS leadership and this partnership moving forward to be able to really start looking at what we can do to identify where are these differentiating factors and how we can approach this in a more practical and sophisticated way that also is clearly looking at it from an investment standpoint and really fits with our fiduciary responsibilities. The one thing that does strike me is that I'm really looking forward to over the longer term is in recognizing that the economy is incredibly complex, global creature, and our environment, our ecosystem, our biosphere, whatever you want to call it, is also even more complex, and that this critical focus on the carbon economy and on climate is just one part of the environment writ large. And that we also will be able to ultimately find other differentiators that relate to both environment and indirectly or even quite directly climate, but also the other factors related to sustainability and governance. You know, as Director Pacheco mentioned, you know, if we find technologies that help with one aspect, that they don't also hurt on other aspects of risk related to business practices, labor practices, environmental practices, as we move into technologies that may produce less, you know, just outright reportable carbon emissions in a obviously reportable way, but may result in much more drastically toxic or greenhouse effect that aren't necessarily found in those one-dimensional kind of measures focused very single-mindedly on carbon emissions that are easy or relatively easy to get to right now. But over time, we may find we can really hone in on some other differentiators within those more differentiated segments and sub-segments to continue to be able to, you know, play the smart game from a fiduciary standpoint and be able to really start honing in on, you know, those little differences that will make a difference in long-term returns and picking the winners in these various segments where it's going to be harder and harder to differentiate as we go forward. That's that.
Thank you, Mr. Miller. Mr. Rufino, go ahead.
Thank you, Madam President, and thank you to the distinguished panel. This has been very obviously informative and interesting. I want to go back to disclosure, and it was sort of implied early on, it was the first question, the reporting on climate laws. And as you know, as we all know, I think in this room, after 2 long years, finally last March in 2024, you know, the Security Exchange Commission issued the much anticipated disclosure rule, which within an hour, literally within an hour, 10 states, 10 AGs filed to block the implementation. And last month, just to add, the Supreme Court, as you all know, ruling and ending the Chevron deference, that will scale back the ability for any federal agency, whether it's the Security Exchange Commission or others, to implement regulation on environmental matters. Now, thank God for states like our great state of California, you know, who have taken matters in its own hand and passed SB 253, you know, and of course, as we speak, New York and Illinois is considering passing some similar legislation. But the question is, how are all these activities going to impact or affect what are we doing, or if any? And I know you don't have a crystal ball and it's not directed at any particular individual, but any one of you that would like to share your insight or thoughts on this will be appreciated. Thank you.
Well, maybe I'll kick it off and just say that disclosure is critically important. Both emissions to assess climate risk, to assess a company's ability to transition from high emitter to low emitter. And as we've shown, both from a public markets and private market standpoint today, those are critical drivers, we believe, of performance. So if you don't have that disclosure, there are, of course, still estimates that you can get from FTSE, you can get from MSCI. But frankly, if it's coming from the source and it's in a standardized way, it makes everyone's life, particularly investors, much easier. So what we're doing, since we really believe in such disclosure, whether it's 253 or SEC or 261, is voicing our support to the agencies that have put this in place. In California, to the Attorney General, we prepared a letter of support because there's a lawsuit pending there as well. So yeah, we're definitely in the camp of wanting it and believing in it. So, our voice will be behind these new implementations. As you infer, there's been some really significant developments at the federal level of the Supreme Court. So we're actually working with our lobbyist firm as well to have a full understanding of what those changes are and what the implications are as an investor, just broadly, generally.
Perhaps, yeah, to add to that, and maybe to reflect on a comment that Tony Campos from FTSE mentioned, that first trend of moving from moving from the larger amount of money moving into climate indexing from active, and also we mentioned that we would approach that both as active managers, which is what we did in private, but also in public, and indexing, i.e. passive. As information becomes more and more prevalent, as the disclosure becomes more important or less, the balance between active and passive, I think, will be changing. When information is disclosed, when it's publicly available, we can manage indices better because we have more information. When the information is less available, then active management is a more, I'd say, conducive strategy to add alpha because information is only owned by a few. So I think as this evolves, the balance between active and passive will also evolve.
I was just going to add, perhaps from the perspective of a data index provider, of course, disclosure is crucial to sort of, it's the raw material that feeds into all of these inputs. And we've seen growing, familiarity and comfort with estimates as well, right, for things like carbon emissions, even things like some of our green revenue data. So that allows us to work around some of the disclosure gaps that are, yes, inherent in the data set. But also, the trajectory of disclosure has been, a positive one overall, because I think the companies, the issuers that are having to put this information are getting, consistent demands from a global group of shareholders and other stakeholders to improve their disclosure. And London Stock Exchange Group, our parent company, has been very vocal about particularly adopting the ISSB standards for climate disclosure that have recently been published. So, we're confident, certainly in the space of climate, that's where we see the best disclosure, although still room for improvement.
Thank you. Thank you, Madam President.
Thank you, Mr. Rufino. Ms. Ouellette?
Thank you. I really appreciated the presentation. I'm a big fan, and I look forward to this ongoing. So in that vein, I'm wondering, how are we making sure, we've heard from some members and stakeholders that it's really difficult to understand what CalPERS considers a climate solution, and how are we making sure that our plan participants, that our stakeholders, and other institutional investors that may want to follow CalPERS have the information they need to what are these investments? Where's the 47 billion that's already been considered allocated? What is that 47 billion? Where has it gone to? Who is it? And then for our plan participants, how can we make sure that they understand that these investments not only just benefit California, they create opportunity for us and mitigate risk, but that they're there to ensure that they can retire? Like, I'm not sure if it's a press release, a media campaign. How are we conveying information outwardly outside this room for plan participants and other stakeholders that are concerned about their ability to retire or concerned about these investments?
Thank you, Ms. Millett. So we, in terms of our climate solution definition or taxonomy, the mitigation, adaptation, transition, that's we've been very public with. And in terms of the 47 billion, we've presented it. We are also in the midst of, this information's on the website, but we're also in the midst of updating the website and in a way making it, I think, more user-friendly, better pictures, and improve the messaging tool. So that work is underway right now. We've also just begun the work in terms of more public press releases, public relations. We've been working very closely with PAOF and John Myers. We did a press release last week, 2 weeks ago, on the 10 billion. I recently, we did a video where I talk about the climate action plan. So it's, I think first we felt, one, we needed the strategy, Second, we needed to get some implementation done, and then we could talk about it. Because talking about something you haven't done, first, I think you need to have show some deliverables. But 100% take your points on board. I think we can, make sure that we're really targeting the members of CalPERS and making that linkage to them for why is climate investing, sustainable investing beneficial for them as beneficiaries.
Thank you. And then just another question, if that's okay. I know we're running tight on time. How are we going to make sure that our investments in the transition category are high integrity? And are we requiring companies to have transition strategies that apply to their whole company? I think my concern is the idea of greenwashing, and that some companies in the past have said that they are, green and part of the green economy, and in fact, we found out that they weren't. So how are we using science-based measures and other information out there to, have clean data going forward and making sure that our transition companies meet our definitions?
Thank you. So first of all, the component out of those 3 layers that we mentioned of climate solution, transition remains a pretty small one because it is difficult, because they are in fact, that said, is not large. The reason for our working with FTSE was precisely about the building blocks and the quality, the institutional quality, the rigor that we see in those. One of them, the TPI, the Transition Pathway Initiative, is that. It's really one of the 2 major benchmarks out there that are acceptable, the other one being SBTI, that really does the groundwork to actually assess the credibility of that transition. And so based on that quality input, we'll be assessing transition, at least on the public markets, and we are pretty excited about this partnership, but we'll definitely push in that direction. Credibility, transparency on information, quality research.
Thank you so much. I just want to reemphasize, I'm really excited about this work. I'm really grateful to the presentations, the work that's gone in, and the future is bright at CalPERS. Thank you.
Thank you, Ms. Willett, and I will also hop on with that and thank everybody here in terms of our partnership with FTSE. So sounds like it's really helping us. My last one is Dr. Gail Willis.
Good morning. First, I want to commend you on an excellent presentation. Looking at page 2, focusing on strategies and objectives, looking at number 4, promoting greater inclusion and representation in the financial industry and the global economy. I would like you to elaborate a little bit on those strategies. And then number 2, can you clarify or explain passive versus active investments? And how do you measure which strategy to implement at a given time?
Sure. So I'll pass the passive versus active to my public market teams. In terms of greater inclusion, I mean, one of the fundamental ways is through our emerging manager program, and we'll actually be touching on that this afternoon. And also historically on our work in stewardship, and for boards, for example, having diversity or promoting diversity amongst boards. And that's a really important area where we work very closely with Drew Ambley and his team for engaging on that. Also, I mean, more broadly, just our work on human capital management. There's definitely a diversity component in that. And yes, so I think those are the primary 3 areas.
And then the advantages and disadvantages of passive versus active. Oh, I was asking him the advantages and disadvantages of passive versus active investments. Okay.
Thank you. So first, a quick definition. Passive versus active. Passive really, and this is a simplification of terms, but passive is really systematically replicating a construct, a portfolio that has been underwritten for certain criteria that we believe translate a belief, a thesis, but passively systematic, no discretion. Rules are set and followed. That's the CTI index. Active is really about discretion, is you underwrite an active manager, a manager that will be the steward of your capital, our capital, to make decisions following a thesis and strategy, but the ability to be discretionary on a daily basis, weekly, monthly, quarterly, whatever they see fit to add value to the index. The index is our bogey, our reference point. The active needs to beat the index.
And which one is more of a risk?
So both strategies can be equally risky. I'd say the active tends to be more risky because it is typically less diversified. It is typically more concentrated. It carries more views. So the active typically will be a bit more risky than the passive.
Right.
I think just to add to that, I think the risk is the volatility, which really, in reality, if you're a long-term investor and you can withstand the volatility of that active strategy, as long as the investment thesis is sound over a long term, you'd expect that, if you're good at picking active managers, that would outperform the passive strategies. Otherwise, why would you invest in active management? So the definition of risk is really, volatility for long-term investors. If the investment thesis is sound, then we should be good.
Thank you so much.
Thank you, everybody on the board, for your insightful comments. Again, Peter, thank you for the presentation. Thank you for the partnership. I do have public comment. I don't think one applies. I don't know about the other one. So we will start with Maria Rodriguez and her translator, it looks like Daniel Garcia. And you have 6 minutes, basically, right? Okay.
Good morning, Chair, members of the board. My name is Daniel Garcia, and I'm here today with Maria Rodriguez, a former employee of Cardenas Marquez. I will be translating her testimony. Thank you.
Buenos días, señor presidente y miembros de esta junta. Mi nombre es María Rodríguez. Hablé en la reunión pasada. Mucho ha cambiado mi vida desde entonces. Cuando llamé el 10 de junio, comenté un poco sobre el trabajar en Cárdenas. Cómo tenemos nuestro horario un día de anticipación. Y lo estresante es que trabajar ahí, cuando hablé con usted, estaba de baja médica de Cárdenas porque a finales de mayo mi médico me recomendó que me ausentara del trabajo unas semanas debido al estrés laboral. El día después de hablar en CalPERS, mi horario para regresar vi mi horario para regresar al trabajo, estaba cambiado estaba cambiado el turno de la tarde. Esto fue un problema para mí porque el 2021 me fracturé el pie derecho mientras trabajaba para Cárdenas. Mi caso de compensación laboral se resolvió en el 2023, pero desarrollé artritis y el estado de California me impuso restricciones de por vida debido a mi herida por la herida y podía trabajar, no podía trabajar por las tardes porque hay que lavar el piso y el trabajo para cerrar la tienda es más pesado y tendría que usar más el pie que en el turno diurno. Durante años estuve en el horario, siempre trabajé por la mañana para adaptarme a mi discapacidad. Le mencioné a mi jefe que estaba discapacitado de por vida y que sentía que no podía soportar la situación, trabajo requerido para cerrar en el departamento en la noche. La única respuesta que recibí de ella fue: se avecinan cambios. Me sentí impotente y sentí que no tenía más remedio que dejar de trabajar. Sentí que Cárdenas me obligó a irme. Creo que tomaron represalias contra mí como empleado de Cárdenas. Durante 10 años me decepcionó cómo me trataron después de hablar de mi experiencia. Quería brindarles una actualización de mi historia porque creo que debía saber que nos tratan de, que creo que deberían de saber cómo nos trata la empresa después de hablar. Después de que hablamos. Gracias.
Gracias, Maria. Good morning, Chair, members of the board. My name is Maria Rodriguez. I spoke at your meeting just last month. A lot has changed in my life since then. When I called in on June 10th, I told you a little bit about what it's like to work at Cardenas, how we get our schedules with 1 day's notice, and how stressful it is to work there. When I spoke to you, I was on medical leave from Cardenas because in late May, my doctor recommended that I take a few weeks off from work because of workplace stress. The day after I spoke at CalPERS, I looked at my schedule to return to work and I saw that it was changed to the afternoon shifts. This was a problem for me because in 2021, I fractured my right foot while working for Cardenas. My workers' comp case was resolved in 2023, but I developed arthritis and the state of California gave me lifetime restrictions because of my injury. Because of the injury, I could not work in the afternoons because the floor has to be washed, the work to close the store is heavier, and I'll have to use my foot more than on the daytime shift. For years, I had a schedule where I always worked in the mornings to accommodate my disability. I mentioned to my manager that I was disabled for life and that I felt like I couldn't handle the work required to close the department at night. The only answer I received from her was that changes were coming. I felt helpless and I felt like I had no choice but to stop going to work. I felt like Cardenas forced me to leave. I believe they retaliated against me. As an employee of Cardenas for 10 years, I was disappointed with how I was treated after speaking about my experience. I wanted to give you an update to my story because I think you should know how the company treats us after we speak up. Thank you for your time.
Thank you very much. Our next public comment is on the phone. Are we on? Is the phone?
Yes.
Hi, okay.
Madam President, we have
Go ahead.
William Michael Cunningham. Go ahead.
I'd like to start by saying good morning to the esteemed members of the CalPERS board. My name is William Michael Cunningham. I'm an economist based in Washington, D.C., and hold an MBA in finance and a master's in economics, both from the University of Chicago. We were in the spring-fed pool for non-fiduciary investment consulting. In 2015, we created a model that detailed how environmental issues impact stock prices, quantifying the impact environmental factors have on stock prices using several statistical techniques. While the current presentation seemed to focus mainly on equity markets, I would like to suggest a fixed income market strategy that may not only complement your excellent equity market approach, but also lead to an increase in affordable housing, a critical shortage in your state. Let me note my opinion that Mr. Cassion's approach to fixed income in this area is interesting, but there may be a better way. They're integrating energy efficient mortgages or EEMs into the CalPERS investment portfolio, if you have not already. EEMs allow home buyers to finance energy efficiency improvements as part of their mortgage, leading to lower utility bills and enhanced property value, as our 2006 EEM study showed. This is especially helpful in housing markets populated by people of color, given the older housing stock typical in these areas. The age of the housing stock, by the way, leads to greater energy savings, thus leading to relatively higher home values over time. We described this approach in an April 22, 2024 article in Black Enterprise magazine titled Cost-Saving Options for Black Americans to Consider. Our analysis strongly suggests that investors in publicly traded companies must not only recognize, but quantify the impact environmental factors have on a given firm's ability to use company assets and therefore generate revenue and profits. The conclusion is straightforward. Fair, rational investment policies that consider environmental factors, like those outlined by CalPERS today, lead to higher long-term returns. Thank you very much.
Thank you very much. And with that, I'm going to recess this for a short break. We're running a little bit over time, so can we all be, it's 11:10, can we all be back at 11:25? That gives everybody 15 minutes. In your chairs, please. Thank you. At 11:25. Malia.
Okay, everybody, thank you very much. So we're going to turn our attention now to our efforts with the emerging managers, including updates on work that two partners, TBG and Grosvenor, are doing with some of the managers they have selected to fund and mentor. We're fortunate to also hear directly from two of the managers involved with their programs. So I'm going to turn everything over to Anton Orlik, and our Managing Investment Director for Private Equity, to get us started and introduce your guests.
Thank you. Michael Silva will start with some introductory comments.
Okay, everybody speak into those mics. I know you're all crowded, but people in the back can't hear.
I've got my voice with me this time, so I think
There
we're
you
going to be
go.
okay. Members of the board, hello. Michael Silva, Associate Investment Manager in Sustainable Investments. It's so nice to see all of you and be here with you today. I've been looking forward to this opportunity to make this brief presentation on emerging and diverse managers in our investment portfolio. My remarks will be short to give you more time with the subsequent presentations by our partners, TPG and GCM, who manage the TPG Next and GCM Elevate portfolios that we refer to as the Mosaic platform. Our partners are also accompanied by a manager in each of their respective portfolios to share some of their insights and experiences as active managers in this space. I'd like to cover how this program supports our mission to deliver retirement and healthcare benefits to our beneficiaries, as well as dovetails with our core values. My comments will focus on research observations about diversity in the asset management industry and how they correlate with performance for emerging and/or diverse managers. I'll share how the Sustainable Investments team is working closely with our private equity team in the management of these emerging and diverse manager programs. And lastly, Anton Orlik will provide an overview of how private equity is engaging with emerging and diverse managers in their portfolio. Our mission is to manage the investment portfolio in an efficient and sustainable manner and to generate risk-adjusted returns to pay benefits now and into the future. As such, our objectives for investing with emerging and diverse managers is to generate risk-adjusted returns by identifying managers with a strong potential for success, access unique opportunities that may otherwise be overlooked, and cultivate the next generation of investment management talent. CalPERS broadly interprets diversity to mean differences such as age, ethnicity, culture, gender, and other external factors that result in diversity of thinking. We recognize diversity as a competitive advantage. CalPERS seeks diversity of internal staff, corporate boards, and external investment managers to secure high-functioning teams that incorporate different ways of seeing and solving problems. Investing with emerging and diverse managers is also consistent with our investment beliefs. Investment belief 10 states that strong processes, teamwork, and deep resources are needed to achieve CalPERS goals and objectives. And the underlying sub-belief states that diversity of all talent at all levels is important. So it is our belief organizational cultures promoting diversity are vital to improving the performance of our organization as well as the managers we invest in. McKinsey & Company have provided some of the foundational research work as it relates to the business case on diverse executive teams and financial performance. In 2023, they published their fourth report in 8 years, and as you can see by this slide, their research suggests a strong, positive relationship between financial performance and diversity and inclusion. According to their data, the business case for gender diversity has more than doubled over the last decade. Each time they assessed the data, they found an upward trend tracking greater representation and financial outperformance. In their 2015 report, they found top quartile companies had a 15% greater likelihood of financial outperformance versus their bottom quartile peers. In 2023, that grew to 39%. Their research suggests a strong business case for ethnic diversity as well, with a 39% increased likelihood of outperformance for those in the top quartile of ethnic representation versus the bottom quartile. My next 3 slides overview research into correlation between diversity and performance. I'll touch on a few observations from studies of organizational diversity and returns generated by emerging and/or diverse managers. In particular, the latter cohort, which includes emerging and established firms. On slide 5, I highlighted the level of diverse manager underrepresentation cited in a 2021 study funded by the Knight Foundation, which stated that emerging and established diverse managers in total represent only 1.4% of the $82 trillion in AUM, in assets under management for the industry. Also, I found it interesting that the Boston Consulting Group and Cambridge and Associates research indicated that diverse managers may unlock access to differentiated deal flow for their limited partners and other investors. A 2024 report by Fairview Capital illustrates a steady increase in women and minority-owned private equity and venture capital firms. While there's still significant underrepresentation today, the participation levels have been accelerating over the past decade as the universe of diverse-owned firms have steadily increased. Based on the data in this report, the rapidly expanding opportunity set of diverse firms is substantial and represents an undercapitalized investment opportunity with a likely broad pool of investment manager talent. In this slide, I want to highlight a couple of research observations from 2 diverse manager performance studies. The National Association of Investment Companies, you may know them as NAIC, compile a biennial report to educate the broader marketplace that investing with diverse managers does not require compromising returns. The numbers illustrated on this slide represent a 2021 study that examined net returns generated by the association's member firms. In their latest report in 2023, their diverse managers continued to outperform the Burgess benchmark median return, recording a net IRR of 17.23%. The second is a broader study by an advisory firm and a subscription-based data and analytics service provider, showing strong gender performance numbers, but still with underrepresentation. I took away these key points from my read of research to better understand relative performance of diverse managers that I've shared with you so far. The research shows a correlation between diversity and outperformance, as well as the undercapitalized investment opportunity this represents for capital allocators. An important point underscored by the growing body of research work and efforts to identify differentiating characteristics or attributes for outperformance or underperformance is that we can assess them in more detail, more so now than ever before since I joined the investment office more than a decade ago. As all of these points here on this slide have been covered in recent presentations, I'm skipping over slide number 9 in the interest of keeping my remarks short so you have more time with our partners and managers in the Q&A. The Mosaic platform seeks to establish an ecosystem that helps identify emerging and diverse managers that will provide CalPERS with risk-adjusted returns. CalPERS via TPG, Next, and GCM Elevate, both designed to be commingled funds, will invest in emerging and diverse managers to create meaningful relationships with managers with a strong potential for success. GCM and TPG teams will provide operational support and guidance to firm founders across key non-investment functions to help mitigate risk, accelerate growth, and enable long-term success. Ability to invest in managers earlier and across their life cycles is a key differentiator and facilitates deeper relationships, discounted terms, and co-investment opportunities. GCM and TPG have full discretion on program parameters, admission metrics, and selection. The Sustainable Investments team helps oversee both partner relationships. Importantly, our role will also to be engaged with the underlying managers early and often and establish a meaningful relationship. We will act as a bridge between the Mosaic platform and the private equity team with the goal of continuing relationships with the highest performing managers in these portfolios. For the next slide, I want to turn it over to Anton Orlich to provide an overview of how private equity is engaging with emerging and diverse managers in the private equity portfolio.
My goal is to provide some context about the difference between Project Mosaic and the activity in the private equity portfolio with emerging managers. The essential difference is that private equity engages with managers at the point where we believe that they are already at a scale position in the market and that we can invest in a way that's prudent with our resources. Whereas Project Mosaic focuses on managers that have the potential for scale but have not yet arrived at that point. We essentially, in the non-intermediated part of the portfolio, is a way you can think about it, are targeting the best returns with managers that can receive scale capital immediately from private equity, whereas Project Mosaic is providing a foundation with firms that could have potentially reached that stage. I'll turn it back over to Michael now.
I'd like to introduce you both to our GCM and TPG Next teams, and we'll start with the TPG first.
Okay, thanks, Mike. Hi, good morning, everyone. My name is Anilu Vasquez-Ubarri, and I'm the Chief Operating Officer at TPG. But more relevant for this conversation, I'm very proudly one of the founding members of TPG Next. And I've been working on TPG Next, or what we call Next now, since I joined the firm about 6 years ago. I am today having the privilege of being in front of you with a few of my colleagues, Pamela Pavkov, who's the managing partner of TPG Next, Marcus Lawrence, who's the principal in TPG Next, and very importantly, a guest that we're very proud to present to you, Karina Williams, who's the founder of Caro Investors, and it's our most recent investment that we announced this morning. So first of all, thanks for having us here and having the opportunity to talk to you about our partnership with CalPERS. Most importantly, thanks to CalPERS for this incredible partnership. You believed in us and saw what we saw from the beginning. You were there at the beginning, and we are looking forward to having this partnership be a long-lasting one. We know that, and we believe in the investment opportunity in these managers. And as Mike referenced, these are non-concessionary investments. We are doing this because we believe that the market had missed an opportunity. And we feel that we're well positioned with our experience, which is coming from 30 years of TPG being an investor, and quite frankly, learning some lessons along the ways of what not to do, that we're hoping we can pass that along to the partners that we engage with. We're also very happy to be doing this alongside our colleagues of GCM and Grosvenor. We want people like them that believe and that are serious about this work and that are good investors, most importantly. Let me tell you a little bit about what we propose we cover today. One is that this partnership between TPG Next and CalPERS, like all good partnerships, is based on trust and on seeing in each other what we could do to move this forward. And we're very grateful for being backed by CalPERS. We take the fact that we have been entrusted with this capital very seriously. We know we're not only delivering for you, the members of the board that are here, but in fact for your true stakeholders behind all of you and the work that you're representing. So like you take your work very seriously, so do we. And we wake up every morning and go to bed at night thinking about the opportunities in this market. As Mike mentioned, there's not only a lot of research, but you only have to look at the figures to know that there is under allocation, there's also under representation. And when you put those two things together and you have a good strategy, it's the recipe that you need to have a strategy that will deliver risk-adjusted returns, which ultimately is our commitment to you. The way that we do that is by using our experience, as I said, as a GP ourselves, and combining the experience on the investing side with the firm building and the business building. And if we move to maybe 2 slides ahead, I can explain more of how we do that specifically, but my partner, Pamela, actually is going to take you through the strategy. We believe that this is what was missing in the market. That is not just about the capital, but many of us that know the difference between having a mentor early on and not can attest to the fact that it makes a huge difference. And what we can bring to the table is our investing experience, our firm building experience, and our operational experience. And also that mentorship, given the team that is involved in the strategy at TPG. If we can go to the next slide. We come at this also with an authentic belief that this industry, ourselves included, should do better when it comes to diversity. And in this instance, we see it as an opportunity, not only for us to have more diversity in the allocator seat, but quite frankly, to have better firms. And as our name suggests, what we are trying to build is the next generation of capital allocators and GP firms. And we're hoping we're going to build competitors to TPG as we do that. The other important thing is that we have seen in our portfolio companies and our firm the benefit of focusing on underrepresented groups as a talent pool, both for our firm, but also for our portfolio companies, and very importantly, for our boards. And so we are seeking to match what we have experienced ourselves with the strategy from an investing perspective. In the next slide, I want to finish my remarks by pointing to the team behind TPG Next. And this is just a representation because the whole firm actually gets involved in TPG Next. And that's probably one of the things that our culture allows for. We partner with each other, we're encouraged to collaborate, and we're encouraged to bring our talents to bear for the better of the firm and the people that we partner with. So you will see at the top is our investment committee, John Winkelried, our CEO, myself, Pamela, and 2 of our other partners who have built businesses within the firm. So the experience of building a new strategy within the complex of a bigger firm, we're trying to capitalize on that too to accelerate the growth of TPG Next. And then in the bottom, you see a representation of the type of colleagues. You see our dedicated team. Hugh and Nishna and Rosalie are not with us today, but they're hard at work, I guarantee you. And to the other side of the slide, you see a representation of the other disciplines of the firm that help with the business building. So anything from fundraising to human capital to operations. And importantly, as I said, that's all circled in with our investment teams. And I hope Karina can tell you a little bit more about that in her presentation. But I will turn it over to Pamela. And once again, thank you very much for having us today.
Thank you, Anilu, and good morning, everyone. I am Pamela Pavkov, and I'm the managing partner of TPG Next. I joined TPG in 2022 and am based in San Francisco. Thank you for your time and commitment to TPG Next. This morning, if we can go to the next slide, please, I'm pleased to provide a brief overview of our investment strategy and describe to you our capabilities and note our 2 investments to date. TPG Next's investment strategy is to seed the next generation of investment managers through investments in their funds as LPs as well as investments in their management company as co-owners of the general partner. Our LP commitments consist of anchor-sized fund commitments, and our GP investments consist of working capital to support the costs of launching a new firm. Completing our flexible solution is our capacity to co-invest, complete secondaries, and warehouse new investments with our new managers. Leveraging our 30-year history of building more than 20 business units organically at TPG, we provide newly launched managers with key business building and investment support. If we can click one slide forward, I'm now going to dive deeper in describing these value-add resources. On business building, we equip our managers with capital formation, operations, and hiring support, just as we do with any other business unit at TPG. We have dedicated teams focused on each of these initiatives, and as it fits with new firms' investment strategies, we also help next managers with their impact and enhancing their brand recognition. Perhaps the biggest challenge for new firms is simply getting known and separating themselves from the dozens of new GPs that launch each year. Part of our value to next managers is helping them sit above this fray, leveraging our presence as an established brand to accelerate their market recognition. Next slide, please. With respect to investment support, we build strategic partnerships with the managers we back to increase their deal flow and enhance their post-investment value creation capabilities. With the depth and breadth of our executive advisor networks, operating groups, and thematic approach to investing. With $224 billion in assets under management across 6 major investment platforms, our firm is investment-centric, and this matters to GPs that choose to partner with TPG Next. These GPs are excited to work with us in establishing their competitive positioning and strengthening their investment capabilities across sourcing, due diligence, deal execution, and post-investment value creation. We build bespoke partnerships with each of our next managers, leveraging the principal talent across our firm that complements their specific investment strategies. To conclude my portion of the presentation, I will provide a brief update on our investments. We are pleased to have made excellent progress with managers in due diligence. We have a growing pipeline of more than 500 partnership opportunities, have spent hundreds of hours with managers in due diligence, and have invested with 2 excellent new firms. Last fall, we entered into partnership with the Visualize Group, a New York-based manager focused on lower middle market buyouts. And today, we announced our investment in Caro Investors, a new real estate firm based in Chevy Chase, Maryland. You'll have the pleasure of hearing directly from Karina Williams shortly. I'll now turn the presentation over to my colleague, Marcus Lawrence, who will delve deeper into trends in the GP seeding and staking market, as well as introduce our newest manager partner.
Thank you, Pamela. I'm Marcus Lawrence, and I'm a principal with TPG Next. I joined the firm in 2023 and am based in New York. Next slide. We continue to be excited about TPG Next's market position as a catalyst for accelerating firm growth for the emerging manager segment. Analyzing the fundraising trends over the past decade paints a pretty clear picture of 2 key takeaways. First, on average and over time, more capital is shifting into private markets investing. Second, the share of capital committed to fundraising less than $1 billion has been halved and now represents around 20% of all capital raised. This trend poses a big challenge for emerging managers seeking to scale their businesses. This funding gap creates an important opportunity for TPG Next to invest in emerging managers and help them achieve escape velocity while also enabling TPG Next and CalPERS to access attractive partnership economics in fast-growing new GP businesses. Next slide. With more new firms launched each year, the funding gap between emerging managers and established managers continues to widen. Over the past 20 years, there has been approximately 2% increase in funds managed by underrepresented managers. Our solution seeks to bring that percentage in line with broader demographic trends. Earlier this morning, TPG and Caro Investors announced a new strategic partnership. This partnership represents TPG Next's second fund investment. Caro is a new real estate firm founded by Karina Williams, a 20-plus year real estate veteran who serves as the firm's founder and managing partner. We're thrilled to partner with Karina on many aspects of her firm launch and expansion. I'll now turn the presentation over to Karina, who will talk about Caro's investment strategy and reasons for partnering with TPG Next.
Thank you. Thank you so much, Marcus. Can you guys hear me? Thank you. Good morning. My name is Karina Williams, and I'm the founder and managing partner of Caro Investors. It is the honor of my career to be afforded the opportunity to present to the trustees of the largest U.S. public pension. Before I describe my firm and my strategy, I want to highlight a few things of note about my personal background that makes this moment really unique for me. Firstly, I started my career in the investment banking division of Goldman Sachs in the late 90s. And post-business school, I've spent my career investing largely in real estate credit and equity on behalf of large institutional pension funds. I've invested across the capital stack from common equity down to senior debt, across real estate product types, regions, market cycles, and risk criteria. In fact, the first investment closing that I worked on was called Avalon at Mission Bay Phase 2, and it was a joint venture equity investment not too far from here in the Mission Bay submarket of San Francisco, and it was in a CalPERS separate account. So today is a full circle moment for me. It is so hard to imagine that I'm sitting here 20 years later from that deal, being able to talk about an institutional asset management firm that I own indirectly as a result of your investment. So thank you. Thank you. Thank you for making me the embodiment of the American dream. My real estate inspiration is my grandfather, whose last grade that he attended was the 8th grade, didn't attend high school. But he worked tirelessly to buy real estate when he could not obtain life insurance as an African-American businessman in Cleveland in the 1940s and 50s. My life inspiration are my parents, a public school teacher in Washington, D.C., and a D.C. government lawyer, respectively, who sacrificed greatly, perhaps too greatly, for my education. The real estate asset class of all the alternative asset classes has one, if not the highest, barrier to entry for early stage firms and has long been represented by firms that could tap into multi-generational wealth in order to start those firms. While I do not have multi-generational wealth, this team here at TPG recognized that I have the investment skill set, the work ethic, the creativity, and the fiduciary mindset honed over 2 decades to join this relatively small ecosystem of players that are permitted to invest your capital. Moreover, I invest with empathy as a product of the underlying constituents. I understand the consequences of not generating the targeted risk-adjusted returns. A little bit more on me. I have 2 portable fund track records from prior firms that demonstrate my investment acumen and portfolio management skills required to do this work. But I have long wanted an opportunity to have greater ownership of my work and to lead an investment team with a set of values honed by my grandfather and my parents. I believe that humility, resilience, creativity, and critically diverse perspectives around the investment committee table can lead to higher performance, no dissimilar to what Mike just shared. So my firm, Caro Investors, is an institutional investment management firm headquartered in Maryland, and I'm in the process of seeking my full SEC registration with the support
of the TPG team prior to the first closing of my fund, which I anticipate in the fourth quarter of this year. While I've invested in both commercial real estate equity and debt throughout my career, I believe the current capital market dislocation presents an unusual opportunity to achieve equity-like returns in debt over the next 2 to 3 years, if not longer. Therefore, my firm, albeit a real estate private equity firm, will focus initially on real estate credit strategies. So Carroll's inaugural investment strategy is a tactical non-core debt strategy that will deploy capital into middle market private debt investments with underlying commercial real estate exposure in product types and markets that we believe to be more resilient, like multifamily, industrial, and investment-grade quality retail, and other defensive real estate sectors. I'm targeting an 11 to 14% net return unlevered, and in a closed-end commingled discretionary fund vehicle with a fund size target around $500 million. Investments will be in primary, secondary, and even tertiary U.S. markets, but where there's favorable supply and demand characteristics. As my mom would say, I like keep on keeping on markets, not necessarily with explosive growth, but steady growth and anchors of demand that prove to be more resilient, like education, healthcare, and government. These private debt investments will be diversified across senior, structured, and distressed debt. And each of these 3 strategies have different levels of risk. I like to keep the math really simple so that everyone understands exactly what I'm doing, because sometimes they're fancy terms, but they're not that fancy when I break it down. So senior loans, if I used an example, a real estate owner goes out and buys a $10 million retail center. I would provide the first mortgage of $6 million to that retail owner, and then that retail owner would invest the $4 million of equity on top. That has the least risk in my portfolio because it has the strongest collateral in that first mortgage position from 0 to 60%. The second strategy is what's called mezzanine debt or preferred equity. Fancy words, it's just gap financing. This is a little riskier because I'm filling in the gap between the first mortgage and the owner's equity contribution. So let's use the same retail center. The retail owner gets the $6 million loan, but not from me, let's say from a bank or life insurance company. The owner invests $2 million of equity. Caro fills in that remaining $2 million gap. That's the mezzanine debt preferred equity. The last strategy, distressed debt. This is limited to 20% of the strategy. It's the riskiest, which is why it's limited to 20%. In this very same instance with the retail center, that bank has already foreclosed on the retail center. And Caro would be purchasing the non-performing loan or the REO asset. And let's say that loan was originally $6 million. I might buy that at a discount for $4 to $5 million. So those are my 3 strategies. So the market opportunity, why? Why now? It is the best time, in my belief, that I've seen over 2 decades to be a lender, because I can achieve equity-like returns, but in debt. And I would like to think that it has to be one of the best risk-adjusted return opportunities across all asset classes today, but clearly I'm biased. But I do believe that real estate credit serves as a great key diversifier within a private credit portfolio, dominated traditionally by corporate credit risk, and even within real estate portfolios, which might be dominated by a lot of open-end core strategies. So why is it such a great time to be investing in real estate credit? I'm sure you see lots of news reports about real estate. 5-year treasuries have nearly tripled since the Fed started hiking rates in March of 2022. As rates rise, values for commercial real estate decline, particularly for real estate, which is one of the most levered alternative asset classes. We use the most leverage traditionally. So what's happening in real estate is there's what I would call a reckoning. Green Street says that nearly 20%, over 20% declines have occurred since March of 22 in commercial real estate values. And this is the first time that we've seen, frankly, in a really long expansion cycle for real estate since the great financial crisis. But why is it actually a better risk-adjusted return opportunity? Because I'm lending at reset valuations that are lower in the capital stack. versus lending at the peak valuations of real estate. Other reasons why it's interesting, there's relative scarcity of other sources of credit for real estate owners around this country. Regional banks, as you know, have pulled back precipitously. Some have pulled back altogether. Others are reducing the amount of proceeds as a result of different regulatory changes. This has a particularly acute impact on the sector of the market in which I focus, which is the middle market. So smaller transaction sizes in that $5 to $50 million range. Secondly, other sources of scarcity is the liquid credit markets. Those markets have remained more muted since than they've historically been, and that I'm referring to CMBS in that instance. Two other critical reasons why the market is interesting right now. There are $2.8 trillion in loans coming due in the next 4 years. And that means that there's going to be a gap in the cap stack of many of those loans because the values have gone down. So if you take that same $10 million retail center again, it had a $7 million loan put on it many years ago. That loan is coming due. Now it's only eligible for a $5 million loan. So there's a $2 million gap. Caro fills the gap. The last thing I would mention is just there have been some systemic shifts in the real estate industry, with the main one being potentially a move to a 3.5-day work week in the office. That has a profound impact on office valuations, which could create kind of a reshuffling of the players and a great opportunity for a new player like Caro Investors in partnership with TPG to join. So why is Caro a little bit different? I just wanted to highlight, because I know a lot of people come to talk to you time in and time out, but I wanted to just mention a couple areas. As Marcus mentioned, there is this great consolidation in our industry, where you are seeing a lot of capital go to larger firms. This creates a void in the middle market. And frankly, the capital market dislocation is most acute in the middle market, and that's what Caro is looking to fill. Secondly, I like cash flow. I prefer lending on cash flowing collateral as much as possible, which reduces risk. And I will critically look at my balance between current yield and appreciation returns. Thirdly, I'm unlevered, largely unlevered, and I prefer not to borrow money, to lend money. I prefer to avoid financially engineering of returns. I actually underwrite debt with a common equity approach, meaning I critically focus on what the valuation is of the underlying collateral. And that's particularly important when you have a time right now where the bid-ask spread on commercial real estate values has widened. I use a consultative approach to working with borrowers. I want them to win. Most of my structures are bespoke, custom. And I try to lean on a pipeline of regional middle market operators with whom I've developed relationships throughout my career. I focus on a fundamental bottoms-up approach to analysis of markets, borrower credit, the physical asset characteristics, and the business plans. And I use data on these markets and trends to make sure I'm lending on real estate where the values can go up over time versus down. And I use, lastly, a common sense approach that I learned from my grandfather, and I just put my tennis shoes on and I walk these properties, I walk markets. I talk to the constituents, the teachers, the firemen, the people that live in these markets so that I can understand the drivers of demand. So lastly, I would like to talk about my partner, TPG, and why I selected them as a partner, and I feel honored that they selected me. There were multiple options, frankly, that I was pursuing in the private equity space and the banking space. The TPG due diligence process is highly selective, methodical, and broad-ranging. I frankly would have waited additional months to have had them as a partner. I believe that TPG can and will revolutionize this industry by backing individuals and groups that have historically invested discretionary capital and are trained and equipped to receive institutional capital allocations. We sometimes define that in our industry as graduations. One of the most important takeaways I want to share with you that I hope will stay with you is that the small number of graduations that have occurred over the last 10 to 15 years has to be testimony that the industry is starving for new and different models like TPG. It wasn't financial capital, okay? They're not a fund of funds. They're not just a working capital provider. And again, I had other options. There were 4 main reasons why I selected TPG as a partner. One is their history of building best-in-class businesses. Secondly, it's their demonstrated commitment to providing the value-added services, where frankly, they have committed a broad range of people, resources, access, and time to every functional area of their firm to assist me with every functional area of my firm. Also, the program support and engagement starts at the top of the firm, as evidenced by the COO who's sitting here today. And I've personally engaged multiple times with the CEO and the COO of TPG. Most importantly in these programs is there has to be an unrelenting focus on the manager's success. And it's about the people. It's about Analu, Pamela, and Marcus. Marcus, who I speak to multiple times a day, nights, and weekends. It's unparalleled. It's their time and their attention. There also has to be thoughtful economic alignment that does not cripple the early stage manager's viability. It's not enough just to invest with early stage managers. It's in the how that matters. And their custom approach now exists in our industry, and we should really welcome it. I wasn't seeking a programmatic joint venture or one fund. I wanted to build a competitive firm that, like Analu said, would be a best-in-class and alternatives investment manager in order to become the next TPG, diversified in real estate credit and equity strategies over the long term and across various risk criteria and structures. However, this requires more than just dollars. It's the value-added services. And I'm just gonna list them. I'm working currently with the Strategic Project Group, human resources for team formation and securing talent, leadership and coaching team and training, their treasury department, procurement department, the valuation department, the risk department, the compliance department, and working on using their best-in-class processes to improve my policies. The ESG and the impact team, Y Analytics, their IT department, the legal department, the compensation department, the public relations and communications department, the capital formation team, and the investment teams within both TPG Real Estate and Angelo Gordon, who can serve as sounding boards for my deals as well as assist in sourcing. And lastly, access to their proprietary research. Instead of building a firm on my own, I'm building Caro Investors in partnership with TPG, heavily de-risking any concerns associated with a first-time firm and fund. In closing, thank you so much for your time today. It is a moment in my career that I have dreamed of for a long time. The responsibility of what it means to be successful is not only lost on me, it's not only for your underlying beneficiaries and my partner TPG that I want to succeed, but for so many young women that deserve to believe that excellence, hard work, and resilience versus the luck of being born into wealth can lead to shattering a glass ceiling. Thank you, and this concludes my remarks.
Thank you. Miguel?
Thank you. I'll introduce Elizabeth Brown from the GCM team and her team.
Good morning. Thank you all so much for having us. I'm Elizabeth Brown, Managing Director and co-head of the Sponsor Solutions Group and GCM Elevate. I am joined today by my partner, Kevin Nickelberry. He and I have since day one endeavored to build this platform. We have our first founder, Tony Miller, here with us today, whose background I will not do justice to. So I will let Tony introduce himself properly. Suffice it to say, we are very privileged to work with some of the best investors turned firm founders in the country. And that was our objective from day one. Our goal today is to shed light on not just the nature of the founders whom we're backing, so Tony Miller, as well as Joe Notori, who's the second founder in our portfolio, but to really shed light on how innovative CalPERS' support of this market is with respect to broader capital markets activity, and why the nature of investments that you all are supporting here is so catalytic with respect to not just the broader financial system, but with respect in particular to providing capital access to the most talented investors, turn new firm founders. We're going to start with an overview today of GCM's 50-year history with respect to emerging manager investing. I will turn it over to Kevin to kick us off, and then I will give some broader comments on the macro environment around GP seeding and staking.
Good afternoon. We'd like to use the time today to provide an overview of GCM Grosvenor, to talk about the GP seeding and stakes market, to discuss how we invest in and support emerging managers, talk a bit about Elevate's value proposition and team, and then turn it over to Tony Miller to talk about Excalary. On the first slide, we provide more information on GCM Grosvenor. Grosvenor is an $80 billion alternative asset management firm. We've been around for over 50 years. We invest in the full spectrum of alternatives. So we're active in credit, real estate, infrastructure, absolute return strategies, and then you have private equity, which is the firm's largest line of business with over $30 billion of AUM. Within private equity, we focus on the emerging manager space. We've invested about $14 billion across nearly 300 different GPs, and 57% of our commitments are to funds with less than $750 million. On the next slide, we cover our sourcing capability. We've been active in the emerging manager market for over 20 years. We have a deep sourcing network that gives us access to hundreds of managers every year. And we host the Consortium Conference, which focuses on emerging managers and has 700 attendees annually. So we have a consistent presence in this market. We've invested significant capital in this space, and it gives us real credibility when we're engaging with the best emerging managers. We've also invested in funds 1 through 3 of some of the most successful private equity firms. These are firms that started when they were $300 to $400 million funds. Now they manage billions of dollars of AUM. So they've generated great returns at the fund level, but they've also generated a lot of value at the management company level, and many have even sold GP stakes. So we've seen firsthand the value creation at the fund and the firm level in the emerging manager space, and Elevate is actually structured to participate in both those segments. So in our view, Elevate is well positioned to invest in and support the next generation of best-in-class emerging managers, and it also serves as a really efficient way to participate in the growing GP stakes and seeding market that Elizabeth will talk about now.
If you'll turn to the next slide, please. One of the most common questions that we've gotten since we launched Elevate formally last January is, why does the GP stakes market exist, and why does the GP seeding market exist, and where did they come from? This is in capital markets terms a relatively new market, meaning GP stakes or the idea of buying a minority interest at the management company level in an established GP. Think of that definitionally in terms of funds typically 4 or later in the life cycle of an emerging or of an asset manager rather. When we talk about GP seeding, we're talking about funds 1 through 3 typically, or that emerging manager category. And if you look at the stakes or established manager market, the evolution of that market is roughly 10 years old. It's now over a $700 billion market. That should feel like a staggering statistic relative to a 10-year-old market, and it is. But what it tells you and what it elucidates is a lot of the macro trends, which I'll go into in a couple of minutes here, as to all of the value that Kevin alluded to that's being created at the management company level, but to which historically underlying investors or limited partners have not had access to participate. And so part of the innovation and really what CalPERS deserves great credit for recognizing in terms of scale capital access is that the seed market focused on emerging managers serves the same critical function in terms of providing not just scale capital access, really importantly, but the right form of scale capital access, as well as all the non-investment infrastructure support that's required to be able to effectively de-risk the new business nature of what investors are building, investors turned entrepreneurs, as we think about them. As you'll certainly hear from Tony and as you heard from Karina, our founders are not new investors. These are very experienced investors, turned new firm founders, but who want recourse to the same degree of capital access and non-investment infrastructure support that's required to make them truly successful in building generational and long-term viable asset management platforms. Commensurate with that, seeding, in our view, is roughly in the first or second inning of market evolution. We think in our very humble corner of the universe as being a sequoia effect for our founders, giving them access to the best possible capital and non-investment infrastructure support in order to catalyze their development and growth. If you'll turn to the next slide, please. This is not a new market. When we talk about the institutionalization of seeding, we often refer back to 3 decades of seeding activity of asset managers, which has really historically been in the domain or purview of single-family offices and or the founders of asset management firms themselves, who have then given that catalytic or seed capital to asset management firm founders to go and launch their own firms. As we look at seed models of old, and what we contrast on this slide, the seed models of old versus how seeding is being done today, and really with credit to CalPERS and others who have now come along in order to catalyze that scale capital access for the best founders, seed models of old were rightly impugned by investors. And rightly, I say, because they were typically defined by subscale capital access, adverse selection in terms of the quality of investment track records of those firm founders. And it was typically the case that the nature of the investments being structured were not setting those founders up for success. And so there was rightly a negative reputation that attached to those seed structures. In today's institutional form, and what I referred to as being in the first or second inning of that institutionalization, seed providers like TPG, like GCM, and others of our peer set are in a position to provide not just the right scale capital and the right mix of scale capital, but all of the requisite support, as well as the credibility that we know is mission critical to ensuring that in a historically very undercapitalized and inefficient emerging manager investment market, that the best founders have access to capital. Next slide, please. As we look at some of the core macro governors as to why the best founders spin out, why Tony Miller elects to start Excalare. And we are nearly a year into our partnership with Tony, and he will give an honest accounting of how that partnership has gone. But I'd say Tony is emblematic of the quality and depth of the emerging manager investment talent market. And what I mean by that is supported by the statistics on this page in terms of where Grosvenor has been hyper-focused, which is to say commensurate with over 2 decades of private equity emerging manager investing as a firm. We have notably seen outperformance within sector specialists, within middle and lower middle market buyout investors, as well as within funds 1 and 2. That's been the crux of where outperformance has been concentrated. So Tony's certainly emblematic of that. He's also emblematic of a core trend we're seeing of the best investors turn new firm founders being motivated by a whole host of reasons, including what has historically been vintage year outperformance in periods of economic volatility, such as the one that we're experiencing today. These tend to be, said differently, very productive vintages for middle market private equity investors. For those founders, it becomes critically important not just be able to launch their firms, but to be able to attract and retain the best possible talent at the outset. And so a seed provider, as you'll hear shortly from Kevin, can be a really important catalyst in terms of being able to lend credibility, not just to the effort in and of itself. We as a platform and team have, since January of last year, looked at 620 investment opportunities and invested in 2. And we are now down the path on our 3rd. That should give you a very clear sense of the high bar with respect to the quality of founders with whom we ultimately partner.
On the next slide, we highlight why GPs enter seed partnerships. Access to capital is still the threshold issue for many managers. Some managers just don't have the working capital to hire the right talent, to invest in the right systems and processes. It's very difficult to secure an anchor commitment. Managers have great deal sourcing networks, but they may not have a broad LP network or relationship. So those could be reasons. Co-investment capital as well. There are certain managers that need additional capital to increase their opportunity set and to execute deals to build their track record. So capital is definitely a limiting factor and one of the reasons that these managers enter the partnerships. And then some managers just need support to help build their firms. Managers are great investors, but they haven't built an asset management firm before. So any additional information or access is really helpful and helps them make better decisions and ultimately drive value at their firms. If we go to the next slide, Elevate is focused on being a true strategic partner to these GPs and address some of the challenges that we know these emerging managers face. We provide flexible capital at scale, and we leverage GCM's broad platform to help build differentiated private equity firms, and then we participate in the value that's created at the management company level. So in terms of capital, we provide working capital facilities to invest in the systems, the processes, the people that are really necessary to raise institutional capital. We provide an anchor commitment to the fund, and we provide co-investment capital to increase the opportunity set for deals. We couple that with providing value-added support services to help GPs build the infrastructure necessary to scale their firms. So we give them access to the functional leaders within Grosvenor in compliance, legal, capital formation, our ODD team, our technology team, and then we leverage the experience that we've gained from investing in 300 different private equity firms over time to really help managers make faster, better decisions and reduce the risk associated with firm building. In terms of investment criteria, we partner with experienced private equity investors, sector specialists with deep industry knowledge, history of driving returns, and an entrepreneurial drive to really build something sustainable and long-lasting. We have 2 partnerships in place today. NVIDIA Capital Management, which focuses on the healthcare services sector, founded by Jo Notori. She was the former global head of healthcare private equity at Goldman Sachs, 26 years of experience in the healthcare space. And then Escalary Equity Partners, founded by Tony Miller, a very experienced education and human capital management investor who you'll hear from shortly. So both industries with very stable demand characteristics, multiple ways to grow, and both firms with great examples of the types of platforms and partnerships that we want to try to develop at Elevate.
Lastly, if we can turn to the last slide, please. What we are building at Elevate and have built is by definition a team effort. And as Tony knows, I think, Tony, you've probably met 80% of the firm at this point, and rightly so. We are a day-to-day 5-person investment team at Elevate. We are supported by a 5-person investment committee that represents the most senior leadership of the firm. Within that, as Kevin alluded to, we have, as we think about the universe for our founders, 12 non-investment functional experts that correspond to all of the non-investment infrastructure pieces that are required to build a best-in-class and blue-chip institutional asset manager. Tony will and our other founders continue to spend very meaningful time with those functional experts that you see alluded to here, but that as we think about our founder experience, we have both an onboarding as well as a continuing education component that's required to ensure that we can be comprehensively good partners to our founders, not just at the outset, but to support what we think of as terminal value businesses that can have enduring staying power, but also generate the best possible returns for our investors and stakeholders. With that, we will turn it over to Tony so that you can hear live from Excalari's managing partner.
Thank you, Elizabeth and Kevin. I'm going to constrain. I think that works. Yes. Well, it's very nice to be with you all this afternoon. Appreciate both the opportunity and appreciate the commitment to Mosaic and the platform, the strategy that we think has been critical to helping us accelerate our success, what we hope will be a kind of a leading platform as an education and human capital specialist for many years to come. What I thought I would do is share with you Excalare, and we'll start with the name and where it comes from, my background in that context, the opportunity that we see, and in that context, what were we thinking of when we were evaluating and considering seed capital investors and a real partner in the decision-making process that we went through, and how that played out. Well, first of all, the name, Excalare. It's a Latin type of pronunciation, of an Italian pronunciation, and it means to build, to nurture, to develop. And for us, it really has 2 meanings. One, we are education and human capital specialists, and so this notion of building, nurturing talent, critical part of what we do. The other part, as a specialist operating in the lower middle market, is this notion of how do we build, nurture, and develop the portfolio companies in which we invest in. So this notion of real systematic and consistent operating value add, we think is a source of sustainable alpha. So as we approach this space, we start with, Kevin knows in my background, I came into private equity from the operating side. And while I'm if you will, we are a diverse-owned business, the real notion was, is this a strategy that we think can deliver superior returns? And that's how we crafted the strategy. And so my background, in a prior life, I had been prior to moving into private equity, I was a consultant with McKinsey. I was a partner in McKinsey, then actually came into an operating executive role with a growth equity stage company. We had great success, which led me to Silver Lake, one of the first operating partners with Silver Lake back in the mid-2000s, a great platform, which CalPERS knows well, and we had great success. I like to say sometimes I might still be there today had it not for me to take a chance and pause my private sector career and actually go into public service. So I was called and took a presidential appointment to run the U.S. Department of Education as the #2 day-to-day operations for President Obama during his first term. And as part of that responsibility, also oversaw the $100 billion investment in stimulus monies that was dedicated to education, both elementary, post-secondary, workforce training. And really it was that opportunity and that responsibility that opened up a significant opportunity for me personally to say, could you actually take this combination of understanding how to deploy capital, private capital, and understanding how that meshes with public capital, regulatory regimes, understanding a broad, complex ecosystem, and a landscape that candidly is underrepresented when you think about private capital in the middle market area. And so that really was the catalyst for this strategy. It led me, first venture was to co-found a firm out of Chicago, the Vistria Group, where education was a core sector that we focused on, and I led all our investments there quite successfully. And then ultimately, and I'll come back to the changing landscape that we see, a growing and vast opportunity, not just in education traditionally, but in human capital management as the supply and demand characteristics of talent management fundamentally change, as the use of technology fundamentally change. And so that way, a group of us ultimately left, restarted, came together in 2022, and then launched the firm last year. Next slide. So at the highest level, what is it that we see? So again, things that we experience every day. Basically, the fundamental supply-demand characteristics in human capital are changing. And so if you start on the left side, what we all know, the need for upskilling and reskilling has never been greater and will continue over the next 10 and 20 years. You heard about it earlier today, this notion of how do we move from a fossil fuel economy to an increasingly clean economy. You heard about the notion of how we had globalization, how we have the deglobalization, the impact of that. What has been a long-term trend is the application of technology and the disruptive impact that is having on many sectors and many business processes. And then specifically, if you look at AI and the impact that's having. And so that is creating a significant opportunity for new skills, creating new jobs. It's been estimated to almost 2.5 million jobs by the end of this decade. And we're talking about a scale of economic opportunity that's been estimated to be $800 billion. I mean, the scale of $800 billion is dramatic. Think about it, roughly equivalent to Switzerland or Turkey's economy. And so that's, if you will, the demand side. What's happening to supply? Well, first of all, the interface between organizations, I'm sure many of you are familiar with, are changing the way you identify, access, and onboard talent. You're using new tools, new data, new mechanisms to do that at scale. We're operating in a very decentralized environment. So how do you actually take advantage of this transformation? And then if you look at how that ripples through to the supply side, we see the notion of ed tech and human capital tech, not just in traditional K-12, not just in higher ed, but also in the enterprise. And so as we look at this $1.7+ trillion sector in the US, we see dramatic transformation over the long term, lends itself to 30 different subsegments, and having a specialist point of view that can really understand and invest in that, we think is an opportunity for superior returns. The next slide. So, Excalare. Again, what are we? We're based in Los Angeles. I said, formally launched last year, having the team kind of come together. The 5 core team members had worked together previously in our prior firm. And we represent both industry leadership, public policy leadership, operating leadership with proven transaction experience. We think that specialist focus, as you all know, kind of what are sources of alpha. We think in the middle market space, this notion of the market is less efficient, and can you take that industry focus and network to generate advantage sourcing, which can be a source of alpha. If you think about the opportunity to navigate across a broad industry, allows you to identify both cyclical and counter-cyclical, right? And to invest and be able to do so with operating expertise that we think allows you to, again, deliver more consistent top-tier performance. For us, this notion of impact is directly correlated to performance. The notion of if students learn at a higher rate, if they acquire skills that are more relevant to employers, if they persist longer in the enterprise and can deliver more value, that is directly correlated with financial outcomes of the enterprise itself. So this notion of impact being somehow concessionary returns is in fact quite the opposite in the sector that we're operating in. Similarly, in a world where there is insufficient, there's jobs today that employers cannot fill because they cannot match it with the requisite skill sets that they need. The notion of how do you broaden the funnel, right? Not lower the bar, but broaden the funnel, identify and create an inclusive environment for those who have the requisite skills to be successful and fully participate in the economy, we think is a long-term and sustainable trend. So those are the attributes that we can marry our industry expertise, our operating know-how, this notion of impact alignment from a public policy standpoint, and that is what represents our overall strategy. Our view for Fund 1 is $300 million fund, of which we've raised half, to create a diversified portfolio of up to 9 different companies, so you get, if you will, the diversification effect, even in a Fund 1 portfolio. And, as you heard earlier, it's the notion of recognizing the needs that many of our investors have. How do you create a platform that provides both fund investment opportunities, but also co-investment opportunities as part of a scalable platform? So that's who Escalada is. Next slide, please. Very briefly, this is our investment team with me, one of my other partners, Pete Davis, former president of McGraw-Hill, made his transition to private equity over 10 years ago when Apollo Global executed the carve-out. He was an advisor on the private equity side, and then has been an operating advisor where we met and worked together at my prior firm. My other partner, Marcelo Stekelode, again, longtime colleague, was one of our first team members at my prior firm and has done all the education deals together. We then brought in 2 associates, and so we, if you will, got the band back together. And so that's the core of the team who had demonstrated experience working together and delivering successful financial investments. We then complemented that with 2 associates so far, at least represented on this page. We've got a 3rd associate, Gina Leggio, who joined us just last week, so she didn't make the page. And we've also got our CFO, Annie Chow. Interestingly enough, I would represent that 4 of the 7 and then 6 of the 9 of us have California higher education roots. So we do have roots in California, so there's a little bit of the homegrown advantage as we kind of build the team. Next slide, please. So the question became, as we were launching the firm, again, as a team that's worked together, deployed capital, I've been part of founding the prior firm, raising a couple of funds. We were really saying in the current environment, right, how do we approach this? And for Rush, we knew we had the good team, but the real complication was, we all know it's been a challenging fundraising environment. We know that, we did not have legal attribution, although a highly referenceable track record, but that creates some friction in the marketplace. We also know this sector expertise and our unique position and depth of that distinguishes us in the market because it's not overpopulated. And so again, the friction of not being familiar with the sector, right, was a potential concern. And we really were committed to not just raising a fund, but really building a best-in-class firm. So how could we scale very quickly? So those are the considerations that we had when we were thinking, do we kind of continue to go alone and to take our time and pace? Or do we think about, is there a partner that could accelerate that, who knows us, who could really help us build a best-in-class firm and get on that track sooner rather than later? So that's what we were looking for. And so again, capital, but not just capital. Understanding of what real best-in-class looks like, because that was really our aspiration, not just Fund 1. We were confident that Fund 1 would come. It was much more, where do we want to go? Ideally, somebody who was familiar with us, right, as an emerging manager, but also us even personally, because there's that credibility that comes with actually knowing the GP that you're working with. And then again, somebody who could provide practical, if you will, tactical expertise and experience as we look to build out our back office. So that is how we came to the decision to partner with Elevate. Next slide. And again, just to summarize at a high level, 1, capital formation. Yes, at the end of the day, it was important, can we have a capital formation partner who could not just provide capital, but also could support our overall capital formation process. And with the GCM platform, you had access to the broader set of investors in their network. Moreover, we had LPs in our network that they had relationships with, and so they could support our capital formation more broadly. They could also, as we again even built out our capital formation efforts, they were experienced working with emerging managers that could bring that expertise and experience. In terms of fund operation support, the idea of like fund administration, finance and accounting. Our experience tells us that one of the key challenges is how do you actually get transparency and really alignment with your LP investors? To the degree that there are issues over time, it's because there's a lack of transparency, sometimes trust, sometimes conflicting interests. And so our view is like, how do you actually understand that early on and infuse that in everything you do, not just in practices and policies, but the culture of what we're trying to do as a firm. We felt like that's consistent with the best-in-class manager. So a GCM platform can provide us that perspective. You did have perspectives on ESG and impact, things again, not just the buzzwords, but like the substance of if you're going to do this authentically, how do you approach it and how do you understand, right, how to do that in an increasingly, if you will, not just crowded marketplace, but a messaging marketplace, a marketplace that's crowded with different messages. How do we get the clarity that's authentic? And then again, the practical, again, as we onboard a COO, how do you actually kind of plug them into the network, into the Grosvenor network so we can understand best in class? For us, we're excellent deal makers, but our view is, our value is one of continuous improvement. And so how do you get the best of Grosvenor's experience leveraging their direct investment and co-investment experience across different sectors, but specifically in the education sector? How can we compare notes, understand trends? We thought that's a source of real value that you wouldn't necessarily think so as somebody who's already got proven experience that we had, but we saw there's incremental benefit in that. And then even the notion of value creation support, our core go-to in terms of this operational support, it's recognizing that, again, everybody represents, we've got operating groups, we have value creation capability, but how do we really understand and take that to the next level of scale, the next level of, if you will, replicability, and what are the resources and approaches that can be used to do that? Those are the things that in our partnership, as we've experienced, coming up on a year now, that we have found to be kind of true to what we expected. In fact, in some ways, we joke, it's kind of been more than what we expected. Because our biggest concern was, as you probably know, you see an emerging manager, you've seen kind of one emerging manager. They have some traits, but you have to meet each GP exactly where they are. So this wasn't our first firm, but we knew there were real gaps. And so what they really did in this partner-like model really then met us in terms of what are you trying to do, how are you trying to do it, where are you starting with, and that's what's made for us a success. So just in closing, we're poised to do we've already done a first deal, we're poised to do our second and third deal over the next 3 to 4 months. We are on track to close out fundraising by the end of the year, and as I say, we'll be kind of officially off to the races. And I'd say, we really appreciate the partnership of the GCM Elevate team, but more importantly, the real vision that CalPERS and the Mosaic platform has being a catalyst, because it really has enabled what we see as a manager of the future who is well positioned to serve you and your pensioners' needs in terms of helping deliver superior returns. So with that, thank you.
All right, Miguel, thank you. Any last comments? Anton, Miguel?
None, just any questions or?
Yeah, so my first person that wants to ask a question is Ms. Willett. Go ahead.
Thank you so much for the presentation and all the information. My first question is, how are we ensuring that our labor principles are being met in both the Mosaic investments and also in the private equity direct investments?
I'll let TPG and GCM follow, but at the highest level, we pursue the attestation process that we've discussed with you, and those are signed by the two managers supervising the investments, TPG Next and GCM Grosvenor.
And I will just ask everybody to keep their answers and questions short because we'd like to be done at 1 because we have a press conference, unfortunately.
So let's leave it at that, but the key point is the two managers here are part of that attestation process.
Is that your only question, Melissa?
I have one more question. Then just how are we scaling our investments in emerging managers outside of Project Mosaic or private equity direct investment?
The question is, how are we scaling them?
Yeah, how can we scale? I think the $1 billion commitment to Mosaic platform is really phenomenal, and we're excited about it. How do we do more?
Yes, excellent question. We think about what we get from Project Mosaic as providing that foundation of opportunities for future scale. I do think that the impact from the Project Mosaic dollars really is not fully captured by the dollar amount. Ironically, the smaller checks to help establish these firms change the landscape and provide more investment opportunities for the private equity program to access directly. But it's those smaller checks that are changing the landscape. As those firms grow, then we have an opportunity to pursue scale. But to go back to the prior comments distinguishing the private equity direct portfolio from Project Mosaic, in the fiscal year 22-23, we had over $4 billion of commitments in firms that were identified as DEI. So we made those investments based on what we thought were the best return opportunities. There was a voluntary questionnaire that was provided to all those managers. Those submissions were compiled for the California legislature, and it established that about just over $4 billion of our approximately $15 billion in commitments were with DEI firms. And I think that shows the feedback loop of being able to, through Project Mosaic, create that foundation of opportunity and then scale.
Thank you.
Okay, I texted everybody and nobody texted me back, so I think that, oh, okay. I texted you, Jose Luis.
I'm sorry.
Go ahead.
Okay. Oh, yeah. I think you did. Yeah, sorry, I wasn't looking at that. Yes, I have one question. So, Tony, I'd like to ask you a question about your fund and just the partnership between you and Gorsner. Sorry. Yes. Can you hear me now? Yes. Tony, thank you first of all, thank you for the presentation, all of you. It's been an incredible presentation. So my question is, with respect to your firm and how your partnership has been with Gorsner, what have you learned to date? What do you think you'll be learning? And how would you leverage that? If you can just kind of elaborate on that. Thank you.
Sure. What have I learned to date? Candidly, I've learned to appreciate more the full set of value-added services that I probably underweighted at the beginning. So again, meeting a lot and having, again, the experience we had of having, have already kind of co-founded a firm, having secured some resources in terms of fund administration and already being committed to kind of a best-in-class approach. It's translating that into the specifics of, now, but how do you actually do it? How do you think about reporting and transparency? As you're setting up kind of this operating value add, how do you think about, how do you need to account for it, right? And so you don't have with fee offsets, so the technical aspects of it. And having those candid conversations with Grosvenor has been very helpful on the back office side. On the capital formation side, it's been the benefit of really being a strategic partner. And so the notion of facilitating introductions, both where they have personal relationships at the partner level as well as firm. And so again, when you think about the best partners that you have, it's the email within the firm, but it's the personal commitment to your success that you experience. And I'd say that's what we've experienced. And so that's been very satisfying. What would what's kind of around on the horizon and what's next? I think for us, candidly, it's leaning into the investment in the firm in terms of continuing to attract and develop the truly top talent of the different functional areas. That's probably the next thing. So we've been talking about recruiting, comp benchmarking. Again, as a emerging firm, sometimes you're inclined to let's just wait a little bit before you really lean in. And if you really are committed and you've already got the momentum, you're actually better served. And especially if you think about the macro markets going on, we think there's opportunities right now. And so that's where I see kind of increased partnership is on the HR and the talent side as we build out our capability going forward.
Thank you. That's all, Doc.
Thank you very much. Gail, then Ms. Cohen, and then Mr. Frank Ruffino, I think. So there we go.
Well, good afternoon. Excellent presentation. Good afternoon. Excellent presentation, first of all. And I like your concept, which is comprised of course, to build, nurture, and to develop. Me being an educator, of course, that's important. Can you explain a little bit more about the commitment to DEI, what that looks like, and also explaining the differentiated investment strategy?
Happy to. So first question, commitment to DEI. For us, many of the opportunities that we see, in fact, the vast majorities, are based on challenges of the current system, and that's generally highly correlated with lower socioeconomic status of students and or underrepresented talent pools in the employer pipeline. And so that's what we find in terms of practice. So if I were to describe our first investment, it is actually providing curriculum, that science of reading-based curriculum that helps students who are at least 1 to 2 grade levels below reading. And if you actually look at the demographics of that student population, not surprisingly, you would see they're highly correlated to lower socioeconomics, and you find that, unfortunately, can be correlated to race and ethnicity. So that would be an example of we are committed to superior outcomes with technologies that actually work, and you find they're disproportionately impacting kind of those communities. And so I'd say that's really, if I've addressed it, that's been our approach. And I could cite the same examples when you look at upskilling and reskilling and allowing, as we move away from more of a degree-based, a switcher degree, but what skills you have, you actually find it liberalizes the marketplace a little bit more, because there's many more adults with different backgrounds who may be able to demonstrate and acquire certain skills, even if their circumstances didn't afford them to a name brand degree. And we think that's, again, a great opportunity for employers.
Okay, thank you.
Thank you, Gail. Controller Cohen, did I mistake your thank you for just a thank you and you meant to talk? I
It's fine.
apologize.
I'm being acknowledged now. It's okay. Don't worry about it. It's all water under the bridge. Thank you very much for the presentation. Don't worry about it, Teresa. And so I have a couple questions for TPG. Thank you for being here. Karina, I loved your presentation. I'm very excited for you.
Thank you.
I'm really fired up. So question, TPG, what advice do you provide managers when they don't qualify when they don't qualify to meet your standards to become a partner with you, to be invested in? And then the next question is what should we as board members do when constituents believe that they really haven't been heard? Specifically, someone came to me with an investment opportunity, connected with you, and felt like they weren't heard, and just wanted to know what more can I do as a partner?
Yeah. Well, let me answer the second one first.
Sure.
Give us feedback, because I think that, we do pay a lot of attention, probably more even attention to the people that we
don't
either say no, or the majority of the people, we say not now. And that may be a combination that we actually may not be the best partner for them, or not the best partner to them where they are right now. And we actually do connect them with other people. We have a great relationship with this team, but thankfully, thanks to what has happened here, to your point, there has been a change in the market. We offer a very specific solution that I think is very applicable to a lot of people, but there are definitely criteria. We are very selective. But most of the people that we decide not to engage further, it is actually with a list of things that we think they can work on and that they should come back to us. And in fact, we have periodic check-ins with people. Many of them are part of our network. They come to us because of the relationships actually of this team. And the other big source is also our own colleagues at TPG. They also refer a lot of people that they know are trying to get in there. So I would say if there's something that we have not met the expectations of how to deliver that answer, definitely give us the feedback because we're continuously working on that. But the majority of the time, I would say there's three buckets. One is size of the fund, because we are trying to meet a certain portfolio construction. We also have trying to diversify the asset class within our portfolio to deliver the returns that we have committed to. And then the majority of the times that we say no, and it might be a harder no, it has to be because we don't think that there's a fit in the partnership. I mean, a lot of our underwriting is on who that founder or co-founders are. And it has to be in alignment of their strategy, but also the values that our firm stands for. So I would say, I don't know if you guys would add anything more than that.
No,
but
well, hold on, just to be respectful of the chair's request, succinct answers. I have another question that I want to make sure that I get on the record. But I think I gather what you're saying. It's the same philosophy I use with my 3-year-old who wakes up wanting a popsicle, and I say, not right now. And here are all the reasons why.
Right.
Yeah,
We try to be, I mean, personally, anyone that knows me, there were a couple of, I like to be transparent because I treat people like I would like to be treated if I was in their position. And this is a big commitment. When people decide to leave whatever else they were doing to start these firms, is a huge personal, and quite frankly, they have to compromise a lot of different things. So we take it very seriously, but sometimes, sometimes we might get it wrong, which is also why I want the feedback. But the majority of the times, I think that over time, we've had some people that actually we have said not now that have come back and are in our pipeline. And we believe that maybe 1 or 2 of them will be in the next set of investments for us. They have made some adjustments or have explored the market, and they think that maybe we are a better fit for them. And then similarly, we have seen growth in them, which ultimately is what we want to see for the industry.
So the other thing I think part of what I understand is that you see part of your role is to help managers prepare to become better institutional, to become more institutional, to become more attractive. Is that what I'm hearing correctly?
Yeah, I mean, our goal is to have them be multi-fund.
Multi-fund.
And that is by institutionalized, you mean that they're sustainable businesses? Yes, for sure. We are not really, our goal, I think it would be underselling the commitment that we have received to try to fund just the first fund, or to only do accelerating capital if it's a, second or third fund. So yeah, we're trying to build, as I said, competitors to TPG.
So that kind of leads me to my last and final question. How many staff do you have dedicated to helping managers get to where they need to be to earn an allocation from TPG? Do you have, I don't know if you have staffers dedicated to this, or is this just kind of built into the entire process?
No, this is, so 2 of my dedicated colleagues, they spend 100% of their time.
I see.
That's what they were hired for. I mentioned Hugh, Nishna, and Rosalia. They're not here with us because they're doing work while we are here talking to you. So they're also dedicated. And the investment committee that you saw at the top, all of us are dedicated as investment committee. That is a core portion of our job. And then we have a business building team dedicated to Next. That team is about 10 people. And they have different disciplines. They also are a team that helps TPG actually with like the recent acquisition that we did. So these are professionals that know how to build firms. And then we have dedicated people from the capital formation team. And as we said, function leads in all of the disciplines that Karina mentioned, that this is part of their job. And so when there's a TPG Next manager, even if it's in the pipeline, even before we've made a decision to invest, they're engaging with that team. So in the page that I showed, there were probably about 20 people in total, but the investment teams, which we didn't spend quite as much time talking about, in all the disciplines that we have are available to the next investors. So in our case, where Karina, as she mentioned, our TPG equity real estate platform, but also we made a recent acquisition last year of TPG AG. Angelo Gordon, they also have a real estate platform, and they also have reviewed with Karina her investment strategy, their fundraising, and just generally, actually, I think that they interviewed someone because we felt that it was important for them to be included. So the whole firm is available, but there is definitely a dedicated team.
So in terms of the firm, do you have opportunities where you present your the businesses that you're partnered with, like a showcase or something like that? Does that exist?
It does.
What
It does.
what is it? When is it? And can I
Yes.
get on the invite list?
Yes, so for our TPG Next, because it's treated as any other platform, we have something that we call Firm Forum. It occurs every Monday at 8 a.m. And as part of, we talk to the firm about different things that are going on. And as part of that, we present the managers that we are invested in. And that's true for TPG Next as well. We have that. We obviously, as part of our diligence process also, we include our colleagues across the firm. So TPG Next is a very well understood strategy within our firm and very well supported.
Thank you. And to the rest of the panel, I have questions, but I'll just talk to you directly afterwards, just in the
Thank
interest of
you.
time.
So-
Thank you. Yes.
So we do have a press conference happening in 4 minutes. I have gotten Frank to step back for us and maybe go up and ask questions later. I want to adjourn and go to lunch. We do have a speaker that's coming at 1:30, but I heard it's not time certain, so lunch will be till 1:45. All right?
Thank you.
forces playing out across the globe to better understand the impacts of those issues on our investment work. And so I'm very pleased to welcome Stephanie Ivy Sanford of Goldman Sachs and Ambassador Norm Eisen, the former U.S. Ambassador to the Czech Republic and current fellow with the Brookings Institute. Thank you very much, both of you, for being here. Welcome, and please go ahead. You got to turn on your mic, and
How
you
about
will
now?
probably have to pull it a little forward because the people in the back can't hear us.
How's this? Good? Thumbs up? Okay.
Okay.
Awesome. Well, thank you so much for inviting me to join Ambassador Eisen for today's panel discussion. It's an honor to be here. I learned through our preparation that Ambassador Eisen and I actually share the exact same birth date, November 11th, which happens to be Veterans Day. So I think that that is the right setting for a conversation on geopolitics.
All Scorpio panel is very dangerous when it comes to geopolitical tensions.
Exactly. And so we're going to explore a wide range of issues as it relates to geopolitics today and really take a closer look at the impact of destabilization in the world. And then we're going to actually unpack decisions that CalPERS can explore as the largest U.S. pension and true market leader and ways that you can consider acting as a fiduciary in this context. Goldman Sachs chief economists, along with others, have the view that the economy looks pretty constructive. So there are all these things happening in the world, but the markets are up 18% in the US, as we talked about, and that the real issues center around the exogenous risk of geopolitical instability. I mean, that's an area where Ambassador Eisen is clearly an expert. Historically, in times like these, the markets have acted as if this is noise, and the markets have extremely low volatility right now. And we still think that there'll be a soft landing in the economy with potentially 1 or 2 rate cuts by the end of the year. So why are we here today talking about this and not thinking about this as just a blip and something that will return to normalcy? We're going to talk a lot about that today. And Norm's background is both varied and highly accomplished and relevant for today. Besides the fact that we're both fellow Scorpios, he's had a previous life as an attorney where he's done a lot of pro bono cases and worked on a number of things like Enron, the subprime financial collapse, Monica Lewinsky situation, and the Trump situation.
Was that a question about which Monica Lewinsky situation or which Trump situation?
Trump situation?
I was the counsel in the first Trump impeachment for the House of Representatives, the impeachment and trial.
Thank
And
you.
I'll tell you a funny story about that when we come to it.
Okay. And in addition to that, his work with the Brookings Institute, a lot of that will be the basis for our conversation today. He's done a lot of wide-ranging and interesting research on autocracies and on AI and a number of different topics. So I can already see we're going to have a very lively, robust conversation here. And he's also been very involved with ICGN, I think where he's off to right after this. And so I think there's a lot of relevance to what he's done most recently and throughout his long career that I think will make this interesting. We're going to chat for the first 45 minutes or so, and we wanted to leave a lot of time for questions from the audience as we go forward. So I'm going to start with a question for Norm about what motivates you with respect to your passion for democracy and ethics. You're an avid historian. You've studied intensely the history for the past 100 years, and you've said we should be optimistic about democracy, although a lot of what we talked about on our call was not particularly bright. And I think a lot has happened since then. We even joked a few minutes ago about how much the world had changed since we first talked with respect to the French elections. With the tragic assassination attempt this weekend, I think we should just acknowledge that and how terrible that is, and that no matter what one's political views are, that violence is not the answer. So that's something that I just think is important for us collectively to acknowledge. And then there was the decision with Judge Cannon that will play into our conversation, and I think the announcement of Trump's vice presidential running candidate at the convention. So much has happened even in the past couple of days since we first connected. But we are going to discover some concrete steps that institutional investors can take in thinking about political risk and whether it's a more significant factor in how you think about investments and portfolios. One of the things is that you've looked at chaos and cohesion over a century of European history and how there was a triumph of liberal democracy in your book, The Last Palace. I think you wrote about that through the eyes of 5 people, including your mother, who was a Czech Holocaust survivor who had been deported to Auschwitz. So I think you have very interesting context on that. As I mentioned, we had a wonderful discussion on a lot of the materials that you've written, including that book. But in addition to being optimistic, you have acknowledged that this is probably the most challenging period since the end of the Civil War or Jim Crow. So in that perspective, what is your view on the current challenging environment that we're in? And are you still optimistic?
I am optimistic, although you can always be optimistic if you set your time horizon in the right length. Stephanie, thank you for having this conversation. I want to thank Teresa for inviting me. I want to thank the Board of Administration of CalPERS and the CalPERS staff and others that are here. I'm from Los Angeles. I'm a native Californian, so I'm acutely aware of how important CalPERS is, since I know so many people whose retirement futures have been assured by all of you, including some of my high school friends who are now retiring as public employees. I'm also appreciative as we tackle this question of optimism in the face of the challenges that are facing us in the United States and globally. I'm also appreciative of CalPERS' leadership role because of I was sent to ICGN actually by President Obama when I was working in the White House to help develop what ultimately became their anti-bribery standards. And I'm headed there, as Stephanie notes, to speak in London. So this is like, you know how the Broadway show opens in Connecticut and then it goes to Broadway. I'm pioneering some of the remarks for London with you today. On that note of appreciation for CalPERS and that note of optimism, one of the models for me in how to do institutional investing stewardship for fiduciaries, for the people whose money and really lives you protect, is the broad perspective on stakeholders that CalPERS has and your leadership on issues like climate change. And one of the things we'll talk about today, it's part of the reason I'm optimistic, I think that America will rise to the occasion and defend against democracy change as vigorously as some of us have climate change. So that'll be a theme as we go through today. I guess I start with my fundamental optimism. I'll be honest with you, it's a methodological bias for me. And it really begins as so much does with my life experience. As I said, I grew up in Los Angeles. If I could have the slide number 1, please. My parents were immigrants from Europe. My father was an undocumented migrant, actually snuck in on the last boat out of the port of Athens, Greece in 1940 and joined the U.S. Army to become a citizen. My mother immigrated to this country after surviving Auschwitz in World War II. I grew up in that little hamburger stand that you see there, South Central Los Angeles. Could you flip to the next slide? Thanks to my law school classmate, Barack Obama, this was where I ended up in my last of my Obama administration jobs, the Ambassador's Palace. And I thought I would start by telling you a story about just that life trajectory is enough to make you an optimist. That home, that beautiful home that is now the residence of the United States Ambassador in Prague, Czech Republic, was Wehrmacht German occupying headquarters in World War II. And the orders to send my mother and her family from then Czechoslovakia to Auschwitz were discussed in the dining room of that home, where we had Sabbath dinner every week. We would bless the candlesticks, the candles, every Sabbath Eve on a table which had a Nazi swastika and serial number underneath that table. And my mother loved to say when she was living, they took us out of Czechoslovakia on cattle cars, and my son flew back on Air Force One. First time I went back, I went with Obama. How can you not be an optimist? How can you not? Every time I would eat, we kept kosher in that house. Every time I'd eat a kosher lamb chop, I'd say, "Take that, Hitler." So I do bring my life history to my optimism. But I think that if you look at the trajectory of the democratic, political, and economic and social structures that have, and I'm going to want slide 5 next. I'm notorious for going out of order in my slides. If you look at the trajectory over the past century, which has been the American century, I know how much it meant to the independence of Czechoslovakia, the United States entering World War I and then fighting for our American ideas in Europe. Look at how we've gone from about 30% of the world being liberal or electoral democracies, 40, 50% about autocracies, to the relatively low number about as you can see, we've got a few more autocracies in recent years. We're going to talk about that. But if you look at the trajectory of democracy, or look at the bottom two, electoral democracies and liberal democracies, you can see that the overall trend of the past century has been towards democracy. And I want to show you the correlation. Proving causation is tricky, but I do want to show you the strong correlations because it suggests to me that we're going to be able to push through our current challenges and continue to deliver progress. Look, for example, at life expectancy over that same period. That's slide 4 in the world. The explosive growth of life expectancy. If you can go back one slide, please. Or the growth of education in a comparable period. The education slide covers, as I say, you can do wonders for your optimism by fluctuating the time horizons. But if I can see slide 3, please. The amount of education we've been able to deliver. And then global GDP is slide 6. So I believe there's a much longer argument to be made about the association of democracy with prosperity and with making the world better, not only for the United States, because the United States is a special case, and we'll talk about that, but really making the world better. If I could have slide 14 and 15, please. We've had a big project at Brookings after the turbulence that I've led, the project, not the turbulence, a big project at Brookings after the turbulence of the 2020 election and its aftermath. It seemed to me that signaled some of the autocratic threats that we're seeing today. So we brought together $14 trillion in capital in the form of a group of institutional investors who've regularly met and talked, and we've produced a series of papers like this one, where we've studied the connection between democratic advancement and backsliding, and and the economic determinants and the ways that the thriving of democracy enhances prosperity, and I will argue to you today, drives value for your stakeholders, for the people whose money you're entrusted with, and the opposite, democratic backsliding of the kind we've seen in recent years around the world. And for this, I would like slide 7, impairs the economic performance of our countries. We've seen this in Poland, Hungary, Turkey, Russia, and there's no doubt about it. We are seeing an uptick in autocratic behavior. And that's really what we're going to talk about today, is how do you remain optimistic in the face of this pushback on democracy and all of the benefits that a thriving, vibrant democracy has brought to the United States, to the world. We have some very serious threats and challenges, but I think that we're up to meeting those challenges. And we're going to talk today about exactly what they are, where they're coming from. We're going to be totally nonpartisan as we address that in the United States. But I am going to be candid with you about the threats that I think represent a potential systemic political and economic risk, and what CalPERS, the leaders that you are, what CalPERS can do about that to protect the people to whom your fiduciary relationships run.
So I think the first potential threat we should talk about is what's happening with the checks and balances, and specifically with regard to some recent Supreme Court decisions, as well as a court decision that was made this morning. So we're going to talk about 2 key decisions. There was the Chevron decision, which really changed a 40-year precedent with the power of federal agencies. And that can obviously have a very significant regulatory impact on certain sectors of the market. And then there's the more widely known outcome of Trump's immunity decision, where the Supreme Court voted 6-3 to review his conduct in his official capacity as exempt in terms of the federal election interference case, but maybe not for other actions. So I think if you take those 2 decisions together and also think about the decision that was made this morning by the federal Judge Cannon to dismiss the classified documents case, there's a commingling of issues that we're seeing here in terms of economics as well as law and policy. So what do people need to understand about this? And then what does that mean for CalPERS?
If I could have slide 9, please. So the folks know, of course, the immunity case has been very well covered. The regulatory case, Loper-Bright, reversing the Chevron doctrine, somewhat less so. I think that you have to take those together with the Dobbs abortion decision and what so-called Judge Cannon, I'm gonna have to, moderate my ire. It's fresh. It's so fresh, the jaw-dropping decision, what all of that means. What we saw starting with the Dobbs case was the Supreme Court abandon its longstanding principle of stare decisis, that it will treat as settled law its own decisions, that you can't have a legal system where if you get new judges, the law changes. And with both Trump, the immunity case, and Loper-Bright, the regulatory case, they threw out very important, longstanding legal principles. And Judge Cannon did the same this morning in tossing the Mar-a-Lago documents case, because she said the appointment of Jack Smith was unconstitutional and unauthorized, even though there's multiple federal statutes which expressly authorize this appointment, and those powers have previously been upheld by the Supreme Court. Law is up for grabs when you have a settled right of choice that is reversed simply because the justices have changed. When you have a Supreme Court that says presidents are immune, they even have the power, it's inconceivable to even have the power to commit political assassinations. They can't be prosecuted for that. That's the import of saying presidents are absolutely immune for official acts. There is an exception for unofficial acts. The Loper-Bright case, the regulatory case throughout, we had over almost 20,000 cases in which when a statute has to be interpreted, they allow the federal agencies who have the expertise and the knowledge, if a statute is not clear, to interpret that. No more. That power has been shifted to the courts. The message that sends is that the legal system, and this really matters to CalPERS, the legal system is up for grabs. Anything goes if the judges, who are the least democratic branch, unlike Congress, unlike the executive branch, unlike our state government, they're not directly elected. They're nominated by the president, chosen by Congress. If judges take that power onto themselves, the instability is the opposite of what has made the United States the safe haven for global capital, the predictable zero-risk destination through thick and thin, the anchor of the global economy, the strongest performing economy post-COVID, our remarkable recoveries. Let's see, I'll show you the next slide, 10. Shows the ways that the United States bounced back after the Great Recession. I was privileged to help President Obama as the lawyer for our post-Great Recession recovery for Dodd-Frank to work on those teams. And then once again, after the pandemic, the envy of the world, really in the post-World War II, the post-Bretton Woods economic order, the centrality, the predictability, the consensus on principles like the settled rule of law have made the United States the anchor of all those charts that I showed you, the effects of global prosperity going with democracy. 60% of central bank foreign exchange reserves are in U.S. dollars. 90% of foreign exchange transactions are U.S. dollar based. If the United States is going, and we're going to go through a number of these risk factors with you today, Stephanie and I, if you are going to see this kind of turmoil, think of what Judge Cannon did today. It is one of the most shocking decisions, even worse than that immunity and Chevron decision, on a par with Dobbs in how shocking it is that day that they leaked the Dobbs opinion. She not only lawlessly held that the leader of her party, who nominated her at the last minute to put her on the bench in 2020, she was a midnight appointment at the very end of the Trump administration. She not only held that they're lawlessly, flagrantly flouting I said I was going to be somewhat moderate, the statutes that authorize this. She put herself above the law. She did it on the first day of the Republican National Convention. Do you think that's a coincidence? It's like a nominating speech for Donald Trump, or she's nominating herself for the United States Supreme Court should he win re-election. It's so outrageous, but it doesn't only matter politically. I would argue that because even this Supreme Court won't allow it. The 11th Circuit has already slapped her down repeatedly for lawless decisions. They're going to reverse this. They'll probably remove her from the case. It matters because she got a message from those Supreme Court decisions. Anything goes. And that is a very dangerous message that will erode the stability of the United States rule of law system, one of the pillars of our prosperity and global prosperity, and one of the pillars that CalPERS relies upon. Your portfolio companies, your investments, if there's a need for dispute resolution, we need to count upon a fair judicial resolution. The entire economy, it's not just your investments, it's the entire economy that functions because we can count on the courts for speedy and just resolution of disputes. The world, it's one of the reasons that the world brings its money to the United States, and we all benefit from that, including your fiduciaries. So this is a dangerous erosion of a core, one, not the only, but one of the core pillars of the American rule of law system that together with other threats requires us to say, just like everyone here, you responded. Your predecessors, for some of you, you responded to the threat of the existential threat of climate change. It requires us to ask, is American democracy is the erosion of American democracy a systemic political and economic risk? And if so, as the leaders, not just around the United States, but the world looks to CalPERS, what do we do about it if we feel that way? So if any of you like me have that feeling, when I was working on the financial regulatory reform, we would meet twice a week in Larry Summers' office. I was Larry's lawyer. Let me tell you, that is a very exciting adventure to be the lawyer of Larry Summers. And Larry, I remember one time he said, it's like in the depths of the Great Recession, the first months, he said, it's like a ball has rolled off the table and you're waiting for it to hit bottom. Where will it land? If you've had that feeling that I've had over the past months of, it's like you're in the elevator and it suddenly drops, that sinking feeling. One of the things you can do, I wouldn't tell you how to answer that question, but one of the things you can do is ask yourself, well, is there a systemic risk? And what, if anything, can we, given CalPERS' unique role, do to respond to it?
And so we opened with the fact that the markets have been pretty immune to reacting to this. However, I think you've put some interesting questions on the table as to how that could possibly change, because there's some serious policy, trade, rule of law implications with some of the things that are happening. And one could argue we came out of COVID, we came out of the Great Recession as leaders here in the United States and weathered and came back with economic resilience. But one could argue perhaps, what if we are not a dependable safe haven any longer? And you've put together something very interesting to actually try to monitor and measure that. It's called the American Autocracy Threat Tracker. Can you talk a little bit about that, what it is and how it could be viewed and used?
If I could have slide 11, please. About 6 months ago, the scholar of autocracy, Professor Ruth Ben-Ghiat, came to me. And she said that we're social friendly acquaintances. And she said she felt that in checking that her retirement accounts were going up, and so was her political anxiety. And she could not square the two. And she argued to me that when we've had the most, she knows my family history, she says, when we've had the most alarming democracy downturns, and with them cataclysmic financial and economic impacts, that there's often a a credibility gap, that people don't take the threats as credible. They're not willing to believe, you know, the joke, who do you believe, me or your lying eyes? They're not willing to believe their lying eyes. Now, I have been vocal about some of these issues on CNN, where I'm a legal analyst, and in other fora. So she persuaded me to start the American Autocracy Threat Tracker, where we monitor it's the only comprehensive tracker of all of the autocratic threats and promises. By the way, it's not only, no band on the political spectrum has a monopoly on autocratic threats. So you do get people on the left, on the far left, who make them. There is an asymmetry. We've seen a far greater volume and degree from the center right to the far right in the United States. And she asked me to model with her, to comprehensively catalog these threats, to model them, and to assess their economic impacts. And we have a board of economic experts who do that with us. So if I can see slide 13, please. This is a sample from some of the chapters of what the former president has said he will do if he returns to power. He said he's going to be a dictator on day one. He said that he's going to use his Department of Justice to retaliate, that he's going to engage in immigration roundups, potentially over 10,000 of our friends and neighbors in the United States, use the Insurrection Act and other unbound powers he has to deploy the military against protesters, and a variety of other moves. And what's alarming about mass deportations, mass firings using the Insurrection Act, retaliatory prosecutions are, it goes with a set of economic promises that are on slide, I would have been much more clever to put them on slide 14, but you'll find them on slide 18. So when we talk about that structure, and all of you can Google American Autocracy Threat Tracker, we're having a big cross-partisan summit because this is not a partisan issue. I have senior representatives from every Republican administration since Reagan coming to our summit next Tuesday in New York, including a number of Trump officials. When all of that chaos, if it comes to pass, combines with the economic policies that are being floated, devaluing the dollar, protectionism and steep tariffs, monetary policy that will trigger high inflation, attacking the independence of the Fed, we have a whole section on it. It creates an alarming risk of a kind of chaos cocktail in 2025, should the former president return to the White House. A risk of black swan events. There's a group of Nobel Prize economists who have been tracking this risk. And in its own way, the inflationary effects of deporting over 10 million workers in the United States and establishing, I should show you my tariffs chart, establishing punitive tariffs, if those threats are followed through. Now, you know, there is a question, a legitimate question about whether that will happen or not. But if those threats are followed through on, that poses oh yes, it's slide 19, which shows the impacts on GDP, and slide 20, the punitive effect of tariffs on working people, retirees who were formerly working folks, the cost of these mass deportations, that's slide 21. The combined political and economic, that's why I asked the question, is advancing autocracy in our country a systemic risk politically and economically? The combined political and economic effects are potentially daunting. Now, nobody knows whether this will come to pass or not. And I do not think the markets have priced in the risk until look at the turbulence that we've had in just since the presidential debate, which was a seismic political event, just June 27th. I mean, it's 3 weeks ago, less than 3 weeks ago. It's been a seismic political event like I've not seen maybe since Johnson was driven out of the race. Then you had that Loper, Bright, and immunity decision. That was the 28th. The Supreme Court had the decency, unlike Judge Cannon, to wait until after the debate to issue their decisions. The Chevron decision, the immunity decision, that was the 28th and the 1st. You had the delay of the Manhattan sentencing of Trump. I believe Trump will get a sentence of jail time not to be served immediately. That was delayed. Shortly thereafter, you had the French election results where they reversed. I'm going to come back to that because I don't think the 2024 election is a foregone conclusion. You had the Trump shooting attempt just Saturday, and the Mar-a-Lago documents case today, together with the appointment of J.D. Vance. I've just released a long essay on J.D. Vance and the threat to autocracy that he represents. He once correctly denounced Trump and acknowledged all of these political and economic risks. He was a vehement opponent of Donald Trump. He swung to a very different position. By the way, I should tell you, I worked, believe it or not, this might shock you listening to my assessment of and we'll talk a little bit more about the global situation. I worked on the Donald Trump presidential transition. I have a series of disciplines, specialties. I always help with presidential transitions. I was the Deputy General Counsel of the Obama presidential transition, and I volunteered, and they took me because I felt that was my duty as a patriotic American, just as it's my duty today to sound the alarm. That's what we'll be doing at this summit next week in a bipartisan way, this risk of autocracy.
And so I think that's a good point, that you're not anti-Trump, but you've been called the ethics czar, Dr. No. You've gotten a number of different names because of the stances and the work that you've done around anti-corruption, importantly. And so I have a question for you with regard to how CalPERS, as fiduciaries and stewards for over 2 million pension beneficiaries, and as a leader, we talked about this morning the importance of the leadership role that CalPERS plays in sustainability with the 2030 plan and the capital being deployed and the very forward-thinking steps that they're taking there, as well as labor principles and private equity. What could CalPERS consider actually doing in the current political environment of increasing uncertainty? You have a very interesting 7-part toolkit that you have that are actually similar thoughts around engagement and thinking about political uncertainty as something that could be measured and actioned.
The first question is to ask, is this a systemic risk? What does this risk mean to our fiduciaries? And to honestly grapple with that question. CalPERS is always at the forefront, as you've been on so many issues, as you are on climate change. So depending on what the answer is to that question, if I can have the next slide, our Brookings project, these will all be familiar to you, but the Brookings project that we've been doing all these years has come up with 7 principles of stewardship, adding U.S. political risk to the factors assessed in asset allocation and other stewardship decisions, issuing an explicit statement depending on your assessment of the risk of democratic erosion, engaging your leaders in engagement, so asking board directors and executives, starting that conversation, that can be part of your information gathering. Whatever you believe, whatever your politics, we should all believe in free and fair elections and the independent functioning of the courts. Some business leaders, not enough, have spoken out about that. I mean, we can't have the abandonment of both the truth and evidence of fact-based decision-making and of the law that we saw in 2020. I was on the other side of a lot of those cases that baselessly attempted to upend the legitimate choice of American voters. So supporting business leaders who speak out. Certainly transparency of corporate lobbying expenditures and corporate contributions. Do they track with these values? Again, depending on the assessments you make. What will bodies like CII, ICGN, others do to highlight political risk? And then, of course, frameworks of pass-through voting, expressions of wish, proxy, and other forms of activity. So there are voting options that track political risks together with other considerations that CalPERS has determined are material and systemic for for the people whose money you steward and protect. I probably could have done more than 7, but that's our best effort. It took us a while to boil them down. And I wouldn't expect anyone to immediately go from this analysis to action. So I really do want to emphasize that there's the threshold question, the simple and the most fundamental thing that you can do. And the reason that we've built all these materials at Brookings is so that decision makers across the board, I have a similar talk that I gave to state legislators last week. There's a similar conversation that I have with faith leaders or military leaders. But you really are at the forefront of the definition of capital stewardship and fiduciary duty for the 21st century. So I thought it was appropriate, since I was invited, to frame the question, and then, depending what answers you come to, some of the next steps that are possible.
We've talked about things that can be done. I'm curious to hear your views on the current global trend, and then CalPERS' pursuit of the 6.8% return for their pension beneficiaries. U.S. markets are obviously up 18%. I think we expect that it's going to be flattish for the rest of the year. But that said, I think there's a general concept of this lasting U.S. preeminence. And I guess the question is there a risk to the U.S. or the home bias that many pensions have in their portfolios, or is this something that will simply blow over in a matter of weeks?
If I told you I knew the answer to that question, I would be lying. I'm long-term bullish on the United States because in the way we've driven not just our own prosperity, but global prosperity through our commitment to democracy in all of its dimensions. People say to me, is this the worst, Stephanie referred to this, is this the worst crisis since the Civil War? I say, well, you can't discount the institutionalized injustice of Jim Crow that we lived under for a century after the Civil War. So, but we're still striving to overcome that. One of the reasons my law school friend, he's still my friend, I just was with him in Chicago, President Obama, is such a inspiration to me, is because he talks about America constantly being in an act of becoming. So I'm long-term bullish on America, but I do believe that we are going to face a material risk of short-term turbulence that we need to mitigate together. In the first instance as citizens, but then in our professional roles, including in the stewardship roles that all of you have. As we look around the world, the problem is that if you're going to reallocate investments from the United States, where are you going to put them that is immune from this bug? It's like the revolutions of 1848 in Europe. Why did they? It was before social media. Even I'm aware of that. Why did they spontaneously break out everywhere, all over Europe and indeed around the globe? There are these zeitgeisty moments, and the attack, I think the disintegration of the post-Cold War democratic consensus and market consensus, because some of these threatened Trump economic moves are anything but conservatives. And that's why I have predominantly conservatives who are coming to this summit next week in Manhattan at NYU. They're concerned that there has been, the far left, I don't want to only focus on the far right, although I think the threats are asymmetrical. There's also a lot of skepticism about this market consensus that I think has delivered so much prosperity since the end of World War I on the far left. And certainly those solutions like attacking the independence of the Fed, that I believe very deeply in keeping the Fed independence. Don't you think, though, that Biden and the left would have loved to have some injections, some more injections, some rate cuts earlier in the year? But it comes at an inflationary cost. So there's no, there's just as there's no monopoly in the United States on eroding that consensus, and the left refers to the uniparty that manages affairs in the United States. There's really, it's challenging to find another zero-risk safe haven should the United States be destabilized. I mean, are we going to invest in China and Russia, where you're seeing a severe erosion of market freedoms, protections for capitalist actors? Are we going to put our money in France or Germany or the Netherlands, where right-wing parties are resurgent, a similar autocratic threats you have here? I know you don't want to invest in Hungary, because if you look at the effects of the autocracy there, probably the best model for what Trump would do here if he were given free rein, if it really is open season, as the Supreme Court and Judge Cannon seem to have decided. All of the indicators are down: GDP, brain drain. The population has shrunk by millions under Viktor Orban. So it poses a set of challenges, particularly given the size, the sheer size of the United States. That's the reason that these 7 principles of stewardship are so important as you consider, I suppose inviting me was a part of that, as you consider how should we respond to protect our investments here, because there's not an equivalent place to put them. I know I happen to have it with me because I'm going to ICGN. I ain't giving that up. I'm staying and working for the kind of democracy that I want. And I guess that is my not very subtle pitch to all of you, because there's really no other place for the money or for all of us to go.
I'm going to ask one more question, then I want to open it up to the audience, because I think I'm assuming there'll be lots of interesting questions, and we can also talk a little bit about the global elections as well. But the other area that you've spent a lot of time on, and that is very top of mind for people for many, many reasons, is AI. You've done extensive work at the Brookings Institute, and there are some unique things about AI and the way that it plays into 21st century social forces. Obviously very expensive, obviously has an impact on energy and water usage, but can also be a real solution to some of the world's greatest problems. Are you optimistic or pessimistic about AI? And what role does it play in democracy? Is it going to help us preserve it or further destroy it because of potential manipulation?
There's certainly market risk and existential risk associated with AI. I am bullish. I admitted my methodological bias to you up front. The legal commentator, Jeff Toobin, jokes that I never saw a glass that I thought was half empty. They're all half full. I lead a project on AI and democracy at the Brookings Institution, where we bring together about 70 people from all over, principally US, but really from all over the world, government, business, technologists, academics. We develop ideas. I didn't put it in the deck, but we had the idea of a public option for AI, a kind of NPR for AI, because a lot of the architecture of AI is affected by the commercial choices that are being made in developing the models. But I do think that if it's properly managed, that AI can be a boon to human productivity. One of the things that we do in this program on democracy and AI is we try to identify gaps and fill those gaps with good, broad-based research that takes account of corporate imperatives, but also those other dimensions of social expertise. So we developed, if I can have slide 16, please. We developed a set of best practices for state election officials. Our state election officials were buying AI packages, totally disparate, 50 states plus the District of Columbia, the territories, all with their own regulatory schemes, statutory schemes or lack of statutory schemes, all going their own way on AI, and nobody had done best practices. That's an example of the kind of thing we do. If I could have the next slide, please. But I think the best practices that we gave you, it's a little small if you have old eyes like I do. I think the best practices that we did for the officials are a good rubric for what we need to do. The most important is probably number 2. I should make it number 1. Ensure that humans are always in the loop. The greatest dangers from AI, I am not a technologist, but I talk to the MIT and Caltech and Stanford, and those people are in my group. my friend, Congressman Don Beyer, we were ambassadors together. He was ambassador to Switzerland. We worked on the Obama campaign together. He's now a congressman. He went to learn how to program AI as part of doing his legislative work. He's on the congressional because he feels like you should know the technology. I would like to do that, but I'm too busy. He's taking night class. He's getting a master's degree in AI programming. The greatest danger comes when AI systems are not subject to human supervision, and particularly when they have interactive power with other systems. And that is, we have very specific advice when election officials are purchasing AI systems about what they can and cannot allow them to do. So you've got to keep humans in the loop. We have to have a robust social dialogue. That's principle number one. I guess asking the questions, like I'm asking the threshold question to all of you about autocracy today. That's always where you should start. And then there's a variety of other things. If the best practices can be followed, and if we can avoid the distortions that come from purely market-based solutions that do not take a broader view of stakeholder interests, then I think AI can be a net boon. And I certainly think that I'm integrating it into everything I do. Again, I don't have time to do it. I'd love to write a book, The Year of Living AI, where I just do everything. I've written 6 books. I like writing books, where I just do everything with AI for a year, and I talk about what it's like at my work and at home. I told this to my wife, who said, "You are not bringing AI into my kitchen." I'm a believer, because it will improve human life, and I think it has the potential to accelerate some of those trend lines that we saw in all the measures of human prosperity and sustainability. We've talked a lot about climate change and your stewardship work related to climate change as an example. I really think it's a model nationally and for the world. I'm going to talk about it when I give my ICGN speech on Wednesday. And obviously, we know the downside risks of runaway technology. And when John D. Rockefeller initiated the carbon revolution in the Pennsylvania oil fields in the mid-19th century, nobody envisioned the devastating long-term effects. So we do have to very carefully monitor the downside risks. But if we do, technology can work for us. We started with climate change. Hopefully it will not be too late. And we're starting early with that human supervision of AI.
Terrific. Why don't I open it up to the board and the audience for questions?
So thank you, both of you. Stephanie, Ambassador Eisen, I don't have this in front of me. Oops. They're going to get mad at me in the back. Our first person who wants to ask a question is Controller Cohen.
Thank you very much for a very exciting presentation.
The controller told me I had to warm up the crowd with jokes, so
and I didn't
I
lead you
took your
astray.
advice.
Right, you did. So my compliments. Question, the 7 principles that you had on the screen, we don't have that in our packet. Is there a way that we can get a copy of that, or do we have to go to the Brookings website and then have our...
Good Lord, you deserve your responsibility to the pensioners of California if you can navigate your way through the Brookings maze to those 7 principles. I'll get the deck. I saw folks taking pictures and jotting notes.
Yeah.
So there's nothing in that deck that's a secret of state. I'll get the deck to everybody, and I'll come around and shake hands and trade business cards and whatnot too, but I'll send it to Teresa and she'll make sure everybody gets it.
Okay.
We're proud of those 7 principles of stewardship. It took us a while to boil them onto one. They kept giving me like long lists. I'm like, no, I got to get them onto one slide.
Well, the 7 principles of stewardship actually is actually very applicable to the work that we're doing here as we continue to, particularly the governance committee, evaluate investment and investment opportunities. In addition to maybe the 7 principles of stewardship, we probably would add, we have a list of work, what is it called? Labor principles as well. That's not on this list, but we should probably add an addendum just to incorporate that.
Should I add?
Yes, I think you should.
Let's talk.
Okay.
Let's talk.
So, appreciate it. I want to, I think I had 2 people. I have Lisa and somebody else raised their hand. I thought I had 2 people. Lisa, go ahead.
Ambassador, thank you. A couple of autocrats that you didn't address today. What would be your advice with regard to China and Russia for those of us who are institutional investors?
Lisa, I think I took a passing body slam at China and Russia, but I did not go deep. I believe that I haven't thought about China and Russia from an institutional investor perspective, only from a political perspective. I always believe in continued engagement, even when the situation seems dire and you risk validating or authorizing heinous autocrats. There always needs to be that engagement. My first response to the Russian attack on Ukraine was to write an op-ed with Ambassador Dennis Ross, the great Middle East peacemaker of presidents of both parties, on what the outlines of a Ukraine-Russia, when Russia seemed to be still on the road to Kyiv, what would the outlines of a peace negotiation look like? And I think it's still what the eventual peace deal will look like. I think it will come. Let's hope it takes years and not centuries, like the Irish-British rapprochement. So point 1 is remain engaged. The form of that engagement has to be, point 2, has to be totally candid, diplomatic, but totally candid. China has, I think it was a terrible miscalculation. Again, I've talked, because the rise of autocracy is asymmetrical, I've talked more about right-wing risks in the United States. But I think that the admission of China by the Clinton administration to the WTO, the basically unconditional admission, and no kind of a phased or staged accession or commitment to democracy. And then the UK saw what was happening, and they did it all over again with handing Hong Kong back. You know, we have to be very clear-eyed in our engagement with autocratic nations like Russia and China. I do think that there is I do think that there is a role for those who are so inclined to maintain some type of a indirect economic connection to Russia. Here's where I really bifurcate on Russia and China, because of course we're wedded at the hip. A lot of that 60% of foreign holding of American currency that I was talking about is Chinese holdings. And it's not just our currency, as you know, it's a very diversified set of positions in the U.S. economy. And if China wanted to, it would be very devastating to them. It would destabilize the world. They could embark on punitive and retaliatory measures against the United States. Russia is a totally different creature. and its size and its importance. So, you know, in China, we need to maintain forms of engagement. As the child of a Holocaust survivor and a Holocaust refugee and undocumented migrant, that's why those 10 million plus, some say 11, some say 13 million migrants that President Trump is threatening to put in concentration camps. That's why I take it so personally. You know, I think we needed much blunter engagement with China over the genocide of the Uyghurs. Then that should have been a global scandal. So I think we have to be candid with them, but we need to use a variation. Controller, we should work on a version of this for dealing 7 principles of stewardship. Now will be 8 because we're going to add a labor principle for dealing with autocratic regimes, for dealing with our investments in autocratic regimes. So those are some initial thoughts, Lisa, but I do not, even if we should disinvest from Russia, certainly. China, we can't, but don't I would say, disinvest, de-escalate, moderate, but don't disengage. We must keep engagement for the sake of not destroying us all. These are 2 powerful nuclear regimes.
And Modi was in Russia recently, right? And I think the general concept of the global south is an important one. There have been some interesting election outcomes there, but are we paying enough attention to the role that the global south is playing in the whole geopolitical dynamic?
I was so fascinated. I was very quick to pivot to the Ukraine conflict in my Brookings work. I love to use it's like we have massive data models that consist of the brains of all the Brookings, hundreds and hundreds of Brookings fellows. So we pivoted, and I like to do these comprehensive projects like that American Autocracy Threat Tracker, which literally has thousands of autocratic threats that have been made across 22 categories that you saw in that one slide and then a whole chapter at the end on solutions. Hundreds and hundreds of solutions are in there, including the role of institutional investors, if you Google it, or I send the link to Teresa so everybody can just have it. There's a section in the solutions talking about institutional investors linking out to resources. And the response of my friends, the big thing that we did was a comprehensive tracker of all the Russia sanctions. It was the only one in the world where we tracked them all in real time. Banks, national banks, and financial institutions from all over the world were coming to Brookings to assess sanctioned individuals and firms in Russia or doing business outside of Russia. 60 Minutes did a whole story using the architecture of our sanctions tracker. So I pivoted to Ukraine, and then I worked furiously on Ukraine for a couple weeks. My wife likes to joke that I'm the policy equivalent of those tornado chasers. Twister, did you ever see that movie, Twister? That's me. Like the policy, what is the policy issue this week? And then I started talking to my friends in the global south, and they said, that's a first world problem. It's a Western transatlantic issue. We just don't care that much. And they reminded me of all the issues that Brazil, we'll talk about Brazil at the ICGN. I have a panel. I'll have Sandra Guerra talk about the Brazilian example of autocracy. David Pitt Watson from formerly of Hermes, I guess before it was Federated Hermes, will talk about populism in the UK and the response. Karina Litvak will talk about Italy and France, and a series of other speakers, and then I'll talk about the U.S. and moderate. And the issues are different for the global south. I will say the one issue I work on the most, and it's a big Brazil issue. If we're going to talk BRICS, it's a big issue for all of the BRICS. is corruption and the terrible cost of corruption. We run a big project, the Anti-Corruption Democracy and Security Project, where we actually do field work all over the world. What are the solutions? Because as a congenital optimist, I always want to find the solution. So my Global South friends are interested in a different set of issues, but they also care deeply about autocracy and would not like to see the United States slip into the kind of autocracy that has characterized some of those tragic histories. And Modi is his own story of autocracy. And for those who've, Lisa, if we wanted to include India and Brazil, for those who hung in there, right, that, we've seen major pushback on autocracy in Brazil and India. I would argue Brazil handled its January 6th far more effectively, efficiently, and speedily than the United States did ours. Those are some not very organized Global South thoughts and anecdotes.
So I'm curious. So first of all, I want to tell you to say hi to everybody at ICGN because I'm supposed to be there, but this board takes priority. But secondly, I think it's interesting. I've been doing some reading, and it seems like this is going on all over the world. It's in an upswing. There's a lot of thought behind whether or not that's because of the failure of neoliberalism, which is causing this risk for us. But in any event, we saw it change in France, like overnight, right? And in Great Britain. So I guess my fear is that Great Britain not necessarily, but France definitely knows what fascism was like, right? They were occupied. So I guess my fear is that this country has never been occupied. So do we have, are we going to, you say your cup is half full, and I wonder if that is the case and whether or not we have this huge risk on the horizon.
Will you accept a friendly amendment to the question, and then I'll answer it? We did experience a form of occupation, of course, in 1776, the War of 1812, when things deteriorated with the British. They did burn the capital.
True.
You can still see the singe marks in the sub-basement if the architect of the Capitol takes you around. And then, of course, in a sense, the Civil War armies of the South came and did occupy territory. I always return to the historical parallels, but with those friendly amendments, I think the United States is well aware, the people of the United States are well aware of the risk that democratic backsliding, advancing illiberalism, the threat of autocracy represents. And I think we have some data to suggest that. We know that democracy is one of the top issues, together with the economy and immigration, in poll after poll. We've had what I view as 3 referenda on autocracy in the United States, the elections of 2018, 2020, and 2022, in which democracy outperformed. Sometimes in 2022 came as a shock to all the experts. Definitely the election of 2020 was in part a referendum on some of the autocratic rhetoric and action of the first Trump administration. The same with 2018. The election of 2024, without taking a partisan perspective on this, I think will be determined by whether it is an election about, is it a referendum about Trump and Trump's autocratic leanings and other shortcomings, or is it a referendum about Biden and Biden's age and other shortcomings? That question really possibly for, the polls have been weird post that debate that I pointed out to you, because first we saw backlash, but now we're seeing a trickle-back effect. I don't know what effect the shooting attempt will have, the appointment of J.D. Vance. J.D. Vance has become a very hardened autocrat. I released, as I said, a paper on him today.
I'll get it to you guys. He sent it to
I sent it to Teresa right before I started. It just popped an hour ago when they announced J.D. Vance. Yes, I had one on every vice presidential candidate. Yes. So I released a big paper on J.D. Vance and a bunch of others because I take the autocracy threat seriously. So I think the American people don't want to go down that route. The failure of neoliberalism has not been, in my view, a policy failure, although another, to be balanced. The complete or the substantial omission to think about the costs of globalization for the American heartland and the Rust Belt, the explosion of prosperity for our billionaires, for our coastal elites, and
all over the world.
All over the world. But also there has been a globalization of wealth. If you look at the trend lines, they've accelerated post the neoliberal peak of Clinton and Summers. Larry regrets it now, by the way. Some people thought he was just doing that to get in the Obama administration, just saying that because Obama represents a new kind of consensus. But I met with him constantly, and he's since shown that he's a true believer. Although he has some anti-neo-Keynesian tendencies that he demonstrated with his reflections on inflation. They proved to be more apt politically than economically because of the soft landing we've had, that shock treatment. We needed those electrocardio shock paddles to get out of the COVID recession, and it worked, and we've had a soft landing, but with high political consequences. And that's what I wanted to say, Teresa, in my view. The failure of the neoliberals, the democratic neoliberal elite, to recognize the cost in our country, and then the knock-on effects to the hollowing out of our communities, the loss of jobs, the undermining of American labor, the effects that would have on the social cohesion and integrity of our communities, and then the things that have followed from that, like the opioid crisis. That is a political failure, and the thing that neoliberalism is lacking is strong. Strong policy spokespeople and guides to shape. I actually think Biden's stewardship of the economy, his legislative record, it's superb. Best since Johnson. I said that to Obama. Inadvertently, I just let slip. We were talking. I'm like, it's the best since Johnson. And he gave me a look. He gave me a dirty look. I said, well, what do you want me to do, lie to you? It's been superb, the economic handling. The Fed has been very good. Michael Barr has been a steady hand there. My colleague on that Great Recession Daily Committee at the White House, of course, Jerome Powell, has been excellent. But we haven't figured out how to talk about it. And part of that is our leaders. You can't learn politics. You can't go to school to be a good, innate politician. What Trump did when he was injured, he said he was shot, but I think it was the broken glass. The bullet missed the glass. It cut his ear. It's a shocking lack of medical information when you compare that to the amount we discussed Biden. I'm not suggesting that it was any kind of conspiracy. It was a genuine, crazy person, evidently of conservative antecedents, who did it. But what Trump did in that moment, just the native political genius of seizing that moment in the way he did and creating that image, a new Iwo Jima image for his followers, for the history books. You can't teach that. We haven't had, for the neoliberal consensus that I more or less continue to embrace. I am a neo-Keynesian. I think you can just continue with priming the economy indefinitely, but more or less. But we don't have neither the right policy guides nor the right spokespeople for that consensus. I do think the Biden administration has done a good job on the policy front. Total flop on selling it to the American people. The world looks at us. They see our economy and their economy, and they can't understand why Americans don't see the extraordinary job of stewardship that this administration has done.
I have one more question from one of my fellow board members. Thank you for that answer. I know that was more political than economic.
But I cast shade, cast aspersions through shade on both sides.
That is okay. I agree. So our next person is Jose Luis Pacheco, and then I think we need to wrap it up.
So first of all, can you hear me?
Yes.
Okay, great. So first of all, thank you very much, Ambassador Eisen, for your presentation. I really appreciate this. Has been.
He's thanking me profusely. We have to have that well amplified.
I'm now, it's been brought to me. So, anyway, I've been reading this book. I bought it from, it's Dr. David Sagner, the New Cold War, China's Rise, Russia's Invasion, and the American Struggle to Defend the West. And I'm starting to read it. The premise is basically that we had thought that China and Russia would come to our terms on Washington terms, but it appears that after five presidential administrations, they've kind of done their own thing, and now that we're struggling as on the West side to can maintain our democracy, and and China and Russia are taking advantage of the situation. And I just wanted your perspective on that. First of all, on the book, and if you have read the book or not.
I have.
And also how that is going to play in terms of our of the marketplaces and the economy in general. So that's basically, sir. Thank you.
And Teresa, how long do I have for this answer? I don't mean to strike terror into anyone's heart. I want to keep you on time. 3 minutes, okay. Can I have the slide again of the hamburger stand? Is that too hard to do? Yeah, there we go. David Sanger is a friend of mine. He's a fellow CNN contributor, and we are friendly acquaintance of mine. I never imagined when I was growing up in the hamburger stand that all the people I see on TV or who occupy the White House, or that we'd have a president when Biden, I had meetings with him constantly in the White House because he was working on the economic stuff. And periodically he'd run his hand. He's a very touchy-feely, in a nice way, affectionate guy. And he'd run his hand over the top of my hair and he'd say, "Norm, if I had hair like that, I'd be president today." So I never imagined when I was in the hamburger stand that I would be friends with brilliant authors like David Sanger, the New York Times columnist, my fellow CNN commentator. Having used up 90 seconds on that preface, Jose Luis, I think that we have failed in doing the kind of long-term strategic thinking that I have tried a little bit to share with you that my day consists of at the advanced age of 63. I think all day long about, okay, what's over the horizon, what's after that, and what should we do about it? Administrations of both parties, as David explains in this book, have failed. I was there with President Obama at Prague Castle. That was that trip on Air Force One that that's where I started. It's a good place to end. When Obama flew to Prague Castle and he met with then Russian President Medvedev, the chair warmer between Putin Term 1 and Putin Term 2 to sign START 2, the New START Treaty, in the splendor, the glory of Prague Castle, the last seat of the Holy Roman Empire. And when he talked his hope of denuclearizing tactical nuclear weapons, very dangerous, stationed across the nuclear continent, the faith and belief that he had. And I write about this in my book, The Last Palace, the first and my favorite of my 6 books, about flip to slide 2, please, which is about that house. This is where Stephanie and I started, that ambassador house, and the people who moved through it, the optimistic Czechoslovak Democrat who built that house as a tribute. He thought democracy 1,000 years after World War I, and the Nazi general who supplanted him, the Wehrmacht general, the American ambassador who came in there. He saved the house and he lost the country to communism. Shirley Temple, your Northern Californian who was there in '68 when the Russian troops invaded, and then again in '89. She was in that house when the Russian troops invaded, and then again in that house as ambassador in '89, as a visitor in '68, ambassador in '89. I'm over my 3 minutes. And I tie that story together with my story and my mom's story as a Czechoslovak. That house was built by the richest Czechoslovak Jewish person, and my mother was the poorest Czechoslovak Jewish person. So she was so amazed. Oh, you live in Otto Petchek's house. When I got to that house, I had one view of Russia. And after I'd been there 3 weeks, I had 180 different degree view of Russia. They had an embassy of 1,000 people with like 20 diplomats and 980 espionage officers. They were on the march using disinformation, economic power across Europe. And I sat with, he became one of my great teachers, the great first Czech president of the post-communist era, Václav Havel, President Havel, the great playwright, and saw the country, the end of communism, and he said to me, "Wake up." And the other one who said, "Wake up," was my mother. She said, "Wake up. Your American optimism is deceiving you, and tell Obama." And I went back to the Oval Office. I did. I told Obama, I don't think it's like we thought it was. And he's like, "Have you got native already? You've only been there for a month. You've already drunk the Kool-Aid." But of course, Havel and my mom were right. Russia had malign plans. Putin had no intention of denuclearizing whatsoever. So I agree with David Sanger now. I think we have to be very clear-eyed, but that doesn't mean disengagement. It doesn't mean political disengagement. Lisa, doesn't mean economic disengagement. We need that that stewardship goes for political stewardship too. So I shamelessly abused, Nancy Pelosi, the Speaker of the House has the magic minute. They get 1 minute to talk on the floor of the House, but the minute extends until they're done. That's what I did with my 3 minutes.
Sorry. I have one of our stakeholders would like to ask you a question.
Yeah, you mentioned that,
Introduce yourself, Al.
pardon me?
Introduce yourself.
Oh, Al Darby, I'm with the Retired Public Employees Association.
Hi, Al.
The question is, you mentioned that you're trying to fight corruption down in Brazil. Seems to me we might have a bit of a conflict now that the Supreme Court has legalized bribery.
Yes. When I was ambassador, Al, first of all, I want to join the Retired Public Employees Association because, as you can see, I actually have the word retired in my official title. And I know my wife would love it if I lived up to my title. She's like, "Not again, Norm, not again." Another one of the terrible Supreme Court cases this term, and it's a trajectory, said that illegal gratuities cannot be prosecuted under the existing statute. and you can actually give gratuities to public officials, and then you, as a contractor or what have you, can get benefits, and there's no illegality there. It's shameful. It's shameful. The worst corruption in the United States is the legal corruption. And I would always say when I was ambassador, and now it's really true, I would always say, look, they'd say, the United States, how can you sympathize with my problems in Czech Republic or the other countries I would travel to? I'd say, oh no, we're on this road of democracy and free markets, political freedoms, personal freedoms, market freedoms. We're on this road together. And you can learn from us, but we can learn from you too. But boy, is that we haven't talked about the NATO summit we just had in D.C. But boy, is that true now, because on one model of how things go in the United States, NATO and Europe may become, for the first time since 1941, the foundational guarantors of democracy in the transatlantic relationship. And that anchor on the two sides of the Atlantic is really the anchor of democracy in the world in many ways. So Brazil, we have little ground to preach to Brazil, but we can learn together how to deal with corruption. I will say that both political parties in Brazil have taken more than their fair share. I personally prefer Lula to Bolsonaro, but both of them have had plenty of corruption allegations.
I want to thank you very much, both of you, Stephanie, Norm. Thank you. It was a great panel. We are
Thank you.
due for a quick break before we go into proxy voting. So if anybody wants to grab Ambassador Eisen for a minute, go for it. We have, it is 3:22. I'm just going to say 3:40. Is that 20 minutes or is that 15? 18. Be back at 3:40, everybody. It is our last session. It is on proxy voting, and I would like to introduce Samiso and Drew to take us away for the afternoon.
Thank you very much. Hopefully everyone in the back can hear me. Drew Hambley with the Investment Office. We're going to get into some of the sausage making of proxy voting. I'm going to start with an apology. This topic is much drier and much less interesting than geopolitical risk, and that's going to be a tough act for me to follow. What I will try to do is I'll try to keep the slides in order, and as you see us go through this presentation, I think you're going to see how our stewardship program, which includes proxy voting, aligns nicely with the ambassador's slide 22 on the 7, soon to be 8 principles of stewardship for asset owners. Can I have slide 2, please? Okay, so I think we've all seen this before. When we talk about the stewardship program at CalPERS, we're really focused in on our active ownership duties of proxy voting and engagement. So we're going to focus mostly on the proxy voting in this session, but I will be touching on engagement. Slide 3, please. So this is just a quick overview of the team that I lead. There's 6 of us in total. What I would like to highlight is, unlike some of our large asset manager friends who have big teams, we're blessed with a lot of experience in the proxy voting arena. If you just look on a team average, we have about 16 years per person average in proxy voting and engagement experience. So we're small, but a very experienced and dedicated team, and some of my team members have been with CalPERS their entire career. Slide 4, please. So we have some governing documents that oversee the work we do. It starts with the total fund investment policy, the CalPERS investment beliefs, the governance and sustainability principles, and the proxy voting guidelines. Today I'm going to spend most of our time talking about the one on the far right there, the proxy voting guidelines, which is the desktop procedures that we have to handle the more than 650 different types of resolutions that the team sees every year. This particular document is reviewed on an annual basis by the proxy voting team. Any changes that are made to it are run through the senior leadership team at CalPERS and then presented to the investment committee meeting in March. Next slide, please. So just a little setting on, what is the size of this program? So when we were preparing the slides, we had our March numbers. We have over $200 billion in equity assets. It's spread out over close to 6,800 companies. And so what that means is the average holding that we have is about 20 basis points or 0.2% of each company that we own. We go from 1 basis points. There's a handful of companies where we have up to 2% ownership. Why is that important? So if you look at a BlackRock or State Street, they might be a top 5 shareholder in every S&P 500 company. For us, we're usually in the top 40 shareholders. So we're not the biggest. The overall size of the equity book is very large, but since it's diversified over 6,800 companies, we average about 20 basis points in equity ownership per investment. Next slide, please. Okay, we're not going to spend a lot of time on this, but we're going to talk about sausage making. This slide represents the global chain of custodians, proxy advisory services, asset managers, asset owners. This is how we get our proxy. This is how we work with our banks. I just put it up there to show you there's some complexity in the operations of voting at 6,800 meetings or companies a year, about 9,300 meetings in total. Next slide, please. So what do we vote on? So the figures I'm going to show you are from the 2023 proxy season. They're very representative of the proxy season that just ended on June 30th of this year. So when we think of proxy season, we think of March through June, where we do about 70% of our proxy voting volume. So to have the slides ready in time for this session, we just use the 2023, but they're very representative of what we'll bring to the investment committee in March for the 24 season. We spend a good deal of our time voting on directors, and we're going to go through each of these and what we do. So about 70% of what we vote on is the election of directors. One topic that gets a lot of airtime is shareholder proposals. And I just want to remind everybody that's about 5% of the proposals we look at the U.S. It's very small. It gets a lot of attention. And we spend a lot of time reviewing them, but it does make up a small portion of what we vote on each proxy season. Next slide, please. So down at the bottom on the guidelines, we're going to take you through today how we think about director elections, proxy contests. We're going to spend a little extra time on executive compensation because I know that's come up a lot in previous discussions we've had. And then we'll touch on ESG shareholder proposals. Next slide, please. Okay, so in the election of directors, we have two pie charts here. The first one is how we vote on non-U.S. Directors, and you see we vote against directors about 50% of the time. And that is very different than about the 25% of the time that we do in the U.S. So what makes up that difference? A lot of it is markets outside the U.S. that have boards that are much less independent than what we would find in a G7 country board, U.S., Germany, France, England, for example. In Japan, for example, about a third of the board members are independent, which is below our principal standard of at least majority board independence. So outside the U.S., we do tend to vote against directors more, primarily because of independence issues, other things as well. One of the things we focus on through this program is, board independence, board oversight of climate, board oversight of human capital management, and executive compensation. And so when we see something not aligned with our principles and our proxy voting guidelines is when we'll cast that vote against. Also, there's idiosyncratic risk that happens every year. We see companies that stumble and fall, and our guidelines are sufficient to address. We can vote against a director anytime we see something that is not aligned with our investment beliefs, with our governance principles. And sometimes you'll have, a company that has a misstep, and we'll use that opportunity to hold directors accountable, even if it's not one of these traditional board independence or compensation issues. So we can use that tool, and our guidelines are, robust enough that we can introduce the vote against when necessary. Next slide, please. Okay, so we'll talk about, a couple of examples here on companies and how we apply this policy. So one of the things we've done over the last couple years is holding directors accountable for their oversight of climate risk. We have curated a list of about 350 companies where we apply this policy, and those are the 350 top emitting equities in the portfolio. And so we work with various partners to gather the data, and then we look for 7 different metrics at each of these companies, and they have to pass all 7 to get a vote for. So last proxy season, for example, Chevron missed on at least one of those 7 metrics, and we voted against the board members who sat on the committee that the committee charter said they oversaw climate risk for Chevron. And so in the 2023 proxy season, there were 106 companies where we voted against directors out of the 350 that did not meet all our criteria. And I think we'll see similar numbers in 2024. Then on board composition, human capital management, so we spend a lot of focus on board succession planning and boards casting a wide net to find good directors. When a board has a robust process of succession planning, they're going to find candidates that include diverse elements, whether it be gender, whether it be ethnicity, all sorts of skill sets. So what we're not looking for is the existing board just to go down to the country club and pick one of their friends out. We want them to have a robust process. So we have high standard of director diversity. And so, for example, at Ford Motor Company, they did not meet our standard, and so we voted against the members of the Nominating and Governance Committee. We also will engage with these companies when we do this to tell them why we did this, what our expectations are, what they can do to improve. And so that's how we handle, the DE&I at the board level through the director election. And I talked about board oversight when companies stumble. So some of us may remember back in Christmas of 2022, Southwest Airlines had difficulty getting planes off the ground for about a week and had trouble finding their employees. And so we saw that as a failure of a couple of things with the board, partly their capital expenditure policy, which was highly focused on share buybacks and not reinvestment. Matter of fact, 3 weeks before this incident, the new CEO had come out and said, hey, we know we have a technology problem. We're going to spend $1.5 billion to try to fix it. Unfortunately for him, this incident happened right after he made that announcement. So we were holding directors accountable for what we saw were years of capital allocation that was short-term focused and not long-term invested in investments into the company to make that airline run as efficiently as possible. So while it wasn't strictly covered in the guidelines, it was an event. We saw it as an oversight failure of the board and senior leadership, and used that director vote and the engagement to talk to the company and hold those board members accountable. Next slide, please. Okay, executive compensation. So this gets a lot of focus. As you know, coming out of the financial crisis, the Dodd-Frank bill mandated that U.S. companies had to include what we call a say-on-pay vote at the annual meeting. Generally, most companies have an annual now say-on-pay vote, and that started in 2011. What we've done is we try to focus on 2 areas. One is a quantitative approach to reviewing the pay package in relation to the company's peer group. And then there's a qualitative element. I'm going to walk through each of these bits. And the qualitative element will look at things like how long-term view is the plan? Is it too short-term focused? Does it have protections, no golden parachutes and things of that nature? So we use a combination of the qualitative and the quantitative to make a vote on the pay package itself. And then when we vote against the pay package, we also vote against members of the compensation committee. In addition, we endeavor to, especially with our largest holdings, when we do that against vote, we will reach out to the company and explain our methodology on why we did that. Next slide, please. So I'm going to take us through the quantitative elements. So you'll see in the top here, we have this P for P score, and you'll see realizable pay and grant date fair value pay. I'm going to talk about those two elements. And there's a third element that you may have heard called realized pay. We're not going to spend much time on that. Realized pay is your W-2 paycheck. The reason we don't focus in on that is because many of the equity awards, you can delay the realization of that money. And so if we focus on realized pay, we get gamed a little bit by companies who would just delay the exercise of equity options, for example. And so make their pay look much lower in the short term, when in reality, in the long term, it could be quite large. So that's why we focus on realizable pay. And what that does is it looks at the pay they can earn in the future, and it bakes in all these equity awards. For an S&P 500 company, equity awards make up about 80% of the award package. Then grant date value pay, and that's what we call the pay at T0, the pay that the board awards that day. They put a valuation on it, and we're going to go into the differences between the two. And so, every year the board will sit down, the comp chair will sit down with the CEO and say, okay, here's what your pay is going to be, here's the salary, the bonus, and the value of the options on that day. And so that is the number that gets reported in the annual proxy statement. And so we're going to look at these two numbers as we, evaluate whether this is a good pay package relative to peers. Next slide, please. So we've just highlighted a company, and not to pick on anybody, Dollar Tree, DLTR. And you can see on the 5-year annualized TSR number, they're sort of middle of the pack. So over this time frame, over the last 5 years, this particular company, when we evaluated the pay, gave us a 5.7% annualized shareholder return. Then we go to our next column, and this is 5 years of realizable pay, and we see that Dollar Tree is the second largest in this bucket. And so this will generate what we call a negative score in the realizable portion of our quant model. And so we can see here that over the time period, for the next 5 years, they can realize up to almost $250 million when they've been a middling performer in their peer group. So that will be a negative attribute that will go as one of the factors on whether we decide to support this one or not. Next slide, please. Now we're going to look at the grant date value that I talked about. So this is the board intention. So in the previous 5 years, the board made the CEO of Dollar Tree the intention of the highest paid CEO in their peer group. We see it at $183 million. Now in the previous one, we saw $250 million of the realizable. So what explains some of that difference? Part of that is the gearing that is inherent in some of the equity awards that people use. And one of the things that we've cautioned companies against is performance stock options. And these have a gearing element that brings that realizable, even with mediocre or middling performance, up to 250 from the board intention of 183 million. So once again, we'll take the difference between how they do on the annualized TSR and where their place is within the peer group, generating another negative score. So we now have 2 strikes against this particular CEO on the quantitative element. Next slide, please. Then the other thing we look at, so the third element of the quantitative model, is the change in pay of the CEO rising faster than the change in the TSR. So the blue line, the line at the top, shows the change in value to the CEO over this time period, over the 5-year time period, versus how the stock has been doing. And so we once again see the CEO's rise in pay outpacing that of the market return, strike 3. And so in this element on the quantitative, we have 3 negative elements, so we're leaning towards voting against this particular pay package. We will factor in some of the qualitative elements. Are the awards sufficiently long-term? Are they using the right types of metrics? Do they have protections for shareholders around no golden parachutes, things of that nature? And so we'll take all that together to decide whether we will support or not support. In this case, we did not support, and the quantitative model plays a big role in how we evaluate these. We do about 1,200 of these a year in the U.S. That's the size of our U.S. portfolio. And so we partner with a company called Equilar that provides us the data that allows us to build this model out. And it's been quite successful. I think we put this in place in prior to me coming, but in 2018 to be able to handle this kind of volume. So we can look at each package and evaluate it in its totality. And by having this data available to us, it allows the team, the small team, to be able to get through 1,200 of these each proxy season. Next slide, please. All right, so we go in from pay into the other hot topic, shareholder proposals. So these have been typically classified. I know ESG is a dirty acronym these days in the last couple of years, but simply put, environmental, social, and governance shareholder proposals. And as we know in the U.S., if you're a shareholder and you've owned the shares for at least a year and you own about $25,000, you have the ability to introduce a shareholder proposal. You usually have to do it 6 to 9 months ahead of the annual meeting to give the company time to review it. So there's a bit of a lag from when it's introduced to when we see it on the ballot. And so we bucket these, environmental, we look at reporting on climate change, greenhouse emissions disclosure, which we talked about earlier with the SEC rule, lobbying, reporting on things like plastic waste and such. On the social side, freedom of association, human rights standards, and then governance, some of the traditional ones like majority voting, declassifying boards, having shareholders the ability to vote on poison pills and things of that nature. So these are the typical ones that we'll see. In every proxy season, we may see, some kind of off-the-wall ones or, new proposals that we haven't seen before, but this is a good representation of the typical ESG proposals that we review every year. Next slide, please. So I want to talk about a couple ones in the previous proxy season that we voted for and a few that we voted against and what some of the rationale and thinking was around them. So we talked earlier about our review of high emitters in the portfolio, 350 companies. We had an opportunity to vote on an environmental proposal at Southern Company. It's a large U.S. utility. And this was for a request for disclosure on Scope 3. So as an investor, we want more information. We generally support additional disclosure. So whether or not the SEC rule is challenged or happens, many companies are providing this type of disclosure. And so we viewed Southern Company as lagging its peers in this type of disclosure. So we cast a vote for that and engaged the company to encourage them to produce this information themselves. Then at Starbucks on the social side, they had a proposal on adopting a policy regarding freedom of association. I think we talked about this in my first investment committee meeting. I think you handed me the question, if I recall correctly. And so as part of our principles, we support the right of people to form unions, to the freedom of association. So we're very supportive of these types of shareholder resolutions when they're introduced. And then the last one was a governance proposal, splitting the chair CEO position at Citigroup. We believe, and there's been plenty of academic research on whether having an independent board chair produces alpha. And many finance professors over the years have attempted to have written this paper. I think one of the reasons they do it is because the data is pretty easy to collect. It's a binary, do they have the structure or not? And then you can look at the shareholder returns. Depending on which time period you run and, over which times, the research is pretty muddled on whether or not it generates alpha. But one of the important things I want everyone to understand is part of our governance program here and the stewardship program is equally important is we are trying to protect beta. Right, the portfolio is designed around beta, and we do believe that having independent board leadership is a good protection to the beta risk that we assume in our equity portfolio. We're not looking to drive alpha with this, but protect the drawdown risk or the beta risk of the company. Generally, when we support these, we will talk to the company. We generally don't argue for them to eliminate it that day. So, for example, Jamie Dimon, well-known JP Morgan, he holds both titles, chairman and CEO. JP Morgan gets that proposal from time to time. Our engagement message to the company is next time that seat changes, that would be the appropriate time for the board to revisit that structure and hopefully adopt an independent board chair. We don't get very far trying to take away the title from the person who has it, but we often see through engagement supporting these types of proposals, we have started to see a slow change of companies rethinking that when the seat changes and that CEO retires. So we will support these, and if we've done it once and had the engagement, we may or may not support it again in the future, but we've made our message clear that at the next changing of the guard, we hope they will revisit that. So these are, three typical examples of an E, S, or G proposal and why we supported. Let me go through a couple that we didn't. So at Microsoft, there was it was a very bespoke proposal to request a report on climate risk in the employees' retirement options in their 401k plan. So there's this concept in the shareholder proposal process of ordinary business. And there are times, and we felt at this time, that the 401k options that the employees had felt to us like ordinary business, and a report to shareholders we didn't think was going to be additive to our knowledge and understanding of the company, and that's a type of proposal or that type of issue is something the company could handle. We did engage the company with it, talk to them about it, but I also brought this to bring out a point because of the fight we had with Exxon, is Microsoft chose not to challenge the proposal or just, let it go on the proxy statement. They didn't take the investor to court. They didn't talk about the sky falling down because they had this bespoke proposal. It made it onto the ballot. They gave shareholders the opportunity to weigh in on it. It was overwhelmingly defeated, I suspect, because as we felt, this really touched on the ordinary business of running Microsoft, and any kind of report on this would not be additive to our understanding of that security. And so this is an example of you don't have to take your shareholders to court. You can just use the SEC process as it's been designed. We talked earlier about the Chevron rule, and using existing frameworks to settle these, which we think the SEC process is the appropriate one. And here's an example of a large, very well-known company just allowing the process to take place. Didn't get very high support. It won't be allowed on future ballots because of the low support. And we were one of the ones that did not support that, but mostly because of the ordinary business aspect of it. Also, another ordinary business one, Starbucks. They had a proposal asking for a report on their plant-based milk pricing. So once again, for us, that felt very ordinary business. We don't normally talk to companies in our engagement program about the price of their products and which ones they charge more or less for. And once again, a company choosing to just use the SEC process, allowing it on the ballot, not having to sue the shareholders for something that they felt was, ordinary business. We did vote against this because we did not feel a report was going to add to, on the pricing of their products was going to add much value to our understanding of the company or the investment, so we voted against. And the final one I'm going to bring up that we voted against was a proposal at Bank of New York Mellon. This was around, a proposal around severance policy. Now, remember at the beginning, I talked about the lag time between a proposal is filed and then when we get a chance to vote on it. In this particular case, the bank addressed the issue. They were unsuccessful in getting the shareholder to withdraw the proposal because this particular shareholder doesn't usually engage with companies. They just file proposals. So we voted against it because in the time between when it was filed and when we had the opportunity to vote on it, the company had made some changes to their severance policies that we felt were appropriate, in line with best practice. And so we voted against the proposal because it had been substantially implemented from our view. So just a little flavor. We support lots of shareholder proposals. We'll get into some of those numbers in a moment. But there are some that we just don't feel are going to be additive to our understanding of that particular security, and we will vote against. I think in the last 2 years, our overall support for shareholder resolutions is about 2/3. That's been, it's down a little bit from a few years ago, but consistent with the proxy voting guidelines and the governance and sustainability principles. Next slide, please. I'm going to touch on a moment for mergers and acquisitions. We see a number of these each year. It doesn't, I didn't even put it on the earlier pie chart because it doesn't rise to that level. Primarily what we're looking for here is, are we going to earn a premium to the existing share price? That's the primary concern that we're looking at in a merger. We let the FTC worry about whether it's competitive, anti-competitive, but as a fiduciary, if we're offered more money for the security, and generally in the U.S. you'll see premiums of 15, 20+%. So as a fiduciary, we like to take the higher price and we can use that to put into other investments that we like. So that's the primary driver of our M&A reviews. Next slide, please. Proxy contests. What I tell everyone about proxy contests is no two are the same. There's a lot of common elements to these, but each one has its own idiosyncratic things going on. What we do try to do is we endeavor to meet with both management and the dissident that is putting up one or more candidates for the board. We want to meet some of the board members on both sides. We want to understand, is this activist more short-term focused, or are they long-term focused? Are they do they want to fix the company, or they may be trying to get a couple board members so they can do a quick special dividend or something of that nature? So we want to stick with the board that has the right strategy, is long-term oriented and focused. But trying to paint them all with one brush is very difficult in my career. I think each one is just a little bit different each time. They're fun to work on, very time consuming, but we really try to look through that long-term lens on which side is best positioned to deliver that long-term value. Next slide, please. Okay, so I want to talk about proxy advisory firms and some other research firms that we use in our day-to-day processes. There are two primary proxy advisory firms, Glass Lewis and ISS, Institutional Shareholder Services. It is a duopoly, a global duopoly. They probably own north of 95% of the market in providing proxy advisory and operational research and operational help to asset managers and asset owners globally. Neither one of these organizations is terribly big. I would say, ISS is about 3 times the size and revenue of Glass Lewis. I think the two together revenue size would be well south of, $1 billion a year. These are not huge organizations, but they provide tremendous operational help to our organization. And they also, in terms of their research, they get maligned a lot because they make vote recommendations. And I want to be very clear and reiterate for everybody, Their vote recommendations in no way are an input or impact our vote. What they do is they read proxy statements in native languages and then provide us with what I'll call a Cliff Note version of that proxy statement that captures all the data elements that allows my team to apply our proxy voting guidelines. And so while a lot of people, especially the corporate community, gets very upset about the recommendations they make because they do have clients, generally smaller clients, that don't have a team like I do and rely on that recommendation to apply their policies. We don't need that because we have the right team in place. So there's that element, and then the element of that slide I showed a while back with the crazy lines everywhere. They know how to get us our ballot and get the ballot back into the ballot box in a timely fashion. And that sort of help and support is invaluable for us exercising our ownership duties. And then we talked about in the PACE section, we use a company called Equilar, which collects tremendous amount of pay data. They also have some diverse direct data that we use as well to apply our policies around board diversity. So those are three of the primary research sources that we use to do our day-to-day work for proxy voting. Next slide, please. Okay. So I talked about in the beginning stewardship. We think of this as being an active owner, not an activist owner, but an active owner. And included in our proxy voting duties is our engagement process. We look at three different types of engagements that we do. One is what we would just call routine engagements. We try to focus in on, and our program is designed to attempt to talk to more than 50% of the AUM in our equity portfolio. And we want to have touch points with these companies where we've made large investments, talk to their IR teams, talk to the CFO, remind them of the things that are important to us. And some of those are with very good companies that are run great and don't need much from us. We don't need much from them, but having that touch point, ongoing touch point, is important to the program. We have initiative-based engagements like CA 100, like the work we do with some of the other California pension funds around board diversity, and then any other type of thematic engagement that comes up. We're currently working with one of our providers on a methane reduction engagement, a couple companies in the oil and gas industry. And then we have an event-driven. So when we see something that happens, Southwest has trouble getting planes off the ground, Boeing, maybe an airplane theme here. Maybe it should be a thematic one. We'll call companies up and try to ascertain if the board has a good handle on that situation. And then we have to ask ourselves, what is our role here? And so, does the issue at hand have impact on the company, on their risk and opportunity profile? What is the likelihood of success? We do have some companies in the portfolio where there might be a dual class share structure where the controlling shareholder doesn't take a lot of input from shareholders and we might not have as much influence as we would hope. And then do we have the capacity and the expertise on the particular topic? And where we don't, we might seek to partner with one of our managers or maybe some other owners. Or do we have the expertise and can we provide something of value to the company on our views that we think will be helpful to the long-term value of that investment? Next slide, please. So I think we showed some of this voting at the IC meeting in March. As you can see, we vote just over 9,000 meetings per year, annual and special meetings. We vote on close to 90,000 proposals across those 9,000 meetings. In terms of management proposals, we support management 71% of the time, but that's 29% of the time where we disagree with some aspect of their governance or environmental or social oversight, and we'll cast a vote against. And then on global share owner proposals, I'm going to highlight that in China, for example, The shareholder proposals are filed by the government, so we don't really see those as shareholder proposals, but that's how they're categorized. So our overall support globally is a little lower than it is in the U.S., but there's some idiosyncratic markets out there that have some weird shareholder proposal rules. So we don't typically support some of those. Next slide, please. And then just some, highlight here on the bottom left slide on the international management proposals. You see the drop to 72% from 76%. That really was driven by the change in policy in 22 for the Japanese market, where that was the one carve-out market we had on board independence, and we decided in 22 to do away, or at the end of 22 going into the 23 season, to do away with that carve-out and bring them back up with the rest of the policy. And so our level of support dropped dramatically. That year-over-year drop is what you're seeing. Can we skip over to page 24? We've shown this before. So we vote against nearly half of the say-and-pay proposals in the U.S. We do think there are some real systemic issues around the long-term nature of some of these plans that really are more short-term than I think people would expect. I will say this, in our early numbers coming out of the 24 season, we're about 40% against in the U.S., and some of that is, as we've talked about earlier, the robust market in the U.S., where some of the stocks are starting to outperform the pace of the increase for the CEOs, which is a welcome change. So we supported a few more this year than we have in past years. A lot of that is due to the buoyancy of the U.S. market right now, which can certainly change. Okay, and then maybe go to slide 26. We talked about the shareholder proposal support, so you see a drop from 75 to 67%. But what I would focus everyone in on, the two blue bars. So in 2022, we supported 400 shareholder resolutions in the U.S. 2023, we supported 399 proposals. The difference being the denominator changed a bit. So the denominator went up by 60 or so proposals. Some of those we didn't think were particularly well constructed, and we didn't support. So while the percentages change, we still support a lot of shareholder proposals. And you can see by the blue bars, we've been pretty consistent in supporting well-crafted, well-targeted shareholder proposals. And then just maybe go to slide 29, and I know there's going to be plenty of questions. We have a couple links in here. These policies are up on our website for anybody who wants them. I did look, Frank, I know you complained that the policy was very, very long, 180 pages. Now, the proxy voting guidelines are about 15 pages, so I may make you read them because they're not that long. And our governance principles are 45 pages. So, those are in place. But I'll conclude my prepared remarks and open up the floor to questions.
Okay, Drew, thank you very much. That was very in-depth. And that's kind of what we wanted there was the 15 pages, not the 180. Do I have any questions from the board? Mr. Rubalcaba. There you go.
Thank you for the presentation. I have two questions. One, maybe I missed it, but you mentioned there was 7 matrix. And I couldn't find it, or did I miss it?
Oh, what I said was the ambassador had his seven principles.
I see.
And so when you get a chance to read those, when Teresa sends the round, I think you'll find that our existing stewardship program aligns very closely with those. So we haven't bucketed it the way the ambassador did, but our program is very much aligned with what he had shown.
Thank you. And I also made that observation, and my question actually relates to one that is on both. I noticed in the slide 16, when you talk about ESG, you mentioned political spending as one of those under
That's correct.
Yes. And later on slide 28, you again listed with a little bit more detail, but I was hoping you could expand, and it's actually a bit better because now it says political spending or lobbying.
Yes.
And so I was wondering if you could expand how you guys research that and what triggers it. And I'm
Yes.
glad it's included, but I
Yep.
just want to understand a little
Yeah,
bit
no,
more. 'Cause I know
happy.
there's I know for me personally, there's a lot of issues after a lot of corporations. Well, you know what? I'll let you answer.
Okay.
I'll tell you my.
So there's an organization called the Center for Political Accountability that for a number of years now has been tracking at the S&P 500. They look at around 50 metrics on disclosure and oversight by corporations in the S&P 500 on their political spending activities, and they come up with a scorecard for each company. I think it was back around 2016 or 17, there were a couple of shareholders that filed, I believe in the first couple of years, more than 100 proposals, shareholder proposals, asking companies to disclose more around their political spending. And I think a lot of this came out of 2011 or no, 2010 with when they opened up political spending and corporations could spend what they wanted. And so the CPA started tracking this. So we have access to that data. They make it available to everybody. And we use the scorecard to help us evaluate if the company is aligned with its peers and best practices around political contributions, lobbying, disclosures. And so we have seen over the last couple of years a lot of proposals filed. Now they've started to decline because companies have been better in the last few years about disclosing this information on what they're doing. But that's why we highlighted that, because it has seen a lot of proposals, probably been a few hundred in the last 5 years. And that's the information we use to help us evaluate those.
Thank you. I was very pleased to see that there.
You're welcome.
Thank you, Mr. President.
Thank you. Next on the list is Malia Cohen.
Thank you very much. Thank you very much, Drew. This presentation actually has stimulated a question that I want to really direct towards the CEO, and that is to ask that a formal way that you come up, with a formal way or formal process that you can inform this body and solicit our strategic feedback or advice before proxy votes are cast. Is that something that is feasible?
Remove my stuff. There you go.
Thank you.
Yeah. So some of these votes in the annual meetings may not coincide that well with our board meetings, which is why we have the proxy criteria and the guidelines that are then brought in by this board. But let us take a look at it.
Even if it's something that you're soliciting via email, it's, you know, I understand that everything's not going to line up with our board meetings, but particularly this last proxy season, it was so fun and exciting. I
Speak for yourself.
I missed out, and
Exciting for sure.
I would have loved to have been able to play with you.
Thank you. You know, I wish we had a mechanism where I could solicit your feedback outside of board meetings, but unfortunately, you know, we have a Public Meetings Act here in California that would not allow me to do that. That would be a meeting that the public would not have access to, and to really provide public comment on a vote. So, you know, we have to operate within those parameters, but I think, you know, we should take another look at the proxy guidelines, see if there's anything missing that you want to make sure is very reinforced for next proxy season. We can do that. And then you can always call me. You know, if there's something that you're concerned about in particular, call me and I can explain where the team is at. I know we had one where we had that interaction on.
So, and just real quick, so just so you also know, any votes that the team identifies as sensitive, we do a weekly report to the senior executive team. So Marcy and Dan and Michael and others, and me, so get a chance to also review the team's work on what we think might be some of the more controversial votes coming up as they arise.
So then I guess the question is, as it relates a little bit to proxy guidelines, and I'm looking at you and you, what lessons have we learned from this last proxy season, and how are we going to incorporate those lessons that we've learned?
Yeah, and I think, you know, it would be great to get some feedback from all of you based on, you know, our proxy, excuse me.
Here, I got it.
Okay. Oh, thank you. It would be great to get some feedback from all of you based on our proxy voting record this season. I know that there is one in particular at Disney that maybe, you know, Drew could talk about. That's the one that you and I had a conversation about. You know, and I think what the team was looking at in that particular vote was behavior of a company that was not allowing direct engagement from its shareholders. And so, the viewpoint was we need to send that message. Now, unfortunately, when we voted against, it actually put in someone who we voted against later at another company. So it felt a little disjointed. I get that. I don't know, Drew, anything you want to add on Disney?
Yeah, what I could add is we're trying to throw a change up on that one. The company, we have plenty of engagement with that particular company, and we felt our message over the last couple of years was not getting through very well on a number of items. We did an analysis of, did we think Disney was going to win or lose? We did not think they were going to lose the vote. So we used our vote as an opportunity to throw a change up. What I can say is we think it worked because within 2 weeks, the company called us up. They're going to bring a director to the next meeting, so that we were using it as part of sort of a larger platform. And the two people we voted for, we didn't think were going to win, but we wanted to send the company a message. We weren't happy with the way they had been engaging with us, and we think we have reset that engagement. And we're going to be engaging with them in the fall. They're going to bring a director, which they did not even bring a director. Remember, I talked about contests. We like to meet with directors. They didn't bring any directors. We didn't cancel the meeting. We still had it. We didn't walk out and protest. We took the meeting that was offered.
Microphone. Malia.
Malia.
Malia,
Okay.
turn on your microphone.
I was like, I thought it was on. So I take full responsibility. The person, one of the people that we did pick was not the ideal vehicle for that change-up. We knew that person wasn't going to win, and we knew we needed to send a message to the company, and the strategy, in our view, has worked, but we understand some of the blowback we received on that. And so I apologize for that. Our intention wasn't to put him on the board. We knew he wasn't going to win. We had done sort of a straw tally, and but we did have to do something with a company that we own $200 million of that had stopped listening to us.
Yeah, and I think the only other thing I would add, Drew, to your response is that there was a lesson learned as a result of that, because that individual was up for another company vote in which we voted against.
So I think before I move on to Melissa, I just want to make sure, rather than us coming back with suggestions, I want to know what you guys learned, and maybe you guys can come back with some suggestions on changing our policy a little bit that updates the policy. I don't know exactly what that means, right? Because you guys have been working with that policy for some years.
And we update it annually, and I'm very pleased that I think the policy is best in class, globally. We spend a lot of time thinking about it. We review our data every year, trends, and when we see new issues, we will add that. We do think we're going to add another element to our climate risk review.
Okay.
We don't necessarily put that in the policy because we don't want to get gamed by companies, but we will add that sort of the back end element on how we review those. So
when is our annual review, Drew? When will you have that review done?
So we started in the fall because we'll have all our data in, and then we present at the March IC any changes, but we can certainly tee those up.
We can bring it back in March.
And any changes that we're proposing goes through the senior leadership team before we do it.
Thank you, thank you. That's what I wanted to hear. Short answer, Mark.
Sorry.
Everybody's trying to get succinct at this time of day. Can you tell?
I'm keeping you from drinks, so I apologize.
Melissa, go ahead.
Thank you so much for the presentation. I really appreciate all of this information. I'm definitely going to save this presentation in my archives as something to look back on often. I also found this proxy voting season very exciting. And
I didn't sleep much, just so you know. It was.
I had a question on the Exxon vote. I was
Yes.
really happy to see that CalPERS was really visible and effective in its leadership. We used, the vote against the full board, the exempt solicitation, strong, consistent presence in the media, which I thought was all phenomenal. But at the end of the day, the Exxon chair received over 87% of the vote. The CEO received over 91% of the vote. So while our leadership was there and our vote was very significant, we do know that major asset managers did not vote against any Exxon directors. And so what are we going to do to continue to lead and push these asset managers to align with our mission?
Yeah. So let me talk about a few aspects of that. And, first of all, I think the leadership from Marcy and the executive team to take this action was critical. What I will call a success. So if you look at the lead independent director's vote total from the previous year, it was 4% higher. When we did our evaluation of how many votes we thought we'd pull away, we thought we'd pull 4%, which is exactly what we did. We were fairly certain that the large institutional asset managers were not going to do a vote against. One of the primary reasons for that is, everyone has their own set of guidelines. Not everybody incorporates this element of the idiosyncratic piece. So Exxon didn't do anything that fell neatly into the asset manager proxy voting policy. So one of the things we are going to do this summer is talk to some of our managers, just about their policy and some of these idiosyncratic votes that come up and how they're going to think about those a little differently. I know at my time at the asset manager, our policy was a little more black and white, which I didn't always think was the best approach, because these things like Exxon happen from time to time, and our policy is flexible enough to deal with that, which is what I think is the appropriate way. So in terms of, it was the right thing for us to do, and what I will say is, actually the slide that's up here right now, things like majority voting under the governance, 10 years ago, that didn't exist in the United States, and it took a couple of brave people to come forward and introduce that. So while we didn't win as big as we might have wanted at this one, what we did do is get people to start reconsidering, was the SEC process truly broken? We don't think it was. We highlighted that, and we've gotten some people to rethink this a little bit, even if we didn't get as much voting as we wanted on that. And so some of these things take a little bit of time, and I think the leadership that Marcy and the executive team took, us being consistent in the press on what the issue was, I think we'll win the day, even if we didn't win that much at the ballot box at this meeting.
All right, thank you so much. That's good to hear. And I do think we won the day as well. My next question is, and I think I know the answer, but I want to ask it to get a really clear answer. I know that we engage before the votes. We engage with companies. That is our policy. After we take after we take these votes, do we follow up with an engagement process or policy to say, like, hey, this is what we did? It sounds like we did for Disney.
Yes.
But do we do for is that a consistent policy or process that we follow?
So we, in the last 12 months, probably had around 450 engagements. So we have 6,800 companies. So we don't do that with everyone. But yes, if it's a key vote, we will endeavor to speak before and after. We sometimes have multiple meetings with companies throughout the year. So we endeavor to do somewhere between 400 and 500 of these meetings on an annual basis. So we won't get to everyone every single year, obviously, but on the key issues, we make an effort to connect.
All right, I have one more question, I think. CalPERS has a page on its website called Notable Proxy Votes that doesn't look like it's updated, but that there's a link maybe to another site. Can we update our website with the notable proxy votes?
We can.
Okay.
Yes.
Okay. Thank you.
Thank you. I think one of the questions that Melissa asked that I think is interesting is, what is our follow-up when we vote on these proxies and we engage beforehand? Say we take the 400 we engage in. What do we do afterwards? Say we don't win the day, right? What do we do?
Well, we can do a number of things. So, there's a potential escalation of this is, we try again. We may ask for a director if this has been 2 or 3 years and try to talk directly to a board member to make our views abundantly clear. In the Exxon case, we use the exempt solicitation process, so that's another avenue. We can file a shareholder resolution if, we think that's, the means to do that. So there's a number of things we can do. I try to be patient with these because you don't always get everything on the first phone call, and you keep at them for a while. If it's obvious at some point that we're not making any progress, like in the case of Disney, we tried something a little different. Was it maybe we didn't explain that as well to our stakeholders, but in terms of the approach, it actually worked. And we could have done a better job explaining that to our stakeholders on why we're doing that in real time. So we'll try to endeavor to be better on that front.
For the letter writing, is that what the letter writing part, is that what you're talking about?
No, just the candidate we chose, like the strategy of doing a different vote that kind of surprised the company, kind of reset the relationship, and so that strategy worked, but we didn't explain it very well.
Great, yeah. And also, yeah, I think everybody was looking at the person that you, and yeah, didn't understand that.
We knew he wasn't going to win, and we just had to throw a change up.
So maybe, yeah, making sure one of your changes is when you report it to the board is to say, yeah, hey, we don't expect this to win, but yeah.
Yep.
I know.
Just to add to Drew's point, I think one of the things, for example, when we started the executive comp framework in 2018, and we voted against, over 53% of companies in the US on compensation, we actually wrote letters to each of those companies, to the chair of the executive compensation committee. And one of the things which, don't come out in public and we don't report on is the feedback that we get from some of those companies, where they say that the fact that they received a letter from a shareholder actually helps with the discussions within the boardroom. So the things that may not be apparent to everyone, by those follow-up meetings, by the letters we write to companies, they actually do influence the actual discussion in the boardroom. So it's really important that we actually do that.
Yeah.
Okay. Frank Ruffino?
Thank you, Madam President. And before I ask the question, too, I wanted to publicly, as I've done privately, to thank you and your team for looking at the thousands of votes, which I was not aware, that there are that many, but there's quite a bit there. That said, I raised this issue in the past, so it's not new, and about the challenges that we have in the executive compensation, right? So I know we have a misalignment, with the long-term performance, for example, which is not good for us for long-term. The lack of transparency that often happens there. The weak shareholder influence, and there's not much we can do about that one. But the one that I want to focus on is the inequity at the excess pay. And there's often a significant gap, as we all know, between executive pay and the compensation of an average employee, leading to concerns about fairness and about equity. So unfortunately, there are several instances where CEOs' pay ratios are vastly higher compared to the median employee salaries, creating obviously potential morale, reputational issues, and so on and so forth. So the question is, and I'm not sure, I'm thinking out loud and I'm asking out loud, how can our policy, what can we do to promote equity and fairness? Is perhaps establishing guidelines to ensure more equitable pay structure within an organization? Is there a way to introduce policies, guidelines that limits the excessive CEO to worker pay ratio? Not sure, but that's the question. Thank you.
Yeah, and thank you, Frank. We do look at the pay ratios. It's baked into our analysis. I think one thing that really needs to start happening is we're going to need the asset management community to start putting a little more pressure. As I said before, we own about 20 basis points of a company. We vote against nearly 50% of pays. I think we've done, we make our methodology available on our website. We've been very forthcoming with companies and other stakeholders about what we're trying to accomplish. The asset manager community has not taken up the cause as much, and if we could get a little more against votes and a little more pressure from some of those folks, and it's something we talk about with our managers. It's just difficult if we're the only ones doing the 20 basis points against the company. On average, the say and pay vote is about 95%, 95% in favor. So right now, we're still one of the lone voices that is consistently pushing companies to have more aligned pay, more long-term pay, shrink that gap between the median employee. But we can't do it alone. And I'm not sure what else we can do to get some of those other folks on board, but that's, I think, partly what it's going to take.
And I'm sorry, Drew's also being very modest, and this goes back actually most of your
Speak
question.
into the mic a little more, sorry.
Sorry, I'm trying.
You gotta pull it in front of you.
Okay.
It does move, believe. Oh,
There we go. Maybe that's a little better. But Drew's being modest. He's not talking. He's not trumpeting this, but something he just got approved maybe a week or two ago within the internal senior team was actually sending out a survey to our big asset managers. So managers that we spend tens of millions of dollars with, either on the asset management side, the brokerage side, or both. We call it our sort of real strategic relationships. And it's going to be a survey that goes out to them and says, hey, we just want to know how you voted on this, and this, right? And it's 12 different things.
We picked, I think, 7 key votes from this proxy season. We're going to send it to 11 managers that we do business with, representing, 9 figures in fees, and have follow-up conversations with those managers and remind them about the things we're trying to accomplish through our engagement proxy voting program. And just let them know that we're going to be watching a little more closely on what they're doing than we have done in the past.
I don't know if that's gonna change Elon's mind, but,
Can I just do a quick follow-up?
Yeah.
Is it too simplistic to sort of think about a ratio? To make it that, if you don't fall into that ratio, is that too idealistic or too simplistic?
The one thing I would caution against is this is the tort reform idea. If we put a number out there, all the people that are below will go higher, and sometimes it actually makes it worse. So every time they try to introduce tort reform, this is pretty well known in economics. If you draw the line, all the people well below the line now move up. So sometimes if we were created a bright line test on that, we might actually make it worse than it is. And so we're going to keep continuing our approach, but I worry about all the people that are below that would, shoot up to to whatever line we drew.
Thank you. Thank you, Drew. Thank you, Madam President.
thank you, Mr. Rufino. Ms. Walker, go ahead. It also.
That's right. All right. And I will say, it is very important to speak into the mic, having spent the last year on Zoom and can't hear anything almost of what you guys are saying. A lot of you fade off at the end. So I want to put that out there just to be more cognizant, having experienced that. One of my questions, and thank you. One of my questions is, I'm trying, JJ. So one of my questions is, is there like a tier thing? You have 6,000 plus companies you're evaluating or whatever.
Correct.
But so is there a tier, because all 6,000 can't be equal? So like, do you have tier 1, tier 2, tier 3?
So we work with our proxy advisory services to sort of curate some key watch lists for each season. And that might be 1,000 companies, which the team can handle. So you're right, in each season, so on the climate oversight, that list is 350. On compensation, in the last 2 years, we've contacted 100 companies, ahead of season to say we might have some issues there. And so we'll curate a couple, what we call key watch lists, going into each season. And so we'll sort of tier those and spend a little more time on those. And then, yes, there's a lot of routine meetings out there that the team doesn't have to spend a tremendous amount of time on, but that's basically how we tier it.
Okay, that makes more sense to me, because I was thinking 6,000, there's no way in the world they can do that and be effective, really. And then I had a question on the slide where it had the ESG, and it explained out the different things you were voting for. And one of the things, and maybe it is considered and it just didn't make the slide, but we get a lot of times here at the board, we'll have different people come and testify about, practices that they're experiencing at a company and everything else. And I don't see anything about like the human infrastructure, right? Because if they don't take care of that, at some point, the company's not going to continue to be, I don't think, profitable, right? There's a balance. And so how do we fit that in to make sure it's kind of like online with Frank, but not necessarily like, let's have a strict ratio. But how are they treating their human infrastructure? Because if they're not treating them well, they're not going to treat anybody well.
Yep. So generally what we do with that is when we become aware of specific human capital management issues at companies, is we will attempt to engage if it's large enough in the portfolio, and then do a vote against the NOM or Gov committee. So it didn't make the slide, but it is baked into the program. And we have one of our vendors tracks some of our larger holdings on sort of news events so that we get alerted to where we see those instances. And it's hard for us to know ahead of time. It's sort of once we see it, then we start holding the board accountable and try to engage. But just because it's not on the slide doesn't mean it is part of the program. And so we use these new services to identify, problems as they arise, and then we address them as they come up.
And then just one last follow-up on that. So, and I get it, and I get when you're saying that, when we put things out, I view it as we do things incrementally, right? Because you're not going to get a big change, a big swing. That's not going to happen. And so even just knowing that we're monitoring and asking is a start, right, to get that, moving and looked at.
Yeah, we really view the program as incremental change.
Right. It would have to be.
And you have to be patient and consistent and take that long-term view. And I think this organization has always done that, and we've seen great strides over the last 20, 25 years in the reduction of takeover defenses, in the improvement in board independence, in the improvement in gender diversity on boards and other types of diversity, and it takes time.
And I think it would be helpful if you talked about that stuff a lot. Not a lot, but you talk about that stuff also, because I think it gets lost as we go along. If you're not talking about something, it goes out of people's memories. And so these reports are good, but to add in that context also, I think would be helpful.
Will do.
Thank you very much. Mr. Pacheco.
Thank you. Thank you, Drew, for your comments and so forth. My question is back to the proxy advisory firms. You mentioned in your notes that staff will review the information provided by these firms, but they will only use it as a resource. Can you elaborate on that a little bit more on what you mean by that?
Yeah, so that was probably not a very elegant way of saying we don't rely on the vote recommendations. So what they do is they take all the elements in a proxy and they put it in a consistent format, what I'll call cliff notes. And so all the things we need to do to apply our policy are contained in these research reports. So it's the data that they collect that is the input, not the vote recommendation, if that makes sense. So they'll put in a director table and who sits on which committee. So if we're going to vote against the nominating committee, we have a nice table right there. We don't have to go sifting through the proxy statement. For the pay elements, they draw out a couple years worth of pay elements. They talk about the metrics. So they contain that in these reports. So that data and information is the inputs into how we apply the policy, but not the vote recommendations that they make.
So we utilize our CalPERS governance and sustainability principles to provide us the framework that we need to.
Correct. And so all the things that are in there, these companies collect the research on, and that's what helps drive the vote. They're very famous for the vote recommendations they make, but that's not the input. It's all the data that sits behind it.
I just want to just clarification. I think I went to the in March to the Council of Institutional Investors, and they gave me a pretty good perspective on like a broader understanding of this. And I know you guys sit on the board there. What's your thoughts on those hosted based meetings, because they provide a nice framework with a lot of these themes that we're talking about?
Yeah. So actually how that works is I've hosted a couple of those myself, is you petition them. They have 2 meetings every year, the spring and the fall meeting, and they go out to all the members and say, would you like to host an informational meeting? And you can submit your idea, and then the CII staff, sifts through all those and then awards slots for those meetings, and I've actually hosted 2 in my previous role, but that's how those meetings come to be. So it's sort of the CII staff looking through the key issues of the day, and anybody putting their hand up that wants to address those.
No, there was one, I mean, I believe we had one issue with, it was with the Disney. Disney was one of the talks that actually was brought up in one of the
Yeah.
meetings.
No one can hear you.
Sorry, Disney was one of the, sorry, Disney.
It's on, it's just not in front of you.
I'm so sorry. Yeah, Disney was one of the hosted meetings that we actually had. I
Yes,
believe.
so that was in the big room, and so that was staff reaching out to, I think it was Mr. Moffett, who was advising from Value Edge Advisors, and asking him if he'd like to come and present. So
Oh, I see.
that's how that came about.
No, I thought it was a very good educational environment to give us a broader education of the whole process.
Mhm.
Okay, thank you very much.
Yeah.
So let me remind Mr. Miller and Lisa, the dinner's at 6, just FYI. Go ahead, David.
I thought I would land this on time. I really
You have
apologize.
3 minutes each, man. Let's go.
Okay. Pull this up here so you can hear me. Yeah, I mean, so many of the questions and comments that have already covered most of what I was thinking of mentioning. Mr. Ruffino bringing up the issue of say on pay, and I look at it in the bigger context of our executives being compensated, you know, when it's not congruent with their performance or their company's performance, or are they getting increases way beyond what's being shared with the labor and stuff. So those are all issues that I think are worth bringing up and thinking about in the longer run. But mainly, I'm really dwelling on the takeaway that I have a hard time with conveying to stakeholders, and I think it's something for us all to think about, is they often look at it as, well, you voted, but you didn't beat management, and I think the way you explained this cumulative, long term, this is a slow rolling thing. This isn't, and our leadership and our kind of bully pulpit, if you will, and that other institutional investors look to us for direction. And we generate a lot of interest. And the Exxon thing, I mean, when I look at that, or the Elon Musk thing, the pay, but the Exxon thing, the amount of earned media that we got out of that was, and to the folks who sincerely think we should just divest and walk away and not play, I say, look at that. We could not have bought that kind of earned media coverage for our issues and our values. We just, even with our size, we wouldn't have the money to move the needle like that in a couple news cycles in a row. And that's, to me, the real benefit of this is highlighting our leadership, communicating and making a difference. And occasionally when the vote goes our way, yahoo, but that's not really, we're not doing a runs batted in average. We're really just moving that incremental progress along.
Thank you, Lisa, you're up.
Well, everybody will be pleased that Ms. Walker largely already asked my question. In a larger context, in our investment strategy, we've made clear over the last year how important labor standards are in decision making. And so what I would ask is that as we approach the review of our policies and practices when it comes to proxy voting, that leading up to the decisions the board will make next year, that we have a very robust discussion around labor standards and presentations as to how we can strengthen our efforts in that area.
Understood.
So that, I think, wraps up our board questions. I do have public comment, and I'm calling Steve Silverstein. Steve, to the front up here.
So my name is Steve Silverstein. I live in San Francisco. I'm a taxpayer here in the state of California. And I want to address the issue of CEO pay. As we all know, it's just gone up and up and up, usually about 10% a year, while the average worker is just stagnated. And this increasing disparity is a risk, because when workers see the management getting so much more than they're getting, they get unhappy. They maybe slough off on the job a little bit, or they go on strike. So we know that's what happened at the General Motors, the automobile strike. The whole issue was the CEOs were getting $25–30 million a year, and they were making, $15–20 an hour on the assembly line. We see that in Starbucks and so on. So as a matter of reducing the risk of disruption in the companies that we're invested in, we need to do something to rein in that ratio. We also need to do it as a matter of fiduciary responsibility, because when you see a cost going up and up year after year, you need to do something about it. And when it's totally unnecessary, you take the automobile industry, for example, the CEOs were making $25–30 million a year. Their competitors, Honda, Toyota, BMW, Mercedes-Benz, those CEOs make about $3, $4, $5, $6 million a year, and they're doing a better job. You see this with Boeing. Boeing can't get a plane that flies. The CEO there is getting $25–30 million a year. The CEO of Airbus, which can make planes that fly, gets about $6 million a year. So we need to do something to rein this in. Now, I appreciate the model of tying pay to performance that CalPERS developed about 5 or 6 years ago. I think that was a big step forward, and CalPERS was voting against, as a result of that, 50% of the pay packages, now 48% or something like that. That's a hell of a lot better than many other pension funds are doing. And I'm speaking particularly about CalSTRS. And if there's any board members here who are also on the board of CalSTRS, you need to be asking them as to why CalSTRS is approving so many of these outrageous pay packages, whereas CalPERS is voting against a bunch of them. But CalPERS could do better. There are other pension funds that are voting against more than CalPERS is voting. I'm referring to Florida. The great red state of Florida votes against far more than CalPERS does. Minnesota, Rhode Island, Vermont, and even the University of California system, which is about $125 billion pension fund, they vote against 80% of these pay packages, and we're down here at 45%. So we need to revise. We need to revise the model to do better, and I hope the board or the staff gives some direction to the staff to revise the model to do better in this way. And I think putting into the model
Your time's up.
Can I have 30 seconds more? I know the dinner's
How about 15?
15. Put in there the pay ratio. One of the criteria should be the pay ratio. If the CEO is getting more than 30 or 40 times than what the worker gets, that should be an automatic no vote, just like if the board is not independent and so on. So please consider that and bring that back to the board for consideration. Thank you for your time.
Thank you, Steve. So this concludes our presentations for today. Thank you, Drew. Thank you, Samiso. Let's give everybody that presented a round of applause. Before we go, I'd like to thank our stakeholders in attendance, whether you're on video watching or you're here in the room with us. We will be here tomorrow at 8:30 in the same room. So be here bright and early, guys. Enjoy your evening, everyone. At 8 o'clock.
It's at 8:45. We'll do roll call and then we're going into close. Want to let people know.